Hello there. I hope that you are doing well. Welcome to the first lecture of the 2025 model series here on the Time Then Price mentorship. This lecture is completely different than all of the previous lectures which you have ever watched on my mentorship. And the reason why is because I wanted to do something special for the first lecture of this 2025 model series. This is the second time that I have come out here on my mentorship platform and have actually decided to put myself in front of a camera to speak to you. The reason why is because for this model series, I want to make sure that I'm establishing a personal connection with you so that I'm able to guide you as best as possible during your development. During this video, what I will discuss with you is what you can expect of the model series, but also what I expect from you as my student when it comes to making use of the time which you have with me as best as possible. Because my goal is to guide you to become an independent thinker. I want you to investigate what I'm showcasing to you. And I want you to investigate whether or not there's any validity behind everything which I'm sharing to you. Now, when it comes to the algorithmic theory, which I use to trade the financial markets week in, week out, it's very important to understand that it's based upon time and price. If you have gone through the 2024 model series, you have already gotten insights into a great deal of advanced information, which provides you with an edge over the other participants within the markets. However, based upon your feedback on the 2024 model series, I've been able to establish what is basically missing within your understanding right now. And the way that I've been able to establish this is by paying attention to the questions which have been asked by you on the mentorship forum. My goal throughout the 2025 model series is to try and simplify all the information which I shared within the 2024 model series. So even if you did not watch that series yet, that you can still make sure that you get to this very advanced level of algorithmic price delivery. Now, when it comes to what you can expect from this series, you can expect the following. You can expect weekly releases of new lectures, meaning every single weekend I'll release a lecture of the model series. The model series itself is going to consist of foundational lectures that are slowly going to transition into advanced lectures, and paired with the uncensored lectures, you are going to gain insight in the way that I trade all markets. Meaning, I'm not only going to discuss the short-term trading style which I apply for the index futures. I will also be showcasing to you the swing trades which I'm taking. I'm also going to be showcasing to you the longer-term investment plays which I'm making. And the reason why is because my goal is to show to you that there are so many different ways to go out here and to extract money from the markets. At the end of the day, guys, you need to pick what suits you. I am someone who's capable of trading all different styles because I have mastered these concepts. However, for you, I suggest you to first try and master just one style. Focus on either short-term trader, focus on either swing trading, or focus on long-term trading. If you want to learn exactly how to look at swing trading and long-term trading, you can go through the swing trading series. However, even within the model series, I will bring back elements which I discussed during that series. Now, when it comes to the journey which you are going to embark on with me, I want you to understand that it's not going to be an easy journey. It's not going to be like, oh, you watch the lectures and all of a sudden you come to this great understanding of algorithmic price delivery. No, it doesn't work that way, guys. Like some of you think you can just join my mentorship, watch the lectures, and you can go out there next week or next month and just crush it, right? No, that's like, stop thinking that way. Stop thinking that you can just achieve this level of precision that I have within a matter of 1 week or in a matter of weeks. This takes years of hard work and dedication, meaning you need to be willing to submit to time and you need to be willing to put in the required effort. The majority of people, they want to get to a level of success within a matter of months. However, it doesn't work that way. So stop trying to rush your process. Just submit to time and allow the growth to take place at the pace that you are going at. Meaning, some of you are able to commit more time than others. Some of you might be working full time. You might be taking care of your family as well. And next to that, you're also trying to learn how to trade. If that is your situation right now, don't think that you can just, go out here and succeed in this business within 1 month from now. Guys, Do you realize how unrealistic that expectation is that you are basically putting up on yourself, and the amount of pressure which you're putting up on yourself? My main advice to you for the upcoming year is the following. Allow yourself the time which you need in order to develop. And during that time period that you have given yourself the permission to develop, allow yourself to develop by simply focusing on learning. Meaning, don't think that simply because you have watched the lecture, you can go out here and get a funded challenge and go out here and try and trade. Or maybe even fund your own live account. Guys, like, at the end of the day, what matters is that you're able to get to this level of understanding algorithmic price delivery. When you get to this level of understanding algorithmic price delivery, all that there's left to do is for you to go out there and decide on your own. I would never tell you to go out here and trade. I would never tell you to go out here to put risk on the table, because I'm not a financial advisor. Nothing I say throughout my mentorship content, or specifically within this model series, should not be considered as any form of financial advice. If you would think that you can just, copy everything I say and make financial decisions based upon that, you are deciding to do so. I'm not suggesting that you should. Everything which I will share with you is meant for educational purposes only, guys. That means all the content which I release to you is purely my own experience being shared with you for the purpose of education only. If you decide on your own to ever go out here and apply risk to the concepts which I've taught to you, then it's your decision and not mine. And that's something which I am going to continuously mention to you, because I don't want you to just go out there and say, look, Zeus taught me what a breaker looks like, so I can out here and trade this breaker. No, like, even when what you will notice as well is that one of the things which I didn't really do throughout 2024 was share my opinions and share my thoughts. And I stayed quiet and stayed objective. And that was something which a lot of you appreciated. However, when I showed more of me as who I am as the person, as who I am as the operator, it actually sparked a connection between me and a lot of you guys, where you literally DM me or send me emails saying, oh, I would like you to share more of these type of brands, or I would like you to share more of your thought processes when it comes to this type of stuff. And that is why that's a side of me which you're going to see more and more. And the reason why is because I'm looking around the industry which I'm in, the trading industry, and I'm seeing nothing but garbage. I'm seeing people teach others that they can simply go out here and look for price patterns and simply just trade based upon those price patterns, and that's it. And when I see that type of stuff, it really frustrates me, because I know that that right there is a model which is not complete. There's so much information missing within that one particular model that is like, you're trading literally without any direction in mind. And when you trade that way, it's very easy to get unmotivated, because the win rate will be low and you're going to be taking a lot of trades, whilst in reality your focus should be on decreasing the amount of trades, defining what a high probability trade setup looks like, and then purely focusing on executing that high probability trade setup. That is what you're going to learn throughout this 2025 model series. I'm literally going to walk you from step A to step Z through my full protocol, in which you're going to learn, all right, this is the sequence of events that I'm looking for. And based upon that sequence of events, I can anticipate what the next delivery of price is going to be. Because you need to understand that all these markets are driven by high frequency trading algorithms. These high frequency trading algorithms are coded to operate in a certain manner. Our belief is that when we're able to anticipate, or recognize, I should say, what the function right now is of those high frequency trading algorithms, we can anticipate what their next function will be. Meaning, based upon their footsteps, we can say, all right, this is what the next plan should be. And when we're able to come to the conclusion what the next move should be from point A to point B, we're able to look for an entry opportunity within that direction, within that idea in mind. And that is what gets established by paying attention to certain sequences in both time as price. And that is the perspective and paradigm which I'm going to share with you throughout this model series. Now, one of the most important things which I want you to note down is that what you're going to learn throughout this model series is going to be enlightening. And it means it's going to be an experience where it's like, how the hell did I not see this prior? And that is going to be challenging for some of you because it's going to go against some of your former beliefs which you might have had. And I understand that for some of you that could be really hard to accept that what you were taught prior is not the reality behind why price is moving up and down. And I understand that that can be challenging to accept that. However, I want you to go into this series with an open mind. I don't want you to believe anything I say. I literally want you to just watch the lectures and investigate on your own whether or not there's any validity behind the things that I'm sharing with you. And I'm telling to you right now, if you just go into your own charts and you investigate just 1 week worth of price action and you investigate what I'm sharing with you when it comes to time and price, you are going to see these algorithm exchanges again and again and again. And you're going to be like, okay, fun, 1 week. That might have been luck, right? That might have been just 1 week in which what he shared was there, right? However, do that again, and do that another week, and do that another week, and do that another week. And before you know it, you have months worth of data, maybe even years worth of data of the same algorithmic signatures taking place at the exact same or during the exact same windows of time from the exact same points of interest, point A to point B, again and again and again. And when you come to that level of understanding, guys, I'm telling you right now, right here within this introduction lecture, and by the way, guys, this is not going to be the style for every lecture. Don't worry. This is just for this introduction lecture that I'm out here speaking to you face to face. But I'm telling to you right now, yes, when you begin to see this and you begin to see these signs over and over again of high frequency trading algorithms stepping in during these windows of time, doing this and this and this within price, I'm telling to you, you are going to feel a sense of confidence within your own analysis that is literally unseen within the trading industry. And that is something which you must work towards. And until you get to that level, I want you to simply just grind and grind and grind. And when you eventually arrive, you're going to be grateful for the amount of chart time which you spent in front of the screens. Because right now, your focus has to be on studying the lectures, putting in the countless hours, the countless reps of just going into the charts and investigating. But when you know how these markers are driven and when you can time them with a great deal of precision, consistently, your chart time will actually decrease and you're going to take a step back for the screens. Where you were initially putting in 16 hours a day behind the charts, you will now be able to just say, well, if I know that that distribution is going to take place around 10 a.m., why would I show up at 7 a.m.? Why not just wait until around 10 a.m., come to the charts 15 minutes in advance, make your preparation routine, which I also got to discuss what my routine is. Make your routine and just go to the screens at around 10 a.m., trade distribution, boom, be done. Done within less than maybe 2 hours max. Yep, that is what will happen when you are able to see these moves take place before they occur. And that is what I want you to work towards. Now, this style of content is completely new to me. I'm completely new to sitting in front of a camera and speaking to you. And I have no clue how this is going to even look on the platform itself. This is something is new to me, but I am someone who's willing to try out new things. And I'm willing to go out here and just try out what is best. Is it possible that some of you might not like this style of content and you would much rather prefer just the PowerPoint slides in which I'm just walking you through a lecture? Yes, that's possible. However, I know that there are some of you as well that really want to just connect with me more because this is the type of message which you need to hear more. And that is why I'm also going to create more of these type of sit-downs videos in which I'm just going to discuss certain topics with you. Now, with that being said, I want to wish you good luck with embarking on the studies of this 2025 model series. I want to wish you good luck with your studies in general. I suggest you to stay on track with following along with the market reviews, and the reason why is because you're literally seeing me apply in real time what I'm teaching to you. And that right there is one of the most beautiful experiences which you can have, where you can see me outline, okay, I'm entering, for example, in the bullish scenario, I'm entering for the market to draw towards this level. I'm expecting that we're going to run towards that level from this level down here. This is point A, this is point B, and then you can monitor whether or not the market is in fact delivering this way. And when you begin to see that week in, week out, and begin thinking about the amount of opportunities that there are throughout this run from point A to point B, you are going to smile and you are going to be like amazed by what can be achieved within this industry when you start paying attention to the right details. And that is what I want you to work towards. So please don't think that you should rush this process. Don't think that you should be there next week or next month. Give yourself time and give yourself the permission to submit to time. Don't think that you should go out there and just rush through it, because I'm telling to you, and this is what I've seen within the 2024 mentorship, a lot of people try to rush through the content, and by the end of that series, they realized, damn, I rushed through it. And then they rewatch it, and then they pick up on new things, and then they're like, how the hell did I not see that the first time? It's because you rushed through it. Slow and steady wins the race always. And it's the same within trading in general. Meaning within this learning phase, you want to give yourself time, and you want to give yourself the time that you need to develop. And when you eventually come to the stage that you decide on your own, you're ready for trading in general, that is when the real fun begins. Because then you also realize slow and steady wins the race. Less is more. Less transactions leads to a better result over time if the trades that are being taken are highly probable and lead to high returns. And that is the perspective which I want you to gain. Be patient, be courageous, and be wise. Good luck, and I look forward to catching with you in the next episode of this 2025 model series. Be safe.
Hello there. I hope that you're doing well. Welcome to the first real lecture of the 2025 model series here on the Time Then Price Mentorship. This lecture is going to be about one of the most looked after concepts within my mentorship, and it's called price cycles. During this lecture, I will share with you what a price cycle is, and I will explain to you how we can utilize this logic within the markets. Buckle up, because this lecture is going to be game changing when it comes to your perspective on the markets in general. Now, before we dive into this lecture, I want to share with you that even if you're completely new to my mentorship, you will find great benefit in this lecture. I will try to keep everything as simple as possible, whilst also making sure that the knowledge which I'm sharing with you is very advanced. Meaning, I will share with you throughout the 2025 model series very advanced trading concepts. However, I will also show to you how to simplify these concepts, because at the end of the day, you want to have a trading approach, a model which is very straightforward to follow, and it's very simple to follow. You don't want to have a very complicated model to follow. And that is what the goal is of this 2025 model series. And by the end of this model series, I promise to you that you'll have a perspective on the markets that's absolutely unseen. And you will understand time and price to a level that you cannot even imagine right now. All that I ask of you to do is the following. I ask of you to go into all of these lectures with an open mind and with no preconceived notions about why price is doing what it's doing. Please don't believe anything which I'm sharing with you. I want you to literally go into your own charts and look for that what I'm showing to you. Because at the end of the day, you must see it for yourself. Because I know it's there. I know that these algorithmic signatures are in front of you, hidden in plain sight. However, it's now up to you to go out there and investigate that. So pay attention to these lectures, take proper notes. I would even suggest taking screenshots of the schematics, which I will be providing throughout this model series, and move from there. So with that being said, let's begin with the first real lecture of the 2025 model series on price cycles. Here we can see a schematic, and on this schematic you can see that I've drawn a box with 2 points of text. First of all, the point A right here and the point B. When it comes to price cycles, you must understand that icttrading is following along multiple delivery profiles throughout each day, throughout each week, throughout each month, throughout each year, etc. Our job is to recognize when a new delivery profile or a new delivery function is in play. That means that what we need to recognize is where point A is taking place and where point B is likely going to take place. Or in other words, where the inception of a new price swing, in this case a bullish price swing, is going to take place, and where terminus is, where this bullish price swing is going to end. Because the way I want you to start looking at the markets is through the following perspective. I want you to start looking at the markets through the perspective of recognizing expansions. When you can recognize expansions before they occur, the lower time frames are going to be magical to you, because you will see exactly where IPTA is accumulating, manipulating, and distributing. And that right there is what our focus is going to be on throughout this 2025 model series. Because when I come to the charts, all that I'm looking for is I'm looking to determine where point A is, where the inception of a new price swing is, and where the terminus of this price swing will be. When we add something to this chart, you can see that I've added lines to this schematic. And the reason why I've added lines to this schematic is due to the following. These lines represent specific price levels. And that means whenever we come to the charts, we must know that there are price levels which IPTA will refer to. These price levels will tell us whether or not IPTA is in a buy or sell program. When IPTA is in a buy program, we will be looking for buying opportunities. When IPTA is in a sell program, we will be looking for selling opportunities. However, what does a buy program look like in the first place? Well, what a buy program looks like is through the following. What you anticipate is that the market is going to run through these levels which have been plotted on the chart right here, and it's likely going to displace above them and utilize those same levels as support and price to reprice towards point B, the terminus. And therefore, what we look to capitalize on is the move from point A to point B. Does that mean you need to enter at point A? No, it doesn't. As long as you're able to enter below equilibrium of your expected expansion leg, so the expansion leg from point A to point B, and you use proper stop loss placement, you can capitalize on the move which is taking place right here. And please note that when I say equilibrium of the expected range, I'm basically saying to you, when you recognize where the original consolidation is, which is your draw on liquidity, and you recognize that the smart money reversal is in right here, you literally only need to look for an entry opportunity in a discount of that range, if you're bullish, of course. What I anticipate when I see that point A has formed, meaning when that buy program has taken off, is the following. I'm expecting that the market is going to reprice towards the first level right here. And when it displaces through that level, I anticipate that same level to function as support on price. Meaning, I do not want to see the market displace through that level. Surely it can trade just below it, like you see right here, for example, or it can just stop right in advance of it. This is what I refer to as price distortion, and this is a concept which is basically the following. Whenever we have specific price levels that we are monitoring, you must understand that we must allow for some room for the market to trade either above or below the levels, but still remain in the same program. The reason why is because you will not see these levels function exactly as support or resistance all the times. Sometimes a wick will go through it, and that is something we must allow for. The wick which goes below that specific level which we're monitoring is referred to as price distortion. When the market then expands higher, we are looking for the same signatures that confirm to us, yes, IPTA is still in a buy program. And whenever this buy program is taking place, what we can anticipate is that the market is going to continue expanding higher until it reaches point B right here. Now, I've already shared a lot within those few sentences which I've just shared with you. Let me clarify. Our focus is on recognizing point A right here. When we have defined point A, the beginning of our buy program, and we know what the market is drawn towards, which is point B, what we're basically doing is the following. We're trading between the move from inception to terminus. Whenever we have defined what this expansion leg is going to be like, we can anticipate that the market is going to continue expanding higher until it reaches point B. It's going to work through the levels, if you may wish. That means that we can anticipate that when the market displaces higher, that we're likely going to see the market find support inside of these lines which have been plotted. However, sometimes the market will just core outside of the lines, where you will see it get above it, and you might think to yourself, oh, this is already that the market is displacing into that new range, but instead reject it, and then it begins to run. And therefore, what we pay attention to is where our premium and discount arrays are forming. So that means we pay attention to BD arrays in the sense of how the market is delivering around these levels which we're monitoring. Now, this is of course a conceptual idea which I'm outlining to you during this first lecture of the 2025 model series. And the reason why I'm outlining this to you right now already within this new model series is due to the following. This is the perspective which I want you to begin having when looking at the markets. So that means instead of looking at price patterns, you must be looking at the markets through the lens of what is the current program that we're in. In this case, you can see a buy program. And it all gets confirmed the moment that you see point A be confirmed. Whenever you have confirmed that a swing low is formed and you have confirmed that we're now in this buy program, you can anticipate until when the buy program will last. And this is of course also where trade management plays a crucial role. By the end of this model series, you will know exactly how you can navigate the institutional order flow by looking at the markets through this perspective. And it means you will be paying attention to the reactions to specific price levels across all markets. Meaning, not just on the index futures, but also on, for example, Forex, or for example, commodities, or for example, even crypto. Because even though I don't trade crypto myself, there are still a lot of traders within my mentorship that do trade crypto, and they're outlining to me that the same concepts work there. And the reason why they work there is because from a different perspective than what the masses have, I view the markets through the lens of them all being rigged. Meaning I believe that there's a lot of money which flows through all of these markets out here. And that money is not just being thrown around randomly. When we pay attention to a bearish schematic then, what you can see is that we have literally just inversed the placement of point A and point B. Because in a bearish example, what we would be monitoring is the following. What we would be monitoring is how the market is delivering within this sell program from point A right here to point B. Meaning we recognize that a swing high, a smart money reversal has formed up here within a market maker sell model, and therefore we can anticipate that the market is going to expand towards the downside towards point B. Inception to terminus. Whenever we have determined that inception of this sell program has taken place, we can enter anywhere above equilibrium of this range. Meaning, as long as we enter in a premium of the expected expansion leg which is going to take place, we can find ourselves in a profitable trade, because the moment that that smart money reversal takes place inside of point A right here, what's happening is that high frequency trading algorithms are firing in shorts, and that means they're working through the levels and they're taking it one level at a time. And the reason why this is occurring is because they must reprice towards point B. This is terminus, and it means that we can anticipate that all these levels which have been drawn within the schematic are going to get displaced through, function as resistance on price. It's possible that the market is going to go, for example, below the level as you can see here, and then go slightly above it and then run lower. What is that? The movement just above this level right here is called price distortion, and that is something you must allow for. And that is also why when it comes to trade management, you will see that we cannot just say, you know what, I'm going to place my stop loss 1 point above this price level right here, which is, for example, a full 100 number or so. No, because we must allow for the market to reprice just slightly above it, trap people into believing higher prices are next, and then drop it lower significantly. Now, when it comes to PD arrays and such, what you will learn eventually is that the creation of PD arrays can be anticipated the moment that you recognize that the absolute high, the smart money reversal, is in. Meaning you can anticipate in what order all PD arrays, all premium and discount arrays will be created. Since this lecture is still just a foundational lecture to the overall model which I will be teaching to you within this 2025 model series, I will not go into that just too much yet, because I must first make sure that you understand the overlying premise through which I'm looking at the markets. When I look at the markets and I'm expecting lower prices to come, I'm looking at where is point A, meaning where is the swing high formation, and where is the market likely going to draw towards right here. That is the draw liquidity. That is terminus of this sell program. Terminus is already predefined before we even see the swing high formation, and that's a key insight to have. But when it comes to the fact that we see that swing high formation taking place and we begin to see that sell program unfolding, what's actually occurring is the following. Every single key level is getting displaced through because high frequency trading algorithms are doing one thing. They're firing in shorts, and that could either lead to very quick repricing lower. This is a low resistance liquidity run. But in other environments, what you could see is that the market is just going through these levels at a very slow pace, where it's consolidating, where it's going back and forth, where it's taking a lot of time before it expands towards our draw liquidity. Our focus has to be on recognizing environments in which we can expect low resistance liquidity runs to take place. The reason why is because when you find yourself taking part in a low resistance liquidity run, it will feel just awesome. And for those of you that have already traded in the past, you know what it feels like, where you enter and the market immediately expands into your favor. These type of environments can be recognized and they can be anticipated in advance. Wouldn't it make sense for you to focus purely on trading in the low resistance liquidity run environments over the high resistance liquidity run environments? Don't get me wrong. We can still find setups within high resistance liquidity run environments, but think of it through this perspective. Would you much rather enter and exit within a matter of less than an hour or maybe 2 hours? Or would you much rather sit in a trade just for hours in a row before it finally begins to expand towards your favor? Of course, you would choose to focus on the low resistance liquidity run environments. I don't believe that there's anyone that would choose the latter. I really don't. If you would prefer to sit in consolidations and wait for the market to expand, you're unique. And I don't believe you should strive to trade in those environments. You want to be there where the technical precision is the highest. And what you will come to realize is that what I'm outlining to you here when it comes to the logic of point A to point B, I'm outlining to you literally how icttrading is repricing through the price ranges as I'm outlining them to you. Meaning what we're seeing is that the price cycle is the following. The price cycle is the process from point A to point B, in which you're going to see every single bearish signature, which you will learn throughout this 2025 model series. And when it comes to the bullish example, it's exactly the same, but in first, where the bullish price cycle is the movement from the point A to the point B within that buy program. When you recognize what the current price cycle is, and you recognize where the market is going to draw towards, you can enter anywhere in a premium or discount of that anticipated expansion-like range, as long as you use proper stop loss placement. This lecture has shown to you how you can look at the markets through the perspective of levels. Later on within the 2025 model series, I will teach you exactly how you can find what levels to use within the markets that you're looking at. And that means we'll be looking at both the index futures as Forex, but we'll even look at some other markets such as commodities, and we might even throw in some crypto in there if you guys want to, because the thing is, this logic applies to all markets, meaning literally if you would be looking at investing into stocks, you will see the same level of technical precision across all time frames. Guys, literally what you will be introduced to throughout this series is a level of technical precision that is not found anywhere else. And you are going to be amazed by the fact that you are going to see the same algorithmic signatures being present on not only the higher time frames in the form of, for example, monthly or weekly time frames, but also on 1 minute and sub 1 minute time frames. The reason why is because there's always a price cycle in play, meaning prices always part of a market maker model. And all you need to focus on is recognizing point A to point B. And the final thing which I want to introduce to you throughout this first lecture of this 2025 model series. And when I say first lecture, I mean the first real lecture. Of course, I record an introduction lecture, but that's different. That's not like a real educational lecture as part of the model series. This is the first lecture in which I'm introducing theory to you. What I want you to understand is that this schematic right here can be a very big range which we're monitoring. Inside of that big range, you can see expansions lower, followed by retracements higher, followed by expansions lower. Do you understand that this high right here can be your point A and this low right here can be your point B? That's a fractal market maker style model. That's a cell program which is taking place. The same right here. Point A, this low, point B. Point A, this low, point B. Point A, this low, point B. What defines a high probability trade setup is when you're able to align all the cycles with each other. Not only in price cycles, but also within time cycles. During the next lecture of the model series, I will introduce you to the concept of time cycles and I will solidify your understanding of time to make sure that you are able to align time and price. I know that many of you did not expect this lecture to be the first lecture of the 2025 model series when it comes to the topic which I introduced to you today. However, I really look forward to seeing all of the charts on the mentorship form coming in where you're paying attention to defining point A and point B. When point B gets reached, you wait for more market data. You never go out here and say, oh, now we must turn around. Because what can happen is that the market is just going to expand beyond where you anticipated the buy program or sell program in this example to stop. Therefore, be content with enough because you will see that there are plenty of opportunities each week utilizing this logic. I look forward to speaking to you in the next episode. And during the next episode, I will introduce you to the concept of time cycles and I will introduce you to how we can begin to look at the markets from a time perspective. Good luck with your studies and I look forward to seeing the charts come in. Be safe. Hello there. I hope that you're doing well. Welcome to this new lecture of the 2025 model series. This lecture is going to be on time cycles. Buckle up. First of all, I want to pay attention to the following text with you. Time without price means nothing. Price without time also means nothing. But when they align, it yields great precision. Meaning, if you're too focused on purely time, you're ignoring price. If you're too focused on purely price, you're ignoring time. However, when you start ignoring one or the other, what you're actually doing is you're decreasing the probabilities of you being able to make an objective analysis. Why? Because both time as price are the only two objective variables which we can truly deem to be counted within the markets. And therefore, our job is to align them because when both time as price tell us the same story, we can anticipate with a high degree of confidence that we are likely going to see a specific scenario unfold within the markets. And therefore, blending time and price leads to great precision. Let us take a look at some theory, first of all, when it comes to time cycles. On the screen right here, you can see that I've plotted 3 boxes. Each one of these boxes represents a specific window of time. I refer to these windows of time as time cycles. What is very important to note is that these time cycles have a fixed start and a fixed end that does not change. Meaning, if you're looking at, for example, daily cycles, you're paying attention to the days from midnight to midnight. And therefore, the days of, for example, Monday, all Mondays are going to have the exact same time. All Tuesdays are going to have the exact same time. All Wednesdays are going to have the exact same time forever. The same applies to, for example, if you're paying attention to weekly cycles. If this would be week 1, for example, well, the week begins at the Sunday open and ends at the Friday's close. The same applies to week 2 and the same applies to week 3. This right here will never change, guys. And that's very important that you understand that these time cycles are fixed, meaning they will never be adjusted. Now, when it comes to these time cycles, what's important to note is that each time cycle determines how the next time cycle is going to deliver. Meaning cycle 1 determines how cycle 2 is going to deliver. And cycle 2 determines how cycle 3 is going to deliver. And throughout each new time cycle, we refer back to the previous cycle's delivery. Meaning during cycle 2, we refer back to the cycle's 1's delivery to monitor where the previous cycle high and low formed. And the same, of course, applies to cycle 3 relative to cycle 2. The reason why we pay attention to how the previous cycle delivered is because based upon how the previous cycle delivered, we can anticipate how the current and next cycle are likely going to deliver. So when we pay attention to these cycles, they provide you with an objective roadmap that can guide you throughout navigating the financial markets. This theory applies to all markets. Doesn't matter if you're looking at index futures, it doesn't matter if you're looking at forex, it doesn't matter if you're looking at commodities, it doesn't matter if you're looking at crypto. These time cycles apply in all markets. Does that mean they are clean across all markets? No. However, that means that you need to pick which markets you are interested in. There's a reason why I purely focus on the indices, on the index futures, because right now at the time of this recording, early 2025, they are the cleanest. However, in the future, this might change, and then I might have to adopt what market I'm looking at. When we pay attention to time cycles, each time cycle has its own respective function, meaning it either accumulates, or it manipulates, or it distributes. As the text right here suggests, your focus should be on recognizing manipulation to anticipate distribution. Meaning, these time cycles do not only have a function, but that function is not fixed. Meaning, the time cycles themselves are fixed, however, the function of the time cycle changes. Meaning, they shift. So that means sometimes you are going to see accumulation take place perfectly throughout the first time cycle, manipulation throughout the second, and distribution throughout the third. However, there will be instances in which the accumulation is going to last throughout, for example, the first and second time cycle, then the third cycle will manipulate, and then the fourth cycle is going to distribute. So what is very important to note is that your focus has to be on recognizing the manipulation, because once you're able to recognize the manipulation, you can anticipate the distribution to unfold afterwards. There are two ways to gauge order flow using time cycles. First of all, you can pay attention to the purge and revert. The purge and revert is basically when within a bullish market, we see the market open a new time cycle, drop lower, taking out that previous cycle low, which we have determined by looking back, of course. That sells liquidity gets taken out right here, and we then see the market form a low, and it begins reversing to draw towards the opposing side of liquidity, towards the previous cycle high. Why? Because above that previous cycle high, a lot of buy side liquidity has been engineered. Within a bearish scenario, what you will see is the following. What you will see is that the market opens high, takes out the previous cycle high, takes out the buy side liquidity which was resting above this high, and we then see a reversal taking place, and the market begins to draw towards the opposing side of liquidity, which is resting below the previous cycle low. This right here is what I absolutely love to see. I like purchase and reverts, and the reason why is because it's inside of this drop lower if bullish, that a lot of retail mind traders are going to turn overly bearish, and I'm buying against that. If I'm bearish for the session or day or week, of course, I'm looking for an open high, because it's in this process that a lot of retail-minded traders are going to turn overly bullish throughout this final run higher, and that is what we're looking to short against. Because what we're looking for is looking for manipulation to anticipate distribution. Think back to the previous schematic. Another possibility is that when a time cycle with respective high or low gets taken out, that we see continuation taking place. Meaning, when a new time cycle opens up and we're bullish, we're expecting that the market is going to be repriced above the previous cycle high, and then we anticipate that that previous cycle high will function as support and price. If we would be bearish, it would look the opposing, where we would be looking for lower prices and we would be looking for the market to drop below the previous cycle low. And from that moment in time, we anticipate that the previous cycle low is going to function as resistance on price so that the order flow can continue to be bearish. Now, one thing which I want you to look at when you go into your charts is the following. I want you to look for a very specific algorithmic signature by icttrading. The algorithmic signature which I want you to look for is the following. I want you to look for an imbalance to displace through that previous cycle high or through that previous cycle low. Because it's in that imbalance that you're going to see true support turn resistance or true resistance turn support. That's a key insight. Now I understand that so far you're probably like, all right, this is all fun and games. You explained the theory behind time cycles. You explained how to look at them, how to gauge the order flow. However, you haven't explained yet what the exact timings are. And some of you are now probably like, how do you know this? You're reading my mind. Don't worry, I will get to that in a bit. Here we can see the yearly delivery. And we are constantly going to refer back to the same schematics which I have provided already. Meaning, if we pay attention to the yearly delivery, you can see that January determines how February will deliver. February determines how March will deliver. And throughout each new month, so throughout February, we refer to the high and low of January. Throughout March, we refer to the high and low of February. Now, I didn't want to put the full 12 months in within this schematic, but this logic applies to literally the full 12 months of the year. And therefore, you could also, for example, say, all right, let's put in April, May, June, for example, as an example within these schematics. So be flexible when it comes to the time cycles which you're looking at. But to basically make it more easy for me to explain this concept to you, I've just focused on January to March. When we pay attention to a chart example, you can see that I have, however, outlined different months. And the reason why is because I want to show to you that this theory applies across all months of the year. What you can see right here is that I've highlighted the months of July until November. And what you can see is that throughout the month of July, we saw the market rip lower. It was dropping aggressively towards the downside. We saw a very quick expansion towards the downside. The fact that the month of July was so bearish right here sets the stage for the following. It sets the stage for a high resistance grid run towards the upside. Why? Because whenever there's a quick run on the left side of the curve, you can anticipate that what will happen is that icttrading is going to go through that from a whipsaw perspective, where it's going to go back and forth, back and forth, back and forth, aka a high resistance liquidity run. So what you see is that August opens low, takes out the July low, and then begins to reverse and retrace into the July range. Notice that we see the market open up for the month of September. What happens? Open low, and we see the market run higher. October consolidates, and then November expands higher, drawing towards the July high. Now, the reason why this is a perfect example of these monthly cycles having influence on each other is because based upon how July delivered, you can anticipate how the following months are going to deliver. Meaning you can anticipate that since the higher time frame institutional order flow was still bullish, that first of all, this run lower was manipulation, and therefore you can anticipate continuation higher to unfold later. However, next to that, what you can anticipate is that due to the quickness of this expansion lower, that the months that will follow are going to be high resistance liquidity run months. And therefore you can see that there's a lot of back and forth going to reprice above this range, which got established within just a month. And therefore you can see that there was a lot of time required in order for the market to reprice above this range, which got established in just 1 month. When we pay attention to the monthly delivery then, what you can see is that the monthly delivery begins from week 1 and ends by week 4. What you can see is that week 1 determines how week 2 will deliver. Throughout week 2, we refer to the high and low of week 1. Week 2 will determine how week 3 will deliver, meaning throughout week 3, we pay attention to the high and low of week 2. Throughout week 3, we anticipate that we can know how week 4 is going to deliver. Throughout week 4, we pay attention to the high-end low of week 3. Now, when we pay attention to the monthly delivery in general, and we pay attention to what news events are given each new month, it is important to note that throughout the first week of each new month, we have the NFP release. And I've discussed this as well within the Predicting Price series. So if you have not watched that series yet, I highly suggest you to watch that. But when it comes to NFP and its importance on the monthly profile is the following. Because NFP is present throughout the first week of each new month, you must understand that this right here sets the stage for the full sequence for the month to come. Meaning week 1 determines how week 2 will deliver. Week 2 determines how week 3 will deliver, etc. And therefore paying attention to how this first week delivers is very important for understanding the full sequence within time. When we pay attention to an example of this, what you can see is that throughout the weeks which I have plotted right here, you can see that the first 2 weeks expanded towards the upside. Notice that the market was in a rush to reprice higher. Week 3 then came, and what we saw take place was that the week opened high, taking out the previous week's high, and we then saw this reversal taking place. Notice how quick and sudden this repricing lower was. Notice that the market forms a new monthly low, and we take out the sell side liquidity of the first week. Now it's in this drop lower right here that you must understand that what's likely going to happen next when a rejection takes place is that we're likely going to see the market retrace back into the range which got established throughout this large expansion lower. So what do you see week 4 do? Week 4 opens low and immediately reprices higher, trading into the range of week 3 right here. And this is how you can see that throughout the first 2 weeks, the idea was established of higher. Week 3 comes, opens high, and begins to roll over, drawing towards sell side liquidity engineered throughout week 1 and week 2. So pay attention to who has been making money, who is now being trapped into believing a certain idea, when is manipulation taking place. Because once you recognize this run higher to be manipulation, you can anticipate the distribution to unfold afterwards. When we pay attention to the weekly delivery within a regular week that begins on Monday, the only reason why I say that a regular week begins on Monday is because when we have a bank holiday on Monday, I would argue that Tuesday is actually the first day to monitor of the week. But in general terms, within a regular week, Monday sets the stage for Tuesday, and on Tuesday we refer to the high-end low of Monday. Tuesday then sets the stage for Wednesday, and throughout Wednesday we refer to the high-end low of Tuesday. Wednesday sets the stage for Thursday, and throughout Thursday we refer to the high-end low of Wednesday, and Thursday sets the stage for Friday, and throughout Friday we refer to the high-end low of Thursday. So what you can see is that each new day we pay attention to, okay, how did the previous day deliver? Or how did the previous days deliver? What is the story which is currently being told? Where's the liquidity resting? Because once you're able to frame the proper narrative and you're able to define where the liquidity is resting, what you will be looking for is you will be looking for manipulation into the opposing direction of your anticipated strong liquidity, and then you can anticipate that distribution will take place afterwards. When we pay attention to a chart example of this then, what you can see is that inside of this week, we open up right here and we drop lower for the week. And when I refer to the opening of the week, I refer to the Sunday open. Monday opens up at 12 a.m. It's the midnight open, guys, New York time. We begin to see the market expand towards the upside. This high forms, and we then see Tuesday open up. Tuesday opens low, and we see the market expand towards the upside. Notice that we see the market consolidate and relatively equal highs get created. A retracement takes place and Wednesday opens up. Wednesday opens low, back into Tuesday's open, and we see the market begin to expand towards the upside. Eventually Thursday opens, and Thursday again opens low, but there isn't really an expansion which takes place afterwards. It's just a consolidation. It's a very slow grind towards the upside which you can see. However, what has taken place so far since the weekly open? We initially opened up, dropped lower, and then Monday till Thursday, we saw the market grind towards the upside, meaning it was being repriced higher. This right here sets the stage for the following. When Friday opens up and it runs higher, taking out the buy side liquidity resting above the previous day high, the Thursday high, and it rejects that high, we can anticipate that a concept which I will teach you later as a delivery profile called Thank God It's Friday is taking place, where the market is drawn towards sell side liquidity, which has been engineered throughout the run higher for the week. Meaning Monday to Thursday, we saw the market run higher. Friday draws towards this engineered sell side liquidity. Engineered sell side liquidity is resting below these lows of Thursday, for example, and below this low right here, because there was still this imbalance which had to be traded into. What does Friday refer to? It refers back to the Wednesday open, as you can see. Now, when it comes to the overall narrative behind the concept of Thank God It's Friday, I want you to understand that it is all about recognizing who has been making money all throughout this week. Are the signs present of a higher time frame reversal taking place, of a weekly high forming? If so, we can anticipate the market is now going to turn around and draw towards sell side liquidity next. Do you see how Monday sets the stage for Tuesday, Tuesday sets the stage for Wednesday, Wednesday set the stage for Thursday, and the fact that Thursday consolidated right here set the stage for open high on Friday? Pay attention to how the previous day delivered to anticipate how the current day will deliver. When we pay attention to the daily delivery then, what you can see is that the daily delivery begins with the Asia session right here and ends with the afternoon session. All the timings which I have provided right here are in New York time. On TradingView, you can change on the bottom right of your charts your time to New York time. And that is something which I suggest you to do to be aligned with what I'm teaching to you. What you can see is that the Asia session begins at 6 p.m. and ends at 2:30 a.m. The London session begins at 2:30 a.m. and ends at 7 a.m. The New York morning session begins at 7 a.m. and ends at 11:30 a.m. And the afternoon session begins at 11:30 a.m. and ends at 4 p.m. Now, again, as has been the whole foundation of this lecture, Asia sets the stage for London. Throughout London, we refer to the high and low of Asia. London sets the stage for the New York morning session. Throughout the New York morning session, we refer to the high and low of London. And the New York morning session sets the stage for the afternoon session. Throughout the afternoon session, we pay attention to the high and low of the New York morning session. Now, one thing which is important to note is that even though I have just been mentioning the previous time cycle with respective highs and lows, we also pay attention to the highs and lows of even further time cycles in the past. So throughout the afternoon session, you can be referring to the London high and low, for example. Or throughout the New York morning session, you can be referring to the Asia high and low, for example. Don't forget about those levels. And that is why I suggest you to use the time cycles indicator, which I've provided on the mentorship platform, which helps you significantly with determining where the time-based liquidity pools are. Now, when it comes to the delivery, which you can see in front of you, you can see that when we open up a new week and the market began expanding towards the upside, you can see that the Asia session expanded higher. The London session then came along and we saw the market again expand towards the upside. It was a very slow expansion higher, however it was an expansion higher. The New York morning session then also expanded higher, meaning you can see that AMA right here until AMD is the New York morning session, and the same of course for London A and the London D. We'll get into what the AMD exactly means within these boxes in a bit, but what you can see is that the market again expands towards the upside throughout the New York morning session. So what you see is that both Asia as London expanded higher, but now we also see that the New York morning session also expanded higher. So what you begin to see is that the three sessions of the day up until that point all expanded higher. And that sets the stage for a New York afternoon session, which is going to be very messy. Why? Because large ranges turned into small ranges. And therefore, whenever you recognize that the market has been expanding higher, you can anticipate that at one point in time, this is going to basically lead to a consolidation, lead to a tight range. When we pay attention to the London session, it's 90-minute cycles then. What you can see is that the London session begins at 2:30 a.m. and the first 90-minute cycle is between 2:30 a.m. to 4 a.m. This is the accumulation cycle. The second cycle of the golden session is from 4 a.m. to 5:30 a.m. and the third cycle is from 5:30 to 7 a.m. I refer to the first cycle as the golden 1, the second cycle as the golden 2, and the third cycle as the golden 3. This is just a terminology thing, guys. And this is how I like to explain to you what I'm seeing within the markets, because you need to understand that what I'm trying to show to you is that there's an objective method of looking at the markets. Notice that I haven't even discussed a break or a fair value gap or whatever entry pattern you might be using or whatever indicator you might have been using, a VWAP or any other like retail concept out there. You need to understand that at the end of the day, there's a framework in play which leads to all those things working. And that framework is what I'm showcasing to you now. This is time. Throughout the previous lecture, I've introduced you to price as well. And that is what we're going to expand upon. These lectures that I'm sharing with you now as the beginning of this 2025 model series are just to introduce you to how I'm going to teach you to look at the markets throughout the remaining part of this series. Now, when we pay attention to the London 90-minute cycles then, what you must understand is that this first 90-minute cycle, London 1, sets the stage for London 2. London 2 then sets the stage for London 3. And throughout each new cycle, we refer to the high and low of the previous cycle and we monitor the reactions to these levels. However, monitoring the reactions themselves is not enough because we must recognize manipulation before the reaction by itself actually means anything. So that means we must first of all define what are we looking for. Are we looking for a higher London session or a lower London session? Let's say that we are going to look at a London session in which we're anticipating higher prices. What we're going to look for is we're going to look for a purge of a previous London low. So that means, for example, throughout the second 90-minute cycle, we can look for a purge of the first 90-minute cycle with respective low, followed by a revert towards the high. Please note that the revert towards the high doesn't need to complete within this second 90-minute cycle, because the revert towards the high can also complete throughout the third 90-minute cycle. Within a bearish example, it would be of course the opposing, where we would look for a purge of the 2:30 to 4 a.m., the London 1 high, followed by a revert towards the low. When we pay attention to an example right here, what you can see is that I've plotted the 2:30 to 4 a.m. buys liquidity pool, the high, and next to that you can see that I've annotated the 2:30 to 4 a.m. sales liquidity pool, this row. What you can see is that when we open up at 4 a.m. for the second London cycle, the 90-minute cycle, what you can see is that we open low and immediately take out the previous 90-minute cycle low. Notice, however, that this did not set up an immediate reversal towards the opposing side of liquidity, towards the high of the previous cycle. Instead, we saw the market run higher, engineer buy side liquidity, and then within this second 90-minute cycle, you can see that there are also 3 boxes which are plotted. These 3 boxes represent 30-minute cycles. Notice that the second 30-minute cycle within this second 90-minute cycle opened and dropped lower, taking out the previous 30-minute cycle low, which already took out the previous 90-minute cycle low. We see a smart money reversal taking place, and then we see the market begin to draw towards the buy side liquidity pool of the previous 90-minute cycle high, this buy side liquidity pool. Notice that the third 90-minute cycle delivers this objective, and we then see the market eventually form the high to draw lower. Now, I understand that if you're completely new, I just went through that way too quick, and your mind is probably spinning now. You're probably like, what did you just discuss? I understand. I promise to you now that if you come back to this lecture in a few months from now, whilst you investigate deeply what I'm outlining to you, you are going to smile by what I just outlined. And you're going to be smiling about the fact this has been hidden underneath your nose in plain sight for all this time. It's time that moves price. Meaning, recognize what the function of the current time cycle is so that you can anticipate what the next movement in price is going to be. Anticipate distribution by recognizing manipulation. That should be like your top note from this lecture so far. When we pay attention to the morning session, its respective 90-minute cycles then, What you can see is that the morning session begins at 7 a.m. and ends at 11:30 a.m. Notice that within this window of time, we can find 3 90-minute cycles. Now, I already know that there are going to be questions about how did you come up with these 90-minute cycles? How did you figure it out? How did you know what these cycles were? My mentor, the inner circle trader, has been using these 90-minute cycles for a very long time. And the way I realized that is by the following. My mentor, icttrading, he was hiding in plain sight that there were specific elements in time that could provide you with a very objective manner of looking at the markets. Because icttrading is coded to refer to time cycles, but also price cycles. What he mentioned multiple times was that at 8:30 a.m. a new 90-minute cycle begins. So that right there was already the first element of time that provided us with the opportunity to say, okay, well, if at 8:30 a.m. a new 90-minute cycle begins, that means that between 8:30 to 10, there's a 90-minute window of time. Next time cycle is going to be 10 to 11:30. Next cycle is going to be 11:30 to 1, etc. When icttrading then came out and mentioned his final silver bullet time, 7 to 8:30 a.m., the full circle was completed. And the reason why was because it's very random, so to say, right? That he has been hinting at 8:30 a.m. as a crucial opening time all this time. And then all of a sudden, his final silver bullet time comes out and it's the 7 to 8:30 a.m. 90-minute cycle. When you then pair this understanding with the understanding of AMD, accumulation, manipulation, and distribution, you begin to understand the true logic behind these time cycles. And when you investigate them, you are going to smile. So what you can see is that 7 to 8:30 a.m. is your first 90-minute cycle. This is what I refer to as AM1. AM1 sets the stage for AM2, the second 90-minute cycle between 8:30 to 10 a.m. Throughout AM2, we refer to the high and low of AM1. AM2 is going to set the stage for AM3, meaning throughout AM3, we can anticipate the delivery which will take place based upon how the previous 90-minute cycle delivered. Throughout AM3, we refer to the high and low of AM2. AM3 lasts from 10 a.m. until 11:30 a.m. When we pay attention to a chart example then, what you can see is that I've annotated the 7 to 8:30 high right here in this box. And next to that, you can see that I've annotated the 7 to 8:30 low. Please note that I've plotted the high and low based upon the boxes. When we pay attention to a chart example then, what you can see is that I've plotted the high and low of the 7 to 8:30 a.m. cycle. This is done automatically by an indicator which I've created, which you can find on the Mentorship platform. Notice that the market consolidated throughout AM1. This consolidation sets the stage for how AM2 is going to deliver. Meaning what we will be looking for is we will be looking for the market to run higher, taking out the bias liquidity of the previous 90-minute cycle high, the AM1 high. Why? Because we're looking for lower prices, meaning we're anticipating open high for this 90-minute cycle. Notice that the market runs higher throughout 8:30 to 9, the first 30-minute cycle within this second 90-minute cycle of the morning session. We then see a new 30-minute cycle open up, open high at 9 a.m. and the market begins to drop towards the downside. Now what you can see is that I've annotated the full delivery which took place above the previous cycle high in gray. And the reason why is because this right here is where manipulation is taking place. And this right here is where you can see that the market is just basically spending some time before it's allowed to roll over. We see the market drop lower between 9 to 9:30. 9:30 opens up, and we initially see the market run higher, trading back above the previous cycle high, but notice that the bodies stay below it. We see the market then expand towards the downside in a very violent way, and when such a quick expansion lower takes place throughout the second 90-minute cycle, the third 90-minute cycle is either going to distribute towards the final objectives or it's going to chop around. When we pay attention to 30-minute cycles then within the morning session, I just wanted to discuss this because I've already mentioned 30-minute cycles prior throughout this lecture, but I just want to make sure that you had a visual idea of them as well. Please note that these 30-minute cycles are present within each 90-minute cycle of the morning session, but also of the London session, but also of the New York afternoon session. Now, before we dive into them, I just want to mention to you that you might be wondering, Zeus, why don't you discuss Asia? Look, if you want to trade Asia, yes, you can look for the same time elements to play out. However, the only issue that's present throughout Asia is that Asia sets the stage for the full daily delivery which is going to come. And therefore, what you often see throughout Asia is that the delivery is not very clean in that sense. Meaning you can see that it's just very tight ranges usually. You see the market just go back and forth, back and forth. The moments that I'm interested in are the moments which I'm mentioning to you now. That doesn't mean I trade London to New York afternoon session every single day. I determine what session I'm interested in the day in advance, or maybe even the week in advance when I look at the economic calendar. However, in general, these are the sessions which I want you to focus on, because this is where you're going to see the cleanest algorithmic price action. Why? Because this is when the amount of liquidity within the marketplaces is the highest for the markets which we have interested in. Now, when we pay attention to the morning session then, through the lens of 30-minute cycles, what you can see is that we are looking at the final 90-minute cycle of the morning session, meaning the 90-minute cycle from 10 to 11:30 a.m. Notice that within this 90-minute cycle, we have three 30-minute cycles, meaning 10 to 10:30, 10:30 to 11, and 11 to 11:30. Now, the same concept applies as prior, where you can see that 10 to 10:30 sets the stage for 10:30 to 11, and 10:30 to 11 sets the stage for 11 to 11:30. Now, throughout each new 30-minute cycle, we refer to the high and low of the previous 30-minute cycle in order to gauge the order flow. When we pay attention to a chart example then, what you can see is that this overall green box represents the 90-minute cycle from 10 to 11:30 a.m. Notice that throughout the first 30-minute cycle within this 90-minute cycle, we saw the market drop lower. Notice that I've annotated the high and low of 10 to 10:30. And notice that when 10:30, the second 30-minute cycle opened up, we opened low, taking out the previous 30-minute cycle low, followed by a reversal towards the previous 30-minute cycle high. When does this complete? This completes throughout the third 30-minute cycle, right here. A, M, D. Beautiful, right? Let's pay attention to the afternoon session 90-minute cycles. The afternoon session, its respective 90-minute cycles begin at 11:30 a.m. and end at 4 p.m. What's very important to note is that the 11:30 a.m. to 1 p.m. 90-minute cycle is called the launch cycle. Generally speaking, we do not look to trade this 90-minute cycle. There are days in which the launch cycle will deliver a very volatile moment, and that is whenever there's a trending day and the market is in a rush to get somewhere. That is when you can anticipate that they're going to work through lunch, so to say. However, on your average day-to-day day, you're likely going to see the market just engineer liquidity between 11:30 a.m. to 1 p.m. What this launch cycle does is that it sets the stage for the delivery which will take place between 1 to 2:30 p.m. So throughout PM2, which is the name of this second 90-minute cycle of the afternoon session, you will refer to the high and low of the launch cycle. PM2 sets the stage for PM3, PM3 being from 2:30 p.m. to 4 p.m. Throughout this 90-minute cycle, you refer to the high and low of the previous 90-minute cycle to gauge the order flow. Again, each time cycle sets the stage for the next time cycle, and throughout the next 90-minute cycle, you refer to the high and low of the previous 90-minute cycle in order to gauge the order flow. Let us take a look at a chart example. Here you can see the chart that we also discussed on the 30-minute cycle example. However, now it's a bit later. What you can see is that between 11:30 a.m. to 1 p.m., the market consolidated. Notice that I've highlighted the high and low of this first 90-minute cycle of the afternoon session. At 1 p.m., a new 90-minute cycle opens up and we see the market drop towards the downside in a very quick manner. Eventually, after 2 p.m. right here, you see another very quick sudden drop lower taking place. The market forms a low and we then see the market begin to displace towards the upside. 2:30 p.m. opens, open low, drops into this imbalance. Oh, I discussed a price element there, my bad. And we see the market begin to reprice towards the upside. Notice that there's a lot of consolidation which is taking place right here until the end of day macro, which we're going to discuss later as well throughout specific time lectures. But right here, what you can see is perfect accumulation, manipulation, distribution. And within those distribution cycles, you can see that there's even more distribution which takes place between 3:30 to 4 p.m. Now, with that being said, this actually comes to an end. I hope that you found this insightful. I hope that you were able to gain a lot of insights on time cycles from it. If you did, be sure to go into your charts and investigate. And I really suggest you to claim this time cycles indicator, because this time cycles indicator helps you out a lot with recognizing what the current 90-minute cycle is doing and what to anticipate from the next. All in all, I believe that time cycles can get understood if you just put in the required time, because it's simply a game of repetition, repetition, repetition. Why? Because you will come to realize that every single day there's a specific playbook which icttrading is following. Over time, your ability to recognize what the playbook for the day will level up, because what will happen is that you're going to refer to past experiences in which you recognize the exact same delivery profile being in play. Understand time cycles, and once you understand time cycles, pay attention to delivery profiles. Delivery profiles are again also going to be discussed in great detail within this 2025 model series. Good luck with your studies. Look forward to catching up with you in the next episode. Hello there. I hope that you are doing well. Welcome to this new lecture of the 2025 model series. This lecture is going to be on DPD arrays. Now, before we dive into this lecture, I first want to share with you the following. I understand that many of you have probably already researched the majority of these PD arrays in great detail, meaning you have probably gone into your charts and you've probably investigated breakers and value gaps and such. However, during this lecture, I want to share with you a different perspective on PD arrays in general. And therefore, I ask you to go into this lecture with an open mind. Meaning, please understand that the PD arrays, as they were taught by icttrading, are a representation of a certain logic. Because simply looking for these price patterns themselves within the markets is not enough. They can only be looked for within a particular framework. And that is why I'm discussing them now in the beginning of this 2025 model series. Here you can see the matrix of PD arrays. This matrix was originally created by icttrading, the inner circle trader, and therefore full credit goes out to him for creating these PD arrays. Before we dive into this schematic right here, I first want you to understand the definition behind PD arrays. PD arrays are algorithmic signatures within the delivery of price. Meaning, throughout the delivery of price within buy or sell programs, what will happen is that icttrading will leave behind footsteps. Our job is to recognize what these footsteps are to anticipate what the next delivery function is likely going to be. When we pay attention to this matrix of the PD arrays, what you can see is that within this larger box, which represents a range, what you can see is that there is a premium side and a discount side. What this basically means is that above 50%, you can see that there's a red box which represents the premium side, and below 50%, there's a discount which represents the discount side. What you can see is that when we pay attention to the premium side first, that it begins with an old high or low. Then we see the rejection block form, then we see the bearish order block form, then we see the fair value gap form, then we see a liquidity void form. We'll get to the liquidity void in a bit, because in my opinion, you do not need to pay attention to it. Next to that, you can see a bearish breaker form. And next to that, you can see a bearish mitigation block form. If we pay attention to the discount side then, what you can see is that it begins on the lower end right here with an old lower high. A rejection block forms then a bullish order block, then a fair value gap, then a liquidity void. Again, this can be ignored, but we'll get to that in a bit. Then a bullish breaker forms, and then a bullish mitigation block forms. Now, when you pay attention to the way that I'm describing this matrix of the PD arrays, what you can understand is that I'm explaining a specific sequence to you. Meaning, whenever a buy or sell program is in, what you will see take place is that these PD arrays will form within that sequence. Meaning, first the rejection block will form, then the order block, then the fair value gap, then the breaker or mitigation block. When you start investigating this by itself, you're already going to look at PD arrays from a completely different perspective, because all of a sudden you begin to look at them from a sequence perspective. Meaning the sequence has to be in play in order to anticipate what the next delivery function is likely going to be. When a lot of people got introduced to any PD array, such as for example a fair value gap, what they initially think is that they should just go out there and trade every single fair value gap that appears. However, the fair value gap itself is simply a price pattern. The logic which I'm explaining to you now is not based around any price patterns, meaning it's based around understanding A to B, buy or sell program. Are we bullish or bearish? Because once that is defined, you can utilize any of these PD arrays to get into a potential trade. Now, when we pay attention to the liquidity void then, what you can see is that I mentioned already prior that you can kind of ignore this. And the reason why is because the liquidity void is basically multiple imbalances forming after each other. Or in other words, multiple fair value gaps forming after each other in a row, and the range of the liquidity void is those multiple imbalances. So for this lecture, we're just going to focus on the fair value gap. Now, what I will do with you is I will walk you through all of these specific PD arrays. I'm going to explain the logic behind them. I will first discuss all the premium arrays with you, and then we're going to take a look at the discount arrays. The sequence of the premium arrays begins with the formation of a bearish rejection block. A bearish rejection block forms when price forms a swing high with a long wick and trades into the wick before rejecting it and drawing lower. The range of the rejection block is the difference between the open or close of the final candle of the swing high formation to the high. Meaning inside of this example, what you can see is that price expanded higher, and we saw the market eventually form this long wick, and the range of the rejection block is the price range between this candle's close to the high of this candle. Now, please keep in mind that because this is an up-close candle, we pay attention to the close to the high, its respective range. The range is the bearish rejection block. If this candle would be a down-close candle and we would see open high, then the rejection block would be the difference between the opening price and the price of this candle's high. This is our bearish rejection block. When we pay attention to a chart example, what you can see is that the market formed this high right here, and we then saw the market deliver towards the downside. Eventually the market expanded towards the upside, and what you can see is that we took out that old high. Pay attention to what is resting above this high. Above this high, buy side liquidity is resting. So what you must understand is that buy side liquidity is being taken out, and we begin to see the signs of a swing high formation taking place right here. Do you see how this down-close candle right here has a very long wick between the open of this down-close candle and the high of this candle? The range between these two reference points is your bearish rejection block. And what you can now monitor moving forward is whether or not this rejection block is going to function as resistance on price. Now, for many of you, you might be wondering, okay, how do I know that the high is in? How do I know that the smart money reversal is in? How do I know that it's now going to turn around and draw towards sell side liquidity? When it comes to your entry patterns, you must understand that the majority of you are going to enter way later within the PD array matrix. Meaning your focus should be on fair value gaps or breakers and mitigation block entries. There are methods for entering at the absolute high or low when it comes to any reversal which is taking place. However, when it comes to the highest probability trading setups and the most easy ones to spot, you must focus on fair value gaps and breakers or mitigation blocks. And that is what I would teach you within this model series. And don't worry, some of you are so motivated to get to that level of understanding where I can see these swing highs or swing lows formations before they form, and you want to enter at the absolute highs and absolute lows. So I will give some insights on how to anticipate those swing highs and swing lows formations as well throughout this series, but you must first understand the foundation. What you can monitor is that when this bearish rejection block forms, pay attention to what I outlined, that we took out buy-side liquidity. That's a crucial element, by the way. When this rejection block forms, what you're monitoring is whether or not we're going to reject it and whether or not you're going to see imbalances on the left side of the curve get displayed through, because that shows to you that order flow is changing from bullish to bearish. When we pay attention to the bearish order block then, this takes place when price runs higher into a point of interest, and the opclose candle or sequence of opclose candles that forms is your bearish order block. Meaning, the moment price crosses the open of the sequence of opclose candles, or just the open of that first candle, the change in the state of delivery CSD is taking place. To play it safe, wait for the low of that sequence of opclose candles to be traded below. The reason why is because when you see the market displays below the low, which set up the repricing into the point of interest, from that moment in time, you can say with confidence, all right, we have likely formed a high and we're now going to turn around. The range of the bearish order block is from range low to range high, meaning from the lowest price level to the highest price level of that one opclose candle or sequence of opclose candles which repriced into your point of interest. When we pay attention to this example, what you can see is that there are 3 opclose candles which repriced into the point of interest. When the market reaches the point of interest, the reaction to that point of interest will be very telling moving forward. When the market rejects that point of interest and it displaces below the low of this first opclose candle, which set up that final run higher into your point of interest, and you see the signs present which confirm to you, all right, we're in fact turning around, for example, the creation of a rejection block as well, what you would then monitor is whether or not this sequence of opclose candles is going to function as resistance on price. Why? Because what's happening throughout this final run higher into your point of interest is the following. What's taking place is that manipulation is taking place. Buyers are stepping into the marketplace while smart money is being provided the opportunity to go short against those buyers. At the same time, buy-side liquidity is being taken out. Why? Because the market is expanding above old highs which are resting in the past. Therefore, what you're seeing taking place is that those buyers are being trapped into the marketplace while smart money is being provided the opportunity to fill their short orders. And this perspective is crucial to understand because it shows to you how we can look at manipulation. Because once we can recognize the manipulation, we can anticipate the distribution which will follow afterwards, as I taught within the previous lectures. When we pay attention to a chart example then, what you can see is that the market expanded towards the upside right here on the left side of the curve. Notice that the market was continuously expanding higher until it began to slow down. Notice that this high formed right here and the market then retraced. We saw this low form and the market had one more push higher. Notice the size of this opclose candle right here. This opclose candle took out buy-side liquidity resting above this high. The next candle opens high and then displaces towards the downside. Meaning, notice that we see the market trade below the low of this opclose candle right here, which is also the open. Notice that we see a CB form right here, which we'll get to in a bit. And we see the market retrace into this opclose candle. Now, when it comes to this opclose candle, what you must understand is that this opclose candle is a bearish order block. Why? Because we saw the market take out this buy-side liquidity right here. It reached a point of interest and we saw the market begin to displace towards the downside. From this moment in time, what you're monitoring is the reaction to this opclose candle. If the market is going to reject this opclose candle and is going to find resistance inside of that, that shows to you that order flow has changed from bullish to bearish. Meaning, the moment that the market traded below this opclose candle, a change in the state of delivery already took place. And therefore, what you can monitor is the following. You can monitor the price range of that opclose candle and specifically the reaction to 50% of this upclose candle. 50% of this upclose candle is what we refer to as mean threshold. If the market is in fact very bearish moving forward, what you will be monitoring is the reaction to 50% of the price range. As long as the market does not close above 50% of this price range, you're anticipating that we're in fact going to see the market reprice towards the downside heavily. And that is why 50% of this range of this upclose candle has to be monitored. Now let's say that instead of this just being one upclose candle, we would have seen multiple upclose candles. Then you could monitor the reaction to the full price range from low to high of that sequence of upclose candles. Because that sequence of upclose candles is your bearish order block. When we pay attention to the next premium rate then, what you can see is that we're going to be looking at the fair value gap. A fair value gap takes place when price expands into a one-sided direction in a quick manner without retracing to offer efficient delivery. This means price will seek to offer efficient delivery at a later moment in time. Why? Because ictt's main function is to deliver price in an efficient manner on a time-based schedule. The fair value gap is the range between the first candle's low and the third candle's high. Meaning when we pay attention to this price pattern, what you can see is the following. What you can see is that there's a difference between the first candle's low right here and the third candle's high. Meaning there's a gap right here. There's a lack of buy-side delivery inside of the price range of this middle candle. Meaning if this third candle would have repriced all the way to the low of the first candle, then this price range would have been balanced out. But because that didn't occur, buy side has to be delivered at a later moment in time to reprice back into that range to deliver efficiently inside the price range. And I know I said it a lot, and some of you are probably like, okay, it's just a price pattern of a fair value gap. No, the logic goes way deeper than that. But for the majority of you, just looking for this fair value gap is more than enough. The fair value gap is the difference between the first candle's low and the third candle's high. When you start paying attention to where fair value gaps are forming, you are going to experience major light bulb moments. When we pay attention to a chart example then, what you can see is that inside of this example, the market was consolidating and eventually it slammed towards the downside with this big downcross candle. Notice that the candle afterwards did not reprice into the low of the first candle. Therefore, there's a gap between the first candle's low and the third candle's high. This is what we refer to as a bearish fair value gap. What will have to take place is the following. What will have to take place is that the market will seek to retrace back into that price range before the market is allowed to expand towards the downside. When we pay attention to the bearish breaker then, the bearish breaker forms when a bullish order block sets up a run above buy-side liquidity, followed by displacement lower, causing the bullish order block to become an inverse bullish order block. Price will seek to retrace into the price range of the bearish breaker before expanding lower. What this basically means is the following. When the market expanded towards the upside and it retraced, and we then saw this low form, the market expanded higher once more. Meaning this low set up the final expansion higher into a higher time frame point of interest, followed by a reversal which originated from that point of interest. When it comes to the delivery which takes place throughout this retracement lower, followed by the expansion higher, this is a fractal market maker buy model. And inside of this fractal of sell side and buy side delivery, you will see a down close candle form which set up the final run higher. This down close candle got utilized by smart money to buy off to target buy side liquidity resting above this high. The moment that the market displaces below this down close candle, so below this low right here, the final down close candle which formed right here is your bearish breaker. And that down close candle has to function as resistance on price in order for the order flow to remain bearish. Now, by what should this down close candle get displaced through? Ideally, we would like to see a bearish fair value gap form in this area as well. When we pay attention to a chart example then, what you can see is that the market formed this high right here, then dropped towards the downside, we saw this low form, and we then saw the market expand towards the upside, taking out the buy side liquidity resting above this high. Notice that the market then repriced below that downclose candle its low with this candle right here. Notice that we just wicked below it and we then offered buy side back into that range to close it. Notice that the market then expanded away without having to retrace. Why? Because what's taking place right here is the following. We see sell side delivery through the low, and we then see buy side delivery back into the price range of the downclose candle, and we then see the market leave this price range, and therefore it doesn't have to return. This means that this is now a lower time frame balanced price range, and therefore the market is now in a rush to expand towards the downside. More unbalanced price ranges will come later, because balanced price ranges are the reason why all PD arrays work. But in general terms for this lecture, I want you to focus on the price pattern of high, low, higher high, lower low. Pay attention to this full candle, this full downclose candle, to gauge the order flow moving forward. Let's take a look at the bearish mitigation block. A bearish mitigation block forms when a bullish order block sets up a run higher, but does not, pay attention to the word use, does not take out buy side liquidity followed by a displacement lower, causing the bullish order block to become an inverse bullish order block. Price will seek to retrace into the price range of the bearish mitigation block before expanding lower. The price pattern of a bearish mitigation block is very similar to the price pattern of that bearish breaker. The only difference is the following. The only difference is that the bearish mitigation block does not set up a run above the high before the low formation took place. Notice that the market expanded higher, but it formed a lower high relative to this high. Therefore, the moment that price trades below this low, we expect that this final downclose candle is going to function as resistance on price, because it's going to function as a bearish mitigation block. Again, ideally we would like to see a bearish value gap form throughout this displacement leg towards the downside. When we pay attention to our chart example, what you can see is that the market formed this high right here. We then saw the market reprice towards the downside. Notice that this very large downclose candle forms, and we see the market then reprice higher, consolidate for a while, and eventually it slams towards the downside. Notice, however, that before it slammed towards the downside and traded below this downclose candle, we did not see this high getting taken out. Therefore, this downclose candle becomes our bearish mitigation block, and we can anticipate that this bearish mitigation block is likely going to function as resistance on price. Please keep in mind that it's the final downclose candle before the run higher, which is your bearish breaker or bearish mitigation block. When we pay attention to the schematic of the PD array matrix then again, what you can see is that I've added the letters A on the top left and B on the bottom right. What these letters basically showcase to you is the following. What they show to you is what I outlined to you throughout the price cycles lecture, in which I outlined to you that every single price swing has an inception price and a terminus, an end price. Our job is to align ourselves with the delivery which is taking place between point A to point B. But when we pay attention to this PD array matrix, what you can see is that we can recognize when that move from point A to point B is taking place, when we recognize the sequence in which these arrays are forming, because each array is forming after each other. And that right there should be a major light bulb for the majority of you. Where instead of chasing patterns for the sake of chasing patterns, you're now beginning to understand that there's a certain order in which you can look for these patterns. And when all these patterns are forming in the right order, and you're trading within a bigger framework, and you're trading within, for example, a market maker sell model, then you know that you have a high probability short trade opportunity. We're now going to be paying attention to the discount arrays. And as outlined with the premium arrays as well, the discount arrays begin with the rejection block creation. A rejection block gets created when price forms a swing low with a long wick and price trades into the wick before rejecting it and drawing higher. The range of the rejection block is the difference between the open or close to the low. Meaning, inside this example, what you can see is that a swing low forms where you can see that there are 3 candles next to each other. Notice that the candle in the middle took out the low of the previous candle. Notice that the price range between the close of this candle to the wick, to the low, is annotated and highlighted by this white range right here. This wick is our bullish rejection block, and therefore, as long as price does not take out this low, we can anticipate that we're likely going to see the market begin to draw towards the upside soon. When we pay attention to a chart example, what you can see is that the market expanded towards the downside quickly right here on the left side of the curve, and eventually we saw the market stop right here. We engineered sell side and we saw the market retrace. The next candle then opened up, initially went higher slightly and then expanded lower. Notice, however, that the market then closed above the low, which formed right here, and you can see that this very long wick formed. The reaction to this long wick will tell you whether or not order flow is changing. Meaning, what you can see is that this rejection block right here is functioning as support on price. And that tells you that you can now monitor whether or not the next discount arrays are going to get created. Therefore, the rejection block begins a new sequence. When we then pay attention to a bullish order block, we can see that a bullish order block takes place when price runs lower into a point of interest and the down close candle or sequence of down close candles gets traded above. This sequence of down close candles inside of this example is your bullish order block. The moment that price crosses the open of the sequence of down close candles, or that one down close candle, the change in the state of delivery, CSD, is taking place. To play it safe and to confirm your CSD, I suggest waiting for the high of that sequence of down close candles to be traded above. The range of the bullish order block is from high to low, meaning from this high to this low. Pay attention to the fact that the bullish order block forms after the bullish rejection block has formed. When we pay attention to a chart example, what you can see is that the market formed this low right here, and we then saw it run higher. Consolidation took place, and the market then began expanding towards the downside. Notice that this low formed right in advance of the previous low, so we have two sell-side liquidity pools being engineered in close proximity to each other. We see the market retrace, and then we begin to see the market expand towards the downside. And notice how quickly it drops lower. Notice how quickly it reprices below this low. We see the market take out the sell-side liquidity resting below this low, and we eventually see it turn around and trade above the open of this down close candle. Now here comes the tip. Whenever the price range of the full bullish order block is rather large, meaning from this high to this low, what you can pay attention to is the range of purely the bodies, meaning you can ignore the wicks then. Why? Because the wicks do the damage whilst the bodies tell you the story. Therefore, you can see that within this chart example, I've annotated the open of this down close candle as the beginning of the bullish order block. What does that allow me to do? It allows me to have a better entry than where I would enter at the high of this down close candle. That should be a big light bulb moment for many of you. Notice that inside of this down close candle, we also see the market form a bullish fair value gap whilst we reprice through it. Pay attention to what happens to this bullish fair value gap, which we'll get to in a bit. This bullish fair value gap functions as support on price before the market eventually expands towards the upside. So as a general rule of thumb, whenever you see a large bullish order block form, pay attention to mainly the bodies. When the bullish order block isn't that large and it's a rather small order block, you can annotate the full range from low to high. When we pay attention to the fair value gap then, which I've already shown to you prior, the fair value gap forms on the bullish side when price expands into a one-sided direction in a quick manner without retracing to offer efficient delivery. This means that price will seek to offer efficient delivery at a later moment in time. The fair value gap is the range between the first candle's high and the third candle's low. When we pay attention to a chart example, what you can see is that the first candle reprices higher, the second candle then expands towards the upside quickly, and notice that the third candle opens up, initially drops lower, but does not reach the first candle's high. Therefore, there's a lack of sell-side delivery which is now present inside of this range when the market expands higher again throughout that third candles formation. That means that there is a bullish fair value gap which has been created, and the market will seek to retrace into that bullish fair value gap before it's allowed to expand towards the upside. Now, there are scenarios in which these fair value gaps are allowed to stay open, but then we're speaking about breakaway gaps, and they require a lecture by themselves in the future of this model series. Right now, your focus is on recognizing the pattern of the fair value gap. When we pay attention to the following chart example, what you can see is that the market expanded towards the upside quickly, and you can see that there is an imbalance which formed right here between these three candles right here, where I can see that this first candle's high and the third candle's low right here have a difference in between the two, and the reason why is because the candle in the middle expanded towards the upside significantly. Therefore, this range has to be monitored moving forward because this is your bullish fair value gap. When we pay attention to a bullish breaker formation, then you must understand that when a bearish order block sets up a run below sell-side liquidity followed by displacement higher, a bearish order block will be turning into an inverse bearish order block. And the reason why this is happening is because, just like I outlined to you within the bearish examples, within the premium rate creations, we're looking at that final run lower right here to be manipulation. What's happening here is the following. What's happening is that the market is dropping lower, sell-side liquidity gets engineered, a retracement higher takes place, and we then see the market drop lower one more time, taking out sell-side liquidity below this low, reaching a point of interest, and the moment that the market displaces above this high, we anticipate that the final upclose candle which formed throughout this final run lower, yes, or which set up this final run lower, I should much rather say, we anticipate that this upclose candle has to function as support on price, because this upclose candle is your bullish breaker. What will happen is that price will seek to retrace into the price range of the bullish breaker before expanding higher. And this is the entry opportunity which I will show to you throughout this model series, because once you start understanding when and where this setup presents itself, it's going to unlock a completely new perspective on all financial markets. Because this right here is, in my opinion, the most straightforward trading setup which you can look for. There are very clear rules which apply to it. It's not simply this price pattern of a bullish breaker, just like with any other of the previous PD arrays which I've shown throughout this lecture so far. But it's the underlying logic behind when and why they should work. Because once you can understand that, you can come to the conclusion of, all right, it's all about recognizing what's the current program that we're in. Are we currently in a sell or buy program? And once that's clear to you, you must know what's the draw liquidity, where's price reaching towards. Because once you know these variables, what will happen is that the market will seek to create these arrays. And when I say the market, I'm referring to icttrading, the interbank price delivery algorithm for your info. But what will happen is that icttrading will seek to create these algorithmic signatures. They will be shown to you because what's happening is that icttrading is in a rush to reprice towards a specific level. An example of the bullish breaker can be seen here, where the market expanded towards the downside, formed this low, retraced higher, and then had this final expansion leg towards the downside, taking out sell-side liquidity resting below this low. Notice that the market then displaces above this upclose candle, above this high which set up that final run lower, taking out sell-side liquidity, and therefore you anticipate that this upclose candle is likely going to function as support moving forward. Notice that when it comes to this delivery which takes place, you can also see that a bullish fair value gap formed throughout the run above this high. When we then pay attention to the bullish mitigation block, what you can see is that a bullish mitigation block forms when a bearish order block sets up a run lower, but does not take out sell-side liquidity followed by displacement higher, causing the bearish order block to become an inverse bearish order block. Price will seek to retrace into the price range of the bullish mitigation block before expanding higher. What you see inside this schematic is that the market expanded lower, forms this low, retraces, and we then see the market have one more drop lower, but notice that where the bullish breaker took out sell-side liquidity engineered below this low, you can see that the bullish mitigation block does not take out sell-side liquidity resting below this low. And therefore, the moment that we see this displacement leg above this high, it confirms to you that we have in fact formed the low, and now this final upclose candle, which set up this retracement leg, can get utilized as a potential buying opportunity throughout the next retracement leg. This is your bullish mitigation block, and this range can be utilized as a potential entry opportunity. When we pay attention to your chart example, what you can see is that the market expanded towards the downside very quickly. We formed this low, and below this low, sell-side liquidity is engineered. We see the market expand towards the upside, and we begin to see it retrace into the price range which formed throughout this expansion lower. Notice that the market has one more drop lower, and notice, however, that we do not see the market take out this low, meaning we see the market create a higher low. When the market then displaces above this upclose candle with this very strong close, we can anticipate that this upclose candle is likely going to function as support next. And from that moment in time, we can change our idea from bearish to bullish. Notice that this upclose candle does in fact function as support on price right here, before we see the market expand towards the buy side liquidity engineered above this high. When we then pay attention to that PD array matrix one more time, what you can see is that within this schematic, I've now replaced where the A and B are. Notice that A is now on the bottom left and B is on the top right. What you can see is that, just like I outlined with regards to the bearish example of the premium array creations, you can see that there's a sequence to the creation of the discount arrays. Therefore, your job is to investigate whether or not you're able to recognize this sequence. And understand that for many of you, watching this lecture at one go might not be good. And the reason why is because I discussed a lot, and I discussed a lot of different perspectives on concepts which you already got introduced to probably in the past. And therefore, you must investigate whether or not there's any validity behind the statements which I'm making throughout this lecture. Because at the end of the day, your job is to see whether or not the validity is there behind that what I'm explaining to you. And the way you come to that conclusion is by going into your charts and investigating whether or not you're able to see these PD arrays. And when you start blending that with what I've discussed prior with regards to time and price cycles, it will already open up a completely different world for you when it comes to your perspective on the markets. And with that being said, this lecture comes to an end. I hope that this lecture has provided you with more insights on PD arrays, and I look forward to catching up to you in the next lecture of the 2025 model series. Good luck with your studies, and I invite you to go into the charts and test whether or not you're able to see this sequence again and again. Be safe, and I look forward to speaking to you in the next episode. Hello there, I hope that you're doing well. Welcome to this new lecture of the 2025 model series. This lecture is going to be on higher time frame institutional order flow. Before we dive into the lecture, I first want to share the following quote with you. If you cannot anticipate the move taking place based upon the higher time frame charts, you have no purpose dropping into lower time frame charts. Meaning, if you cannot see the move taking place, which you anticipate based upon the higher time frame chart, you have absolutely no purpose going into the lower time frame chart. The reason why is because if you zoom into the lower time frame charts too quickly, you are likely going to get lost in the price action. Therefore, it's crucial that you learn to establish a higher time frame narrative first of all, and that's what we will discuss during this lecture. Defining institutional order flow. Bullish institutional order flow is present when price is expanding higher, retracing lower, and expanding higher. Premium arrays will get violated and discount arrays will get created, which will function as support on price. Bearish institutional order flow is present when price is expanding lower, retracing higher, and expanding lower. Discount arrays will get violated and premium arrays will get created, which will function as resistance on price. These are the two definitions of both bullish as bearish institutional order flow. We also have neutral institutional order flow, but that is basically when there's no one-side order flow present, and that is when you anticipate the consolidations taking place. Throughout this lecture, however, we are going to focus purely on bullish and bearish institutional order flow. Let us first take a look at bullish institutional order flow. Bullish institutional order flow is present when the market moves from point A, which is on the bottom left right here, to point B, which is on the top right. This is the schematic which I introduced to you throughout the price cycles lecture of this model series. This is the schematic which we're going to work with moving forward. Keep this schematic in mind. What we can see right here is that I've created price action and I've annotated two lines. I've annotated a red line on the lower end, which represents a point of interest, and I annotated a green line on the top right here, which represents a draw liquidity. Right in front of you, you can see a visual representation of the market maker buy model. The market maker buy model takes place in markets which are trending higher, which are being repriced towards the upside, meaning there's bullish institutional order flow which is present. What you will see in bullish markets is the following. What you will see is that the market will begin to consolidate, and this consolidation right here has one function. That function is to engineer buy-side liquidity above these relative vehicle highs. Retail-minded traders will look at these highs as a strong resistance area having been reached. When the market then expands towards the downside, it confirms their existing idea of a strong resistance area being met. They see the market expand towards the downside, and we see it retrace higher to continue expanding lower. This continues until we reach the point of interest right here. Meaning, you can see that we were in a sell program from this area all the way to the point of interest. Meaning, the price swing which was taking place was A to B. Eventually, the point of interest gets met, and what we can see is that point B turns into our new point A, and the next price swing which will occur is from point A right here to point B. If you do not understand what I mean by the use of the language of point A and point B, I highly suggest you to go back to the price cycles lecture. What you can see is that the market repriced lower into the point of interest, and we see the market begin to show the signs of forming a reversal in this area. Now, what I will outline to you throughout this lecture is specifically how you can recognize that order flow is changing from bearish to bullish. When we pay attention to the following schematic then, what you can see is that I've outlined two blue shaded areas right here. What these blue shaded areas represent are imbalances which formed throughout this repricing towards the downside. Now, what I want you to pay attention to is first of all the following imbalance right here. This imbalance in particular is very important to monitor because this imbalance formed throughout the final price swing which reached our point of interest, meaning it reached the area where we anticipate a buy program to unfold off. Therefore, what we will be monitoring is the following. What we will be monitoring is the reaction to this imbalance. If we would begin to see the market displace above this imbalance, utilize their support on price, from that moment in time, we can confidently say that order flow has changed from bearish to bullish. Pay attention to the word use of the imbalance which formed throughout this final leg towards the downside. That's a key insight which I want you to write down. Now, what you can see then is that the market reprices into the next imbalance which formed right here. Notice that we initially reject this imbalance and we retrace. This right here is very important to note, and the reason why is because of the fact that the market is retracing into this old high right here. What I want you to understand is that the fact that this premium ray in the form of a CB failed to function as resistance on price is the first sign to you that order flow is changing from bearish to bullish. Next to that, what you're seeing is that the market is trading above an upclose candle, which will have formed throughout this swing high formation in this area. The fact that this upclose candle did not function as resistance on price shows to you that the underlying order flow is changing from bearish to bullish. Because what you can see right here is that inside of this high formation, you will see a bullish breaker form. Why is this a bullish breaker? Well, what you can see is that the market expanded lower and we formed this low right in advance of the point of interest. Notice that a retracement higher took place and the market then expanded towards the downside once more, taking out the sell-side liquidity engineered below this low. Notice that this high also set up the final run into our point of interest. The moment that the market displaces above this high, we anticipate that the final upclose candle which will have formed in this area will function as support on price, because this upclose candle is your bullish breaker. When we pay attention to the delivery in this area then, what you can see is that I've also outlined that the imbalance will form the moment that we reprice through this high. Notice that the imbalance doesn't necessarily have to form exactly at this high. It can also form just a bit below it or a bit above it. What matters is that inside of this impulse leg higher, there will be one or multiple imbalances. What these imbalances suggest to you is that the order flow is changing from bearish to bullish. Why? Because a premium rate is being violated right here and a discounter rate is being created. Next that you can see that I've annotated this light bulb emoji. The reason why I've annotated this light bulb emoji is because what you can see is that this high right here formed inside of a CB on the left side of the curve, a bearish value gap. Notice that the market retraced into that and then expanded lower. We then saw the market displace above this high with an imbalance. This right here is what I refer to as the Zeussy market structure shift pattern. This market structure shift pattern is present within a lot of the market reversals which you will see. If it's not present on the time frame through which you are looking at the markets, I highly suggest you to drop into the lower time frames and investigate whether or not it's there. What we can see is that the market retraces into that bullish breaker, that red shaded box. It retraces into this bullish value gap and notice that the market finds supports there before expanding higher. Isn't that interesting to think about? How did I define bullish institutional order flow to you? I outlined to you that when the market expands towards the upside, retraces lower, and then continues its expansion higher, that right there is bullish institutional order flow. On the lower time frames, what you will see is the following delivery taking place. So meaning inside of this retracement lower, followed by this expansion higher, you will see this schematic right here on the lower time frames. Meaning you will see a lower time frame market maker buy model. The same applies to the next expansion leg, followed by a retracement, followed by another expansion. And the next. And the next. Guys, I want you to put this in your mind and I want you to investigate this. Because I'm telling you right now during this lecture, this has been hidden underneath your nose all this time. Because the point of interest right here, which I've showcased by this red line, could be, for example, this bullish breaker, its range. Yep. What could the draw liquidity be? The draw liquidity could be this high or a level above. Are you beginning to see how everything is fractal? Simply by me explaining these schematics to you. Now what you can see is that the market eventually expands higher as outlined, and throughout these expansion legs, what you will see is that new imbalances will get created. These imbalances will function as points of interest down the line. When we pay attention to a chart example then, what you can see is that the market expanded towards the upside, and throughout this expansion leg what you saw was that this imbalance got created. Notice that the market retraced into that imbalance multiple times before eventually expanding away from it. Notice that a new imbalance got created. We see the market expand higher, retrace, and then expand higher once more. What is present right here in this area on the lower time frames? On the lower time frames, you are going to see the signs be present of a market maker buy model, of lower time frame bullish institutional order flow. Why? Because on this chart, you can already see that the market is expanding higher and discount arrays are being created. These discount arrays are functioning as support on price. So that means that on the lower time frames, you are going to find buying opportunities. When we pay attention to a chart example then, which is taking place on the lower time frames, what I want to see is that the market was repriced towards the downside, and notice how it was going back and forth throughout this repricing lower. Notice how it wasn't really quick. We see the market reprice towards the downside, and we see it take out the previous day low, which was right here. We see the market trade deeper into the price range of that imbalance, which I had outlined. We then see the market eventually show the signs of forming a swing low. How do we see these signs? Well, what you can see is that we dropped towards the downside, formed this low, retraced, and then we saw the market expand lower one more time. Notice that we quickly take out sell-side liquidity engineered below this low, and we then see the market displace towards the upside with this very large green candle right here. This green candle right here shows to you urgency, it shows to you speed. We see an imbalance getting created, and the market retraces into that imbalance. Notice that that imbalance functions as support on price, and we see the market begin to expand towards the upside. Notice that by this time, we have already traded above the high, which set up the final run towards the downside. And therefore, you can confidently say now, alright, we have likely formed the smart money reversal within a new buy program, within the new buy side of the curve, within a market maker buy model. sell side of the curve. The market is being drawn towards sell side liquidity. It's being repriced lower. Eventually, we form the smart money reversal, and the market is reversing and drawing towards buy side liquidity. This is the buy side of the curve. We see the market eventually expand higher, and a sequence of two imbalances gets created. Notice that I've annotated the highest imbalance right here. Why do I have specifically this imbalance annotated? In order to understand why I'm specifically monitoring the reaction to this imbalance, we need to take a look on the left side of the curve, meaning we need to pay attention to the left. I would like you to pause the reaction for a moment, and I would like you to try and think about what you could see right in front of you right here. Think back to what I just outlined within the market maker models. Some of you don't like to pause these lectures, you just like to watch them, maybe even at twice the speed, because you want to get done with it, right? And then you think that that is going to provide you with all the knowledge which you need. Nope, just watching these lectures is not enough. And if you don't pay attention to detail, you're not going to gain the benefit that someone who doesn't rush through them actually gets. What I want you to see is that when we pay attention to the left right here, what you can see is that we formed this high. We saw the market initially expand lower, retrace higher, and then that high was formed. Notice in what that high formed. That high formed inside of this CB on the left side of the curve. Therefore, the moment that we displace through this high with an imbalance, we anticipate that that imbalance is likely going to function as support on price because we displaced through this high. This is a variation of the market structure shift pattern, which I had outlined to you throughout the schematic, but now at a later stage within the market maker buy model. Meaning, initially I showed it to you within the low risk buy, but that market structure shift pattern, guys, takes place all throughout the market maker models. And therefore, you can see it function as support right here. Consolidation takes place inside the price range of that BC, and eventually the market expands higher one more time. Notice that the new imbalance forms right here, and we see the market retrace into that imbalance before expanding higher, drawing towards buy side liquidity, resting above the previous day high. Now, when we're paying attention to this chart, main takeaways is how we recognize the bullish institutional order flow on a higher time frame chart and then dropped into a lower time frame chart to confirm the bullish institutional order flow by paying attention to how the market is reacting to new discount arrays which are being created inside of a large imbalance. When we pay attention to another chart example then, what you can see is that I've dropped straight into the 1 minute chart on the lower time frame chart. The reason why is because this is actually part of a trade breakdown lecture which I released during the time of releasing this model series episode as well. The trades breakdown lecture is called Trading, Consolidating Markets, and basically buying and selling in the range. Meaning, what you can see is that I bought inside of this range and eventually I also sold right here on the right. You can go to the trade breakdowns and find this lecture. Now, the reason why I wanted to put this schematic in is due to the following. What I want you to see when it comes to this chart example is the fact that we saw the market reprice towards the downside right here. We saw it create a CB throughout this repricing lower, throughout this quick repricing lower, and we saw the market retrace into that CB. Notice that we formed this high, and we see the market displace through that high with an imbalance. Notice that at this moment in time, the market is also repricing above this CB right here. Therefore, what we're monitoring is whether or not that newly created imbalance is going to function as support on price. If it will, we can anticipate that we're likely seeing order flow changing from bearish to bullish. Guys, recognizing changes in the state of delivery where order flow is changing from sell program to buy program is crucial. But please keep in mind that there's more that is required in order to confirm that order flow is in fact changing. And that is one of the most important things which I can share with you, is that don't get lost in the lower time frames like I mentioned prior. Focus on recognizing the higher time frame narrative. Do you see how I just outlined to you based on a 1 minute chart, the lower time frame buy program which you're seeing unfold right here? But without a proper understanding of the higher time frames, you would still probably get lost inside of this delivery. Therefore, it's crucial that whenever you break down your trade, or you break down your backtesting log, or you break down my trade, it's crucial that you first always log a higher time frame to try and get a feeling for what the higher time frame narrative is, so that you can then go into the lower time frames and look to confirm that higher time frame narrative. Let's now take a look at the bearish side of things. Let us take a look at bearish institutional order flow. For bearish institutional order flow, what you can see is that the schematic of A to B is of course in first, where you can see A on the top left and B on the bottom right. When we pay attention to the schematic, what you can see is that's basically the buy program in first. Meaning, what you can see is that we see a market make a sell model schematic, where there are two lines. First of all, this line on the downside represents your draw on liquidity, and the line on the upside, the green line, represents your point of interest. What I want you to see is that the market was consolidating down here. The function of this consolidation is to engineer sell-side liquidity. Sell-side liquidity is being engineered below these relatively equal lows because a lot of retail-minded traders will be looking at those lows and will be thinking to themselves, hey, we reached a strong support zone, that's why the market is failing to reprice through this level. We, however, know that this is not the case, and we know that this is the engineering of liquidity which is taking place. The market begins to expand towards the upside, and we see it retrace lower. Eventually, it continues its expansion higher, and we see the market begin to draw towards the point of interest. The moment that the point of interest gets met, we can be monitoring whether or not the signs become present of a reversal taking place. We see the market eventually form this swing high and begins to displace towards the downside. Notice that we displace below this low, which set up that final run higher. We'll get to that in a bit. What I want you to understand is that we change from buy program to sell program. And therefore what you can anticipate is that every single retracement higher is likely going to be manipulation to distribute lower. And that is a key insight which I want you to take away from this lecture already. And that is that when you have a draw on liquidity established, you're actually looking for price runs against that draw on liquidity for a while. The reason why is because those price swings are more confirmation of your existing draw on liquidity to be the right draw on liquidity. Why? Because liquidity will seek to be engineered around your draw on liquidity. And that's something which you need to keep in mind. Understand as well that we saw the market move from point A to point B, and now point B turns into point A to draw towards point B. When we pay attention to the imbalances then which get created on the left side of the curve, throughout this buy side of the curve, what you can see is that I have annotated two imbalances. One right here and one inside this final expansion leg higher. Now what I want you to keep in mind is that throughout this final run higher, what is taking place is that a lot of buy side is being taken out. And at the same time, what's taking place is that traders are being trapped into believing the markets are just going to continue running forever. Therefore, what you see is that there's speed and velocity which is taking place. Big upgo candles will step in. It's in those big upgo candles and an integration of the price pattern of an imbalance that you must be wary. And the reason why is due to the fact that you understand that the point of interest has been met, also during a time of interest, which we'll discuss later throughout this model series, and therefore you can anticipate a smart money reversal taking place. The moment that the market displaces below that imbalance and we begin to see this discount race fail to function as support on price, we can anticipate that's likely going to function as resistance on price moving forward, and that the order flow changed from bullish to bearish, especially considering the fact that your draw on liquidity is down here. When we pay attention to this low right here, what you can see is that I've plotted a red box. This red box represents a bearish breaker, where you saw the market expand higher, create this high, retrace lower, then we finally saw the expansion taking place higher into our point of interest. Now what's a crucial insight here is that buy side liquidity was engineered in advance of the point of interest. We see the market form a higher high, and we then see it displace below the last down close candle which set up that run higher. Therefore, from this moment in time, we can anticipate that this down close candle is likely going to function as resistance on price. Why? Because the order flow changed from bullish to bearish. Now, please keep in mind that I'm not teaching to you price patterns for the sake of price patterns. I'm explaining to you a certain logic which is based around understanding time-based delivery profiles. How price should deliver between fixed windows of time that do not change. Meaning, these time windows which I'm going to teach you more in depth throughout this model series are the same always, and they will never be adjusted. And the reason why is because in order for you to objectify your analysis on the markets, you must subscribe to objective theories, and objective theories are always based upon time and price. Price you have been introduced to throughout the first real lecture of this 2025 model series, and time you have been introduced to in depth throughout the second real lecture of this 2025 model series. More on those topics will get shared in due time, but I must make sure that you have a good foundation before we dive into all of that good stuff. This downclose candle is your bearish breaker, and we anticipate that it's likely going to function as resistance price. It has to in order for the order flow to remain bearish. When we pay attention to that downclose candle, what you're likely going to see is that downclose candle being displaced through by an imbalance, specifically a bearish survival gap, a CB. Meaning throughout this expansion leg lower, you are going to see an imbalance being created right here. What you will notice as well is that I've annotated the light bulb again. This light bulb is important because it shows to you that this low formed inside of an imbalance on the left side of the curve. Therefore, the moment that we see price displaced through that low with another imbalance, we can anticipate that we're likely going to see the market find strong resistance inside this red shaded box. And I do not really like to use the word resistance or even support in general, but it's a very easy way of describing the market rejecting this range to go lower. Now, what's important to note is that when you do not see this price pattern on the current time frame that you're looking at, you can zoom into the lower time frames and try and see whether or not it's there. Next, that you can see that multiple imbalances will get created, and we see the market retrace into those imbalances, for example, here. What you must understand is that the creation of these imbalances, followed by the retracements into them, provide even more lower time frame trading opportunities, because it's inside of those retracements legs higher, whilst the higher time frame institutional order flow is bearish, that we can anticipate that we're going to form a nice swing high before continuing to expand towards the downside. This is what I mean when I outline to you, I'm interested in trading the low resistance security run. In order to define what the low resistance security run is likely going to be, I pay attention to the higher time frames only, and based upon those higher time frames, I try to determine what's likely going to be a low resistance security run and what not. When we pay attention to a chart example then, what you can see is that we saw the market initially expand towards the upside, but notice how slow it was. Notice how it was just going back and forth, back and forth, back and forth. There weren't any real greedy arrays which got created. Eventually, we saw the market take out the buy side liquidity engineered above this high, and we then saw it begin to roll over. Notice that when the market began to roll over, we saw it create multiple imbalances right here. Notice, however, that both these imbalances were allowed to be left intact, meaning we didn't see the market retrace into them. These open imbalances are now called breakaway gaps. These breakaway gaps are suggesting to us that we're likely going to see speed and velocity towards the downside even more soon. We see the market eventually reprice towards the downside, taking out sell side liquidity engineered below these relative weak lows right here. We then see the market retrace, and a daily imbalance gets created, a daily CB. This means that moving forward, as long as this CB does not get displaced above, I'm expecting lower prices. And that's my thought process for the lower time frames as well. So that means I'm going to be looking for signs being present of market maker sell models. Notice that we see the market retrace into that daily CB. New day opens up, we open high, and the market then begins to expand towards the downside, taking out sell side liquidity engineered below this low. When we pay attention to the lower time frame then, what you can see is that we saw the market consolidate right here, and we then saw it begin to run towards the upside. Notice that this rather large imbalance gets created. We see the market consolidate after having traded into it. Market is just going back and forth, back and forth, back and forth. Eventually, we see the market reprice towards the upside quickly. We see a takeout buy side liquidity resting above this high. We see the market form a swing high and begins to displace lower. Notice that the market is being repriced into the price range of this BC right here. We see the market find support inside that initially, and a retracement higher takes place. Now, what's the function of this retracement higher? The function of this retracement higher is to make sure that new liquidity gets engineered. New liquidity will get engineered below this low. So when we see the market retrace higher like this, you must understand that this is manipulation which is taking place, and after that you can anticipate distribution to follow. Eventually, we see the market expand towards the downside. And how do we confirm that the bearish institutional order flow is going to last? How do we know that we were right about point A being up here and point B being down here? This being a crucial sell side liquidity pool. When you pay attention to the delivery which took place relative to this blue shaded box, what you can see is that the market initially found support inside of that. Notice, however, that this imbalance did not set up a new run towards the buy-side liquidity pool resting above this high. Instead, we saw the market eventually begin to roll over and begin to displace through it. Notice that we saw the market reprice below the imbalance right here. Next candle opens high, and we see the market continue its expansion lower, drawing towards sell-side liquidity engineered below this low. When we pay attention to another chart example then, what you can see is that we saw the market expand towards the upside right here, and eventually we saw the market take out buy-side liquidity engineered above these highs, which repriced towards the downside. Notice that we saw the market form a new swing high, and we saw the market eventually begin to run towards the downside. Notice that we saw this imbalance, this bearish value gap get created the moment that we displaced through this low. Why is this low in particular important? Because we saw the signs of a high formation, low, lower high. So this tells you that this down close candle right here is your bearish mitigation block, and therefore this must function as resistance price. If we are in fact going to see a very bearish delivery profile taking place, we are likely going to see the market retrace into that imbalance and immediately begin to expand away from it. Notice that we see the market tap into the imbalance, taking out this candle's high and immediately running towards the downside. This is what we refer to as institutional order flow entry drill. And this right here shows to you that there's an urgency for the market to reprice lower. Now, what you can see is that I did not annotate the green and red line within this example. The reason why is because I want you to begin to be able to determine where point A is and point B is. So I would like you to pause this lecture for a moment. I would like you to think about the following chart image. I would like you to try and basically write down for yourself or visualize for yourself where you would put point A and where you would put point B. I know that for the majority of you, it's too hard to right now even envision where that would be the case. But trust me, in due time, with more practice, this will all make sense. And once you're able to basically say what I'm about to say before I mention it, that's when you know that you're on the right path. What I want you to see is that I mentioned to you that we saw the market run up higher quickly, taking out buy-side liquidity engineered above these highs right here. When I see these highs on the left, I see engineered trendline liquidity. And the reason why is because you can see that the market is very nicely making lower highs all the time right here. So retail-minded traders are looking at that as a sense of weakness. They are looking at that as, oh, the market is very bearish, we can place our stop above the trend line, boom, that's the job done. We see the market, however, begin to consolidate in this area. Eventually, this consolidation leads to an expansion leg higher. Notice, however, how these relative weak lows were left intact. We see the market run higher, and notice that we see this imbalance getting created. This imbalance by itself is already a potential objective on the downside if the market begins to change from buy program to sell program. Notice that we see the market eventually form this swing high above key buy-side liquidity pools. What buy-side liquidity pools I'm referring to? I'm referring to the highs which formed and set up this trend line right here. And therefore, the moment that we take out those highs, this becomes my point A. What becomes my point B? Well, I have 2 points B, so I have 2 potential targets. First of all, this imbalance right here. But secondly, also the sell-side liquidity engineered below these relative weak lows. And next to that, we could even go as far, and this is looking at it from a micro scale, we could be looking at this delivery right here, and we could argue, okay, well, the CB right here, so the low of that CB is point A, and point B is the previous day low, this sell-side liquidity pool right here. That would also be valid. All that matters is that you're able to recognize when the order flow is changing, because once you're able to recognize that the order flow is changing, you can anticipate what the next delivery profile is likely going to be. When we zoom into this delivery then, and we pay attention to specifically an hourly chart, what you can see is that the market opened up for Friday, and we see it run higher. The market trades into that imbalance, that blue shaded box, and just taps it. We just take out the previous day high, and the market begins to roll over eventually. We see the market begin to displace towards the downside, and we see multiple imbalances getting created. Notice, however, that we see these imbalances getting created throughout a price swing which already takes out the previous day low, which was right here. Therefore, what do you know in order for the underlying order flow to remain bearish? What we must see is that the imbalance or sequence of imbalances in this case that set up the repricing into that objective of the previous day low, they must function as resistance on price. So we see the market retrace higher, trading back into the price range of that CB right here, that bearish value gap, and eventually we see the market continue its expansion lower. That tells you for the next week that you can also anticipate further continuation lower as long as we do not see the market displace back above this CB. Why oh why do I choose the imbalance which I choose? I just outlined throughout this lecture a crucial element when it comes to selecting the key ranges to monitor. I want to give you a homework assignment to end this lecture. I would like you to find 15 examples of a trending market in which you see one-sided order flow taking place. I want you to zoom into the lower time frames and find the market maker models present, whether it be market maker buy models or market maker sell models. I want you to annotate everything as detailed as possible. Meaning, I would like you to try and annotate everything which you see when it comes to the PD rates which you see, when it comes to recognizing A to B or the multiple A to Bs, recognizing the use of time cycles, recognizing maybe even intermarket relationship if you're already investigating that. Annotate literally everything. And the reason why is because it's inside of this assignment where you focus on spotting trending markets and looking at the lower time frame opportunities that you will be able to see that there are countless opportunities each period. I hope that you enjoyed this lecture. I want to thank you for watching it all the way to the end. I look forward to speaking to you in the next one. Good luck with the assignment, and I look forward to seeing the charts coming in on the mentorship form because that is where I suggest you to post them if you want to receive my feedback. You can just tag me in the questions channel and I will do my best to get back to you as soon as possible. Good luck with your studies and we'll speak soon again, Lord willing. Be safe. Hello there, I hope that you are doing well. Welcome to this new lecture of the 2025 model series. During this lecture, I will share with you insights on determining your draw liquidity. Determining your draw liquidity is the most crucial aspect when it comes to your trading, and therefore this is a very important lecture and I highly suggest you to take notes. If you did not watch the prior lectures of this model series, I highly recommend you to watch those lectures first before watching this lecture. And the reason why is because I'm speaking to someone who has already gotten that foundational knowledge which I've provided prior. So with that being said, let us begin with this lecture. To begin this lecture, I would like to begin with the following quote. Trading without a draw liquidity is as if you're driving without a destination. Now I can already hear some of you think, but hey, I like to drive without a destination. I like to just spin around in the world and just drive around my city and just enjoy driving my car. Yes, I understand that. It's all fun and stuff, right? However, when it comes to trading, it's very important that you must note that you always need to have a destination when it comes to where the market is drawn towards. Your draw liquidity is so-called the end destination when you're driving within your car. Meaning you have a certain destination that you're driving towards, and when that destination gets reached, you're done with driving your car. You need to view trading the same way, meaning you must view the market through the perspective of point A to point B, where point B is the destination. And the destination is until when you anticipate that the market is going to draw into that direction. And therefore, it's very important that you must understand that the draw liquidity is as a magnet on price, meaning the markets are drawn to these draws on liquidity. And therefore, your job is to be able to determine where they are. Methods to determine draws on liquidity. You can already read this correctly. There are multiple methods to determine the draw on liquidity. I will share all three methods with you today. However, what I would like you to understand is that you can pick the methods which suit you best. I highly suggest you to try and blend the methods and not rely on just one, because the precision is found in blending these three different methods with each other. First of all, we're paying attention to time cycles, meaning we're utilizing the logic that I taught prior within this model series to determine our draws on liquidity. Next step, we pay attention to key levels. And thirdly, we pay attention to PD arrays. When you try to blend all these three elements, it leads to high probability trading setups, as you will see during this lecture. Now, please note that if you did not watch the prior lectures of this 2025 model series, you're going to go into this lecture without any foundational knowledge about how to actually determine these three methods themselves. Do you now also understand why the first few lectures of this model series were on these topics themselves? When we pay attention to time cycles, the logic of time cycles is the following. What you must see is that I have three boxes right here in front of you. Inside of these three boxes, there are time cycles which are taking place, meaning box 1 is time cycle 1, box 2 is time cycle 2, and box 3 is time cycle 3. Now these boxes can represent whatever time cycle that you are looking at. In this case, I'm just going to refer to them as time cycles. This, by the way, shows you as well that you're able to apply this knowledge across all different time cycles. Meaning whether if you're a swing trader or whether if you're an intraday trader or whether if you're a long-term trader, it's all the same logic. It's all fractal. Both time as price are fractal. The only difference is the duration of the time cycles that you're looking at. Therefore, what I want you to understand is that time cycle 1 right here determines how time cycle 2 will deliver. Time cycle 2 will determine how time cycle 3 will deliver. Throughout each new time cycle, we refer back to the high and low of the previous time cycle. The reactions to these levels tell us the story for what's likely going to happen next. Meaning, during time cycle 2, you refer to the high and low of time cycle 1. During time cycle 3, you refer to the high and low of time cycle 2. That's a very important process which you must be applying when it comes to making your analysis about the market price. Now, one thing which I would like to share with you before we dive into the next slide is the following. These time cycles are fixed, meaning they have a fixed starting point and a fixed end point. Where the highs and lows form during that window of time is dynamic, meaning right now, let's say that it is currently the month of March at the time of this recording. Throughout the month of March, a high and low will form. This high and low will be referred to throughout the next month. However, in 1 year, what will happen is that the high and low of March will be at different price levels than this month. And therefore, what you see is that the start and end point is always fixed. It's the same. However, where the highs and lows form, that is what is adjustable. And that's a very important insight which you must understand. Because once we start looking at the key levels as well, you will begin to see that those are fixed and the time-based liquidity pools are dynamic. When we pay attention to utilizing time cycles for draws on liquidity, my main focus is on determining whether or not purge and reverts are taking place. What purge and reverts represent is the following. A purge and revert is basically the market taking out, in a bullish example, a previous cycle low, meaning this red line right here is the previous cycle low. We open low into that, take out the sell side liquidity resting below this low. Then we see the signs first of a smart money reversal taking place. And then we see the market draw towards the upside. The moment that it displaces higher, we can immediately say, all right, the first draw on liquidity is going to be the previous cycle high, which is this buy side liquidity pool. If we pay attention to the bearish example, it's the same logic but then in first, where you see that the market opens up a new time cycle, runs the previous cycle high, see the signs of a smart money reversal taking place, and then we see the market begin to expand towards the downside. Displacement lower takes place. When this displacement lower takes place, my eyes immediately drawn towards the previous cycle low, because below that low, sell side liquidity has been engineered throughout that previous time cycle. Meaning, the logic behind time cycles suggests that between the start and the end of the previous cycle, liquidity will be engineered both above the high as below the low. And what icttrading will seek to do is that it will seek to take out the buy side liquidity resting above the previous cycle high, above this green line, to then revert towards the sell side liquidity resting below this low. This takes place inside of bearish markets, whilst the bullish example takes place inside of bullish markets. It's possible that you're still going to see these smaller fractals taking place inside of the opposing market environment, whereas, for example, you can see a bullish purge and revert of a smaller time cycle taking place inside of an overly bearish environment. And the same, of course, for the bearish purge and revert. This bearish purge and revert can also take place inside of a bullish environment, but then it's likely going to be short-lived, meaning it's likely going to be a purge and revert of a smaller time cycle. Why? Because the higher time cycles, the bigger ones, are suggesting that higher prices should be next. So it's very important to be able to say, okay, the bigger fractals are now in buy programs, or the bigger fractals are now in sell programs. If you're completely new and you're a completely new student of mine, I highly suggest you to just stick to trading in sync with the higher time frame order flow, because that is usually the easiest. Trading against the higher time frame order flow can be very tricky and requires way more experience, so keep that in mind. That is why I outlined to you the institutional order flow throughout the previous lecture. When we pay attention to a chart example then, what you can see right here is that the AM session is annotated right here, where you can see that the market formed the AM high right here and the AM low down here. Notice that when the afternoon session opened up, we saw the market drop lower, taking out the morning session's low, the AM low, and then we saw the signs become present of a reversal taking place. We then saw the market draw towards the upside. What is it like going to draw towards? The market is likely going to draw towards the morning session's high, which is right here. Why? Because we purged the AM low, so now we can anticipate that the market is going to revert towards the AM high. And what's a very important thing to note here is the following. What I outlined is a purge and revert. However, the moment that this AM low is being taken out by this down close candle, you don't know yet whether or not it's a purge which is taking place, or if the liquidity is being swept. And that's a definition thing. Let me explain. Whenever the market takes out a time-based liquidity pool, so in this case the AM low, we call that the sweeping of liquidity which is taking place. The moment that we see the market form a low below that time-based liquidity pool, and we see it displace higher, from that moment in time, we call it a purge on liquidity. Why? Because then we see that smart money has bought below the morning session's low, below the previous time cycle low, and now we can anticipate that a buy program is going to unfold. And that's a very important definition which I want you to understand. It's the difference between sweeping liquidity and purging liquidity. Sweeping liquidity is simply the market taking out a liquidity pool. Purging the liquidity, however, is the market showing the willingness to form a new low below that previous cycle low to then distribute towards the upside. So purging is a sign of manipulation taking place. Whenever you recognize that manipulation is taking place and you see a purge on liquidity, you can anticipate that distribution is likely going to take place soon next. What will the market refer to? It will refer back to the previous time cycle's high, in this case the morning session's high. Notice that the morning session's high got taken out and the market retraces into an imbalance which got created throughout the repricing higher. Beautiful, isn't it? Purge of a previous cycle low, revert towards the previous cycle high. When we pay attention to another example of this taking place then, but in this case a bearish example, what you can see is that between 7 to 8:30 AM, the first 90-minute cycle of the morning session is taking place. Notice that the market is expanding towards the upside during the beginning of this cycle. The market begins to grind towards the upside eventually, and notice how it begins to slow down. We can see consolidations taking place. Eventually at 8:30 AM, the second 90-minute cycle opens up, and we see the market run above the previous 90-minute cycle, its high, above the AM1 high. Notice that we eventually see the market come back below it, and we see the market begin a sell program, where we begin to see that premium rates are being created and they begin to function as resistance price. From this moment in time, what you can anticipate is that the market is likely going to revert and draw towards the previous cycle low. Why? Because we took out buy-side liquidity engineered above this high. We see the signs of a reversal taking place up here, so now we can anticipate that IPDA will seek to draw towards sell-side liquidity. Where is sell-side liquidity? Sell-side liquidity is engineered below the previous 90-minute cycle lows. However, if we look inside of these fractals, what you can see is that these boxes represent 30-minute cycles. So even these relatively equal lows could be a potential draw on liquidity. Why? Because it is a previous 30-minute cycle low sell-side liquidity pool here. The same for this low. The same for these relatively equal lows here. So you must understand that within a bigger fractal, there are also smaller fractals which you can use as objectives. Now, as a general rule of thumb, this is where it's very important to note what the higher time frame order flow is and what you're anticipating from the bigger fractals. If you're anticipating lower prices from the bigger fractals, you can aim for full bulls, meaning you can aim for bigger objectives. If you are trading without an understanding, however, of the bigger fractal and it's not clear to you, that is when you partial or take profit aggressively. The next method of determining the draws on liquidity are by using key levels. When it comes to key levels, the levels which I'm referring to are the levels which are introduced throughout the 2024 model series. These levels are based upon quadrants, meaning we first of all have a box right here, which represents the first quadrant from 0 to 25. We then have a second box. This second box represents the price range between 25 to 50. The third quadrant then represents the price range between 50 to 75. And the fourth quadrant represents the price range between 75 to 100. Now, as outlined prior throughout the price cycles lecture, what is very important to note is that you must be able to see what the sequence is currently that price is following. Meaning, just like there's a sequence in time, there's also a sequence in price. And that means what icttrading is doing is that it's referring to these reference points as reference points to simply say, okay, we're still in a buy program, we're still in a buy program, we're still in a buy program. Why? Because until that bigger draw on liquidity is reached, meaning that more important price level, that bigger price level, that is when you can anticipate every single expansion higher to be followed by a retracement lower to continue higher. Now, I understand that when looking at a schematic like this logic might not click just yet. However, when we pay attention to a chart, I'm 120% certain that it will click for you. When we pay attention to a chart example right here, what you can see is that we are looking at the Nasdaq chart. What you can see is that I've annotated the 21,000 price level right here, the 20,500 and the 20,000 price level. Throughout this week, what I outlined to you was the following. What I outlined to you was that as long as the market would not displace above the 21,000 price level, I would anticipate the market to draw lower. Why, oh why did I outline that? The reason why is due to the following. When you pay attention to this delivery on the left, what I would like you to see is that the market displaced through that 21,000 price level and a CB was created right here. As long as the market does not displace above this CB, I anticipate that what will happen is that icttrading is going to refer to the next dealing range. What is the next dealing range? From 21,000 to 2,000. Inside of that range, equilibrium, 50% of that range is right here, 20,500. Meaning, what I can anticipate is that around the 20,500 price level, we're likely going to see some form of consolidation. Notice how the market wicked multiple times below that orange line, which represents equilibrium of that bigger range. But notice how it took a long time before it finally displaced through it and reached that 20,000 price level. That shows to you that the reaction to equilibrium can be monitored whenever a new range gets entered. So notice that we displaced through the 21,000 price level with that CB. So from that moment in time, my eye is drawn to price levels below market price. Notice how we open up the week and month, repriced slightly above the 21,000 price level, but notice that the market then slammed towards the downside. That right there is a sign of bearish institutional order flow stepping in. Now I understand that some of you might be looking at this example and you might be thinking to yourself, but hey, does that mean we're only using price ranges of 1,000 points? No, we can also use a price range of 100 points, for example. And that is a smaller price range. However, when you're looking at bigger price swings, you must of course use bigger ranges. When you're looking at smaller price swings, you must be paying attention to smaller ranges. So what I'm outlining to you now as well is how price is fractal. Because icttrading is following the same logic on the higher time frames as that it does on the lower time frames. Just like I outlined that the time cycles are fractal, where we can apply the same logic over and over again, but across different time cycles, both smaller time cycles as bigger time cycles, the same applies to these price ranges, where we can apply the same logic on a smaller range as we do on a bigger range. And when you begin to understand this right here, it opens up a completely new perspective across all financial markets, because then it makes sense to you why and when the market is likely going to form, for example, swing highs and swing lows. And that is when you can see as well, when it comes to these bigger price ranges, where certain news events take place, where certain global events take place, where the media begins to push out a certain narrative. Once you're able to recognize what icttrading is doing next, you can anticipate what the news headlines are going to be. Now that's a completely different topic, which I'm going to save probably for a later lecture within this series. I could create a whole lecture on the importance of certain narratives and bigger narratives and how the news gets utilized for manipulation and distribution purposes. But this lecture is simply purely on the drawstring liquidity. Now, the reason why this lecture is a very important lecture to study in depth is due to the following. What many of you do wrong is that you go into the charts and you begin to look for PD arrays. You begin to look for example, breakers and fair value gaps, and you think that every single break and fair value gap that appears is a trade setup. And you think that all you should do is just trade every single breaker that presents itself for every single fair value gap that presents itself. You might look at an SMT, you might implement a very simple element of time, such as a macro window, and you might think to yourself, now I'm trading as icttrading is trading. Well, you're beginning to see that I haven't even discussed any entry patterns with you yet. I haven't even discussed with you how to enter into a position. All that I'm outlining to you so far within this model series is how you can basically predict what's likely going to happen next. This doesn't mean that you're always going to be right. This doesn't mean that you're always going to win. However, it does mean that you're objectifying your approach to the market significantly. Why? Because these price ranges don't change, meaning they're fixed, they're predetermined. The same applies to the time cycles when it comes to when they take place, but the highs and lows of the time cycles are dynamic, meaning where the high and low of the time cycle will form is different. When it comes to these ranges, they're fixed, meaning this is the range high of 21,000, this is the range low of 20,000. Inside of that range, icttrading will seek to go back and forth until it displaces outside of this range. And that's a very important insight which you must have. The next chart example which we're going to take a look at is on the euro. Notice that the range which I have annotated right here is between 104 and 105. 104 is our range low, 105 is our range high. Notice that when you pay attention to this delivery on the left right here, what you can see is that we gapped open higher for the week through the 104 price level. Notice that the weekly open and monthly open is right here. We see the market reprice higher initially, and then we see it eventually open up for the new day, and we see these consecutive down close candles trade into the 104 price level. Notice that the market drops below that 104 price level with this wick, but notice that the bodies keep on closing at this price level right here. We then see the market expand towards the upside and it displaces through the 104.5 price level. The moment that it displaces through this price level, what you can anticipate is that the next draw on liquidity is likely going to be the 105 price level. Notice that we see the market reprice towards this price level and eventually we see the wicks go above it multiple times, but the bodies keep on closing below it right here. Now that this range high has been reached, we must monitor the reaction to this level. If the market is going to displace through this level, utilize as support and price, then we can anticipate that we're going to enter the next range. However, if the market is going to reject this level, then we're likely going to go back and forth inside of this range between 105 and 104. Now what's important to note is what I just outlined to you when it comes to equilibrium. In the previous example, what you saw was that the market didn't displace through the equilibrium price level. Instead, we saw the market reprice through it multiple times, but not really utilize it as resistance price within that bearish example. However, in this case, what you see is that we reprice through it, and the market is so bullish that it doesn't even have to retrace back into the price level. That right there shows that there is an urgency for the market to be repriced towards the upside. Therefore, you immediately should think to yourself, the draw on liquidity is likely going to be the current range high of 105. And this is how we can utilize these key levels to gauge the order flow. Meaning, we're moving from level 1 right here to equilibrium right here. And then we move on to the third level, which is right here. All you need is 3 lines like this. Need to know the range low, need to know equilibrium, need to know the range high. And inside of that range, you can even add the quadrants, meaning 25% and 75% to determine even more important levels to monitor. This is how you can utilize objective levels to gauge the order flow. Now, I understand that for the newer students of my mentorship, this is likely a bit confusing because this right here is a logic which isn't based on any price patterns at all. All that I'm looking for is the following. All that I'm looking for is how the market is reacting to these key levels, and based upon that, I can gauge the order flow. And that's a very important insight which I would like you to take away from this lecture. And that's why I'm putting emphasis on it. I do not need any candlestick to trade. All I need is the time and the price. Time comes first, then price. Hence the name of this mentorship, time, then price. Once you know that the time is right, you will see this delivery and price. This is a low resistance security run. Now, what we can see right here in the following schematic is that I've blended both the time cycles as the key levels, and next to that, I've blended the PD arrays with this logic as well, meaning I'm adding all three elements to each other. During this lecture, I will not explain the PD arrays at all, and the reason why is because the PD arrays have already been explained throughout the previous lecture. However, what I would like you to see is that I'm blending the three different elements of determining your draw liquidity into one. Meaning, what you can see is that both the time cycles as the key levels as the PD arrays are being added into one so that I can anticipate a buy program stepping in. Now, the schematic in front of you might look very confusing to a newer student. Understand that if you haven't studied long enough, this might be like, what does this drawing represent or whatever, right? However, I'm going to walk you through it step by step, and I promise that if you listen closely, you will know exactly what the logic is which I'm representing to you. First of all, it's important to note that we're looking at a buy program, meaning we're looking at a bullish example. What we can see is that the market reached our range high right here, and we saw the market consolidate. We saw the market drop towards the downside, and we saw it displace lower. We see a blue shaded box get plotted right here, which represents a bearish fair value gap, a CB. Market retraces, and we see another CB get created. Notice that at this moment in time, a new time cycle is opening. This time cycle opens because this vertical line is spotted right here. The market retraces, and we see it retrace back into that blue shaded box, into that CB. An expansion leg lower occurs, and the market retraces and expands lower one more time. Notice that we see the market expand towards the range low, utilizing the key levels, and we see the market retrace. Eventually, we see the market have one more drop towards the downside right here, taking out sell side liquidity, resting below this low, trading below the key level, and we then see the smart money reversal taking place. From this moment in time, what we can say is that the sell side of the curve is completed, and now we can anticipate the buy side of the curve to take place. This is what your focus has to be on, becoming very good at recognizing reversals. When you become very good at recognizing smart money reversals, trading the right side of the curve will be very straightforward. Why? Because the right side of the curve is a reflection of the left side of the curve. So when you know that the program is changing from sell to buy program, all that there's left to do is paying attention to the left side of the curve and utilizing that to gauge the order from the right side of the curve. Notice that the market expands towards the upside, and we see it displace above this high. A retracement takes place, but notice that throughout this retracement, a new time cycle is opening up. Now, from this moment in time, what your eye must be drawn towards is, alright, where is the previous cycle low, where is the previous cycle high? The previous cycle low is down here, and the previous cycle high is up here. Do we anticipate the market to take out the previous cycle low before heading higher? No. Why not? Because the smart money reversal is already in throughout this second time cycle. Why do I mention second time cycle? One time cycle, second time cycle, third time cycle. 3 boxes. 1, 2, 3. What we can see is that the market retraces into this high, finds support there, open low of the new time cycle, and then we see the market expand towards the upside. Notice that it now trades above this green line, which represents that previous cycle high. Notice that the market takes out that high and then a retracement takes place. From this moment in time, our eye is drawn to whether or not this high is going to function as support on price. If that high functions as support on price, we can anticipate that further continuation higher is likely going to follow soon. Meaning the moment that the market expands higher like this, and it displaces above this CB, this blue shaded box, we must say to ourselves, okay, we're now in a continuation profile for this third cycle. And again, these cycles are fractal, meaning you can choose whatever cycle you're looking at based upon the time frame that you're making your analysis. The market finds support inside that previous cycle high, and we see it expand higher. Now that we have displaced above this CB, we must see that CB function as support and price. Why? Because it has to function as an inversion to value gap. The market utilizes that inversion to value gap as support and price and expands higher once more, displacing through this CB right here. The moment that it displaces through that CB, we must see that CB function as support and price because it must function as support on the right side of the curve. The left side of the curve determines how the right side of the curve is going to deliver. Eventually the market expands higher, takes out the original consolidation of the first time cycle and reaches the range high. This right here is a buy program from range low to range high completed. Pay attention to the fact that I outlined that we have those multiple time cycles here, and next that I've annotated the quadrants. Because if you pay close attention, what you can see is that we have a first quadrant, second, third, and fourth. When you pay attention to an example then on the charts, what you can see right here is the following. What you can see is that I have annotated first of all the 19,250 price level by this red line, and next that you can see that I've annotated the 19,500 price level. Meaning I'm operating within this quadrant range, within the 19,000 to 20,000 price range. What you can see is that the launch cycle delivered, we saw the market initially run higher and then drop towards the downside. Notice how the market spent some time around equilibrium, around 90,500. We saw the market then reprice lower. Consolidation is taking place, and notice that we saw the market reprice lower one more time. What is it drawn towards? It's drawn towards the launch low and the AM low in this case, but we're paying attention purely to the launch low in this example. And we see the market reach the 19,250 price level. Notice that throughout this expansion towards the downside, the south of the curve, we saw multiple imbalances get created. The first imbalance which I'm paying attention to is this imbalance right here. Next that I'm paying attention to this imbalance. And thirdly, I'm paying attention to this imbalance right here. Of course, smaller imbalances also form throughout this repricing lower, but for this explanation, I want you to purely focus on these imbalances right here. They are the most important ones. Notice that we see the market reprice below the 19,250 price level. We see the market spend some time there. Notice that eventually a low forms. We see the market displace back above that level. Now what's very important to note is that when it comes to these key levels, you're not going to see the absolute highs and lows always form at these levels. Meaning sometimes what will happen is that the market will drop just below the level and then form the smart money reversal. Or it will run just above the level and then form the smart money reversal. These levels are meant to gauge the order flow. Meaning they are meant to provide you with structure when it comes to price. Your job is to recognize when the reversals are taking place. But please keep in mind that the reversals can take place around the levels, meaning not exactly at them. And it's a very important insight to have, because I know that some of you are probably looking at this lecture, you think to yourselves, okay, every single time we reach this key level, I'm going to buy or I'm going to look to sell. No, that's not what I'm outlining. What I'm outlining is that the moment that you recognize that the reversal is in close proximity to this range low, to this level, you can anticipate that the market is likely going to draw towards the opposing side of the range, which is 19,500 right here. Notice that the market displaces through this CB, functions as support and price. Displaces through this CB as well after initially rejecting it, and we see the market reprice higher, taking out buy side liquidity resting above this high. Why oh why is this buy side liquidity pool important? I would like to pause the lecture for a moment and I want you to think about that. I know that some of you never pause these lectures and you're probably watching this series as if it's your favorite Netflix series, and and yet you're surprised that you don't understand the full logic which I'm outlining to you. You must investigate in great detail what I'm outlining to you. This doesn't come overnight. It's not like you are able to just watch the lecture and boom, there it clicks. No, it's going to take a lot of work and a lot of effort for you to be able to recognize these algorithmic signatures. However, once you're able to see this, you will never be able to unsee this. And that's what I want you to keep in mind no matter what. Will it be hard to understand this logic? Will it be challenging to get to this level of understanding? Absolutely. You're going to be faced with hardships. You're going to be faced with moments in your journey where you're going to feel like throwing in the towel. But it's your job to keep on moving forward no matter what. It's your job to keep on investigating. I understand that some of you might even have your head spinning right now whilst watching this lecture because I'm sharing so much information. I understand that you might even have a headache or something like that, but that is all part of the journey. And the reason why is because your mind is now processing all the information which you're being introduced to. And it's not going to click in one go. I'm 130% confident in that. It's not going to click right away. However, when you think about the logic which I'm introducing to you during today's lecture, whilst you're not even watching this lecture, so it means whilst you're, going about your day, maybe you're bringing your kids to school, or you're going for a walk, or you're at work, and you keep on thinking about the charts, and you keep on thinking about why price is stopping where it's stopping, or why it's drawn where it's drawn. When you start thinking about that right there, I promise to you, right here on the spot, you are going to experience light bulb moments. And when you experience those light bulb moments in which everything begins to click, that's when you need to grab a piece of paper, grab a pen, and start writing down what you just thought of. You could also cause these light bulb moments to take place by actually putting yourself in that environment, by forcing yourself to think. And the way you do that is by also grabbing a piece of paper with a pen and start writing down, okay, these type of schematics, which I'm showcasing during this lecture. Once you start looking for these algorithmic signatures, when it comes to these time cycles, when it comes to these key levels, when it comes to these PD arrays, and you start blending the three elements, it opens up a completely new dimension when it comes to viewing the financial markets. And it will be hard for you to speak to someone who doesn't understand this. And the reason why is due to the fact that this is hidden in plain sight, meaning these time cycles and these price cycles have been going on for decades, if not centuries, guys. You could be literally looking at charts from the 1800s or prior, and you'll be able to see these same time cycles and these same key levels being respected. Why? Because back in the day, this was the logic which was being used to manually reprice the markets. When the transition to digital markets took place, to electronic markets, algorithms took over, and these algorithms were coded to follow this logic. And that's what you're beginning to see, where there are objective rules in place, where these price cycles are fixed, they don't change, the prices are fixed. However, where the highs and the lows of these time cycles form is dynamic, and your job is to look for engineered liquidity. Yep. When it comes to why this buy-side liquidity pool in particular is so important, it's due to the following. What you can see is that this high right here formed inside of this CB on the left side of the curve. But do you see how the market just stepped that high right here during a 30-minute cycle? We see the market reprice lower, and eventually it runs higher one more time. Do you see how much back and forth going there is in this area? This is the engineering of buy-side liquidity which is taking place, because what you can see is that another 30-minute cycle high is forming right below the previous 30-minute cycle low. Therefore, retail money traders look at these highs as strong resistance, so to say. And therefore, what you can anticipate is that the market is going to draw towards this engineered buy-side liquidity when the time is right. When you pay attention to where these highs formed, you can see that they formed right in advance of this CB. This high actually formed inside of the CB. It just tapped it, IO-FET, and then we saw expansion lower taking place. But relative to the range, what you can see is that they formed in advance of the 19,500 price level. And therefore, this is perfect engineered buy-side liquidity. So let's pay attention to the bearish example then. Here we're at the bearish example, and what you can see is the following. What you can see is that this is simply the schematic of the bar program, but then in first, where you can see that the market reached the range low and it slowly began expanding towards the upside. This expansion lower which is taking place is rather slow, and the reason why it has to be slow is because it's inside of this slow repricing higher that liquidity is being engineered below these lows in the form of trendline liquidity. The market expands towards the upside, retraces, expands higher, a new time cycle opens up right here. A retracement takes place, and we see the market expand towards the upside one more time. Notice that the market forms a new high and we see a retracement taking place. Another expansion leg higher takes place and the market reaches the range high. A retracement occurs and the market then has one more push higher, taking out buy-side liquidity resting above this high. Notice that we see a rejection taking place and then we see the market displace towards the downside. Notice that we see displacement in the form of the creation of this CB, this bearish value gap. So I just outlined to you that on the left side of the curve there are imbalances within the buy programs. You can see that within the sell programs, I've now shown to you that there are imbalances on the right side of the curve which will form as well. Keep in mind that on the left side of the curve, there will also be imbalances. Now what you can see is that this imbalance right here shows to you that there's an urgency for the market to reprice lower. This imbalance gets created at this key price level. We displace through this price level right here. We displace below this low which set up this final run higher. And from this moment in time, you can anticipate that we're in fact in that sell program. Now, it's very important to note when it comes to the examples that I'm showing to you within these schematics, is that these schematics right here represent a specific logic. And your job is to look for the logic. Your job is not to paste this chart example on any chart that you might be looking at and specifically looking for this. Because sometimes the SMR is going to form exactly at your range high and it's going to just form the high here and then begin doing the displacement legs lower and basically beginning the sell programs. Other times you're going to see some correlating outside of the lines, and this is what you must allow for, where you would see that the market reprices above the range high and then eventually begins to roll over. See the market slam towards the downside and then a retracement higher takes place. Notice that a new time cycle opens up right here and we see the market displace lower once more. We see the market create a new CB and notice that we take out the previous cycle low, this red shaded line right here. A retracement takes place into that low, into this imbalance, and from this moment in time what we're monitoring is whether or not we're going to see this imbalance and specifically this low function as resistance from price. The reason why is because we anticipate that the market is in a sell program now. Therefore, we anticipate that every single displacement leg lower through a previous cycle low, through key levels, with the creation of PD arrays in the form of imbalances, is going to lead to further continuation lower. I hope that you paid attention to what I just outlined. See the market reprice lower and eventually it reaches the draw and creativity of this red line right here. We take out the original consolidation, which was right here, and this is your market maker sell model done. Now, what's very important to note again is the fact that within this schematic, I've put the imbalance on the right side of the curve to show to you that there are imbalances which will form on the right side of the curve. But please keep in mind that when we pay attention to the left side of the curve, there will also be imbalances. Here you can see an example of these ranges being applied to ES. What you can see is that throughout the second 90-minute cycle of the afternoon session, the market was being repriced towards the upside. Notice that it was in a rush to reprice higher, and you see that because the market is working through all these key levels to monitor. Notice that we see the market eventually create this sequence of imbalances right here. Notice them annotating both of them. And we see the market form the high of the second 90-minute cycle right here. A retracement takes place into that sequence of imbalances, and we then see the market find support there before expanding towards the upside. Notice that a 30-minute cycle low is being engineered right here, or is being formed, I should say. We see the market run up higher, and notice how it's going back and forth, and slowly grinding towards the upside. Eventually, the market reaches the 5,875 price level, and notice how it just steps above that level and immediately rejects it. It begins to slam towards the downside. Notice that the market is now repricing through all these key levels, where you can see that the market reprices through the 5,850 price level, random place where the PM2 high formed right, and we see the market begin this sell program. Notice that the market is now in a rush to draw towards sell side. Why? Because throughout this buy side of the curve, the market was drawn towards buy side liquidity. It was drawn towards old highs. It was being repriced higher. Throughout this run higher, which was rather slow, a lot of sell side liquidity has been engineered. So when the time is right, what icttrading will seek to do is that it will seek to go from buy program to sell program. And what you can see is that the market displaces through that 5,850 price level. Multiple imbalances get created, but the market is so bearish that it doesn't even retrace. It just simply reprices lower. It's drawn towards this sell-side liquidity pool of this 30-minute cycle low. Notice that we take that out, reach the 5,825 price level, retracement higher takes place, and we then see the market eventually displace through the imbalance, which I have annotated right here. And next to that, you see the market displace through this 5,825 price level. The market forms a new low and it retraces higher. Do you see how the wicks step above that 5,825 price level, reach the price range of that sequence of imbalances, this blue shaded box, and project it to slam even lower? What is the market drawn towards? The market is drawn towards those key levels below market price and towards the sell-side liquidity resting below the previous cycle low. Why? Because we took out the previous cycle high, and now the market is drawn towards the previous cycle low, which is right here. Eventually, the 5,775 level gets reached, and the market forms the low there before retracing. Beautiful sell program once again. So what you can see is that a buy program turns into a sell program, just like a sell program turns into a buy program. What I suggest you to do to investigate what I outlined during this lecture is applying these time cycles on your charts. You can utilize this time cycles indicator for that. Applying these price ranges on your chart. You can utilize the advanced price ranges indicator for that. Both are available on the mentorship platform, meaning as a student of mine, you can get access to these indicators. You can add them to your trading view and they will make the whole backtesting aspect way easier for you. And what I suggest you to do is then to start blending the two elements so that you're able to see, okay, where are the levels based upon the indicators it's plotting. It's doing that calculation for you, so it saves you a lot of time. And next to that, where are the time cycles, meaning where are these start and end of these time windows. And once you start paying attention to both time cycles as these ranges, I promise you that you're going to see a completely different side of the markets that you have never seen before. Once you start adding the PD arrays to that as well, you will see that determining drawing liquidity is a very straightforward process. I'm not saying it's easy. I'm not saying that you're going to get it right away, but I do promise that this is the only true way to come to objectivity when it comes to your analysis and perception behind the charts. With that being said, this lecture comes to an end. I hope that you found it insightful. As a homework assignment, I want to simply task you to get as many chart time in as possible. Try and get in as many chart examples as possible of this logic being applied, because this is what your focus should be on now. We're going to dive into the details way down the line, but for now, focus on this right here. Thank you for watching this lecture all the way to the end. I look forward to speaking to you soon again in the next episode. Be safe. Hello there, I hope that you are doing well. Welcome to this new lecture of the model series. During this lecture, I will be discussing points of interest with you. Methods to determine points of interest. The methods to determine the points of interest are exactly the same as the methods which I outlined during the previous lecture in which I explained the drawing liquidity. However, there are some subtle things which I would like to share with you during this lecture which are very important to note. First of all, we will be looking at PD arrays as points of interest. Secondly, we will be paying attention to time cycles as points of interest. And thirdly, we will be paying attention to key levels as points of interest. Now, before we dive into this lecture, I would like to share with you that it's very important that you have gone through the previous lectures and that you have studied them in depth. The reason why is because there's a sequence in which I'm explaining everything within this model series. If you are not following the sequence and you're simply just picking these lectures from lecture 1 to lecture 5, and then you go to lecture 2 or lecture 4, right? And then lecture 3, the whole sequence is disrupted. Meaning you need to make sure that you watch this series in the right order, because I'm explaining everything in a specific order. Now, what we will focus on during this lecture is the following. We will be focusing on determining point A. On the left right here, on the bottom left within a buy program, and on the top left within a sell program. Point A is inception of the new program. whether it be a buy program towards the upside or a sell program towards the downside. By utilizing points of interest, we're able to anticipate where point A will form, meaning where we're likely going to see the smart money reversal form. Point B represents the draw and equity. That's the terminus. That's the end of our basically anticipated program, whether it be buy or sell program. And that is where we begin with determining point B, with determining the draw and equity, and then we look at where the point of interest is. When we pay attention to PD arrays, I have shared the schematic which you see in front of you prior during the series as well. I'm just going to walk you through it quickly again. What I would like you to see is that in front of you can see the PD arrays matrix. This PD array matrix was created by the Inner Circle trader. Full credit goes out to him. And he basically shared this sequence in which all the price patterns which he has coined are presented. Meaning what you can see is that inside of any given dealing range, what you can see is that there's a premium side and a discount side. Below 50% is discount and above 50% is premium. What you can see is that inside of both the premium as the discount, his price patterns are forming. Whether it be, for example, the rejection block, whether it be the bearish order block, whether it be the fair value gap, the liquidity void, bearish breaker or bearish mitigation block, and the same for the discount arrays, but then in the opposing order. Now, when it comes to these arrays, it's important to note that we can blend these with time cycles and key levels to basically anticipate where swing points are going to form. And that is what I will teach you during this lecture. When we pay attention to an example of this taking place, what you could see is that on the left you can see a higher time frame chart of any given market, and on the right you can see the lower time frames. What I would like you to see is that on this higher time frame chart, what you see is that the market expanded towards the upside and it retraced lower. What did the market retrace into? The market retraced into a bullish fair value gap which formed throughout this expansion higher. What happens throughout this retracement lower is that sellers are being trapped into believing lower prices are next. Meaning a lot of sellers who look to go short place a stop loss above this high because they believe the high is in. What will the market be repriced into? It will be repriced into this old area of inefficiency, fill in the imbalance, so that the market is then allowed to expand towards the upside. What it looks like on the lower time frames is the following. On the lower time frames, it means that we're seeing a market make a buy model. Original consolidation, sell side of the curve into that higher time frame imbalance, followed by the right side of the curve. Now, when you pay attention to this framework right here, it's important to note that this is all fractal, meaning, as you can see, I haven't put in any time frames. I've not put in, oh, this is an hourly chart, this is a 1 minute chart. No, why not? Because on the left it could be a monthly chart and on the right it could be a daily chart. What I would like you to see is that I didn't put in a specific time frame for the higher time frame and the lower time frame. And the reason why is because everything is fractal. And therefore what you must note is that regardless of what time frame you're looking at, as long as you know what a higher time frame is and a lower time frame, you can anticipate where these swing formations are going to take place. And once you can anticipate that we're going to form a low inside that imbalance, what you can then look for is on the lower time frames for the sign of that market maker buy model to step in. When we pay attention to a chart example of this, what you can see is that on the left you can see a market which expanded towards the upside, and we then saw this large imbalance get created. Notice that the market retraced into that imbalance, and notice how we just stepped into the imbalance and immediately expanded towards the upside. What I would like you to see is that inside the delivery from this high to this low, to the moment that we tapped above the high right here, you see a lower time frame market maker buy model. That's what you see on the right. Where I see the sell side of the curve, which is very choppy. And then you see the market eventually turn around and draw towards the upside. This is the right side of the curve. Notice that we traded into that imbalance right here. We initially formed the low inside of there. We retrace higher, have one more push towards the downside, and then the market begins to accelerate towards the upside. And from that moment in time, the buy program is taking place. higher time frame expansion followed by a retracement followed by an expansion is a lower time frame market maker model. Keep that in mind. When we pay attention to another example then, what you can see is that on the left you can see the schematic of a bullish breaker, where you can see that the market expanded towards the downside, it ran up higher, it retraced higher, and we then saw one more leg towards the downside take place. Notice that the market displaced above the high, which set up that final run lower take place. Now what's important to note here is that the final run lower has to be in some form of point of interest, but that's something which we'll discuss way later within this model series. Notice that the market retraces into the price range of that bullish breaker, and we then see the market eventually expand towards the upside. Inside of the fractal of this retracement lower, followed by this expansion higher, you will see a lower time frame market maker buy model as you can see on the right. Why? Because inside of this retracement lower, what's taking place is that sellers are being trapped into believing that we're going to see lower prices next. Meaning, a lot of sellers are being induced into the marketplace. What icttrading will seek to do is that it will seek to reprice back into the price range of this bullish breaker, so that smart money is being given the opportunity to buy and position themselves long inside of the price range. That is why on the lower time frames you will see the sell side of the curve, followed by the buy side of the curve. Where will the buy side of the curve originate from? The buy side of the curve will originate from the price range of that bullish breaker. Now what you can also investigate is whether or not this bullish break on the higher time frames is going to be paired with imbalances throughout this repricing higher. Usually there's at least one or maybe even two imbalances which form throughout this repricing higher. Even when you look at the left side of the curve when we were dropping towards the downside, then you will see the market structure shift pattern as you know it. It's important to note that the expansion, retracement, expansion is a lower time frame market maker buy model. And you're probably going to hear me say that more often throughout this lecture, so buckle up for that. Here we can see a chart example of this. What you can see is that the market expanded towards the upside right here on the left, and we then saw the market drop towards the downside suddenly. Notice that the market took out an old low, shown by this horizontal line right here, and we see the market eventually form a new low. The market displaces towards the upside, and we see it reprice above this high right here. What I would like you to see is that we see the market form imbalances throughout this repricing higher. We see the market retrace and then have one more push towards the upside. Notice that the market eventually drops towards the downside, trading into this old high, and then the market expands higher. What I would like you to see is that as you've been taught to look at bullish breakers, you've been taught to look at the final up-close candle before the sudden drop lower to be the bullish breaker. However, what I'm about to share with you based upon what you can see in front of you is going to be something to think about. And the reason why I'm discussing this now is because I want to hide this within this model series. What I would like you to think about, right, is the following. What I would like you to think about is why is it the final up-close candle? If you would purely look for the final up-close candle, you would say, hey, the bullish breaker is down here, this big up-close candle. However, what I would like you to understand is that the price range from this high right here to this low is an imbalanced price range. And that means if they will seek to retrace back into this high so that price can be delivered in an efficient manner. That means that we can anticipate the retracement into that, followed by an expansion higher. But what is present here on even a lower time frame than this current time frame? Well, inside of this long wick, you will see that there are up-close candles inside of this high formation. And therefore, what I would like you to begin investigating is balanced price ranges more in depth. Notice that the market drops into the price range of that high, into this imbalance, and we then see the market expand towards the upside. On the lower time frames on the right here, what you can see is that the market expanded lower, reached that price level of that high, we tapped it, retraced higher, and then we saw the market have one more sudden drop before it began expanding towards the upside, drawing towards buy side liquidity, resting above the high of the retracement. Sell side of the curve, buy side of the curve. The next factor which we're going to take a look at is the bullish rejection block. This looks like the following, where you see the market expand towards the downside, and eventually you'll see a low formation taking place. Inside this low formation, you will see that there's a very long wick which will form. This wick will be extended to the right. And the reason why is because this wick is your bullish rejection block. We see the market expand towards the upside and we see it deliver higher. Throughout this delivery higher, what you can see is that the market hasn't retraced yet into the level of that bullish rejection block, into this red line. Therefore, what you can anticipate is that at one moment in time, the market is going to drop into that bullish rejection block. And when the market drops into this bullish rejection block, you can be looking for the signatures of a market maker buy model unfolding. Why? Well, the market expanded towards the downside into a point of interest and then it expanded higher. So what you can see is that the sell side of the curve got delivered, followed by the buy side of the curve. But within a bigger fractal from this low to this high, you can see that this is merely a retracement followed by an expansion higher. But when you look at it from a market maker model perspective, what you can see is that the sell side of the curve is being delivered into that bullish rejection block, followed by the right side of the curve right here. Now, what is important to note is that when it comes to the rejection block and the market maker buy model, which will originate from it, is the following. Intermarket relationship plays a crucial role when determining what rejection blocks are likely going to hold. Because what the other market is likely going to do is it likely going to take out this low, forming SMT, which we'll get to later within this model series. When we pay attention to a chart example of this, what you can see is that on this chart, what you can see is that the market expanded towards the upside and we saw a retracement taking place. Notice that the market traded into the price range of this very long wick, which set up the expansion higher. Notice that we have this large down close candle and notice that we have a very large wick right here. I'm annotating the close of this down close candle. The range between close to low is the bullish rejection block. Notice that the market expands higher again and we eventually see the market drop all the way down into the price range of that bullish rejection block. We take out sell-side liquidity engineered below this low and we eventually see the market expand higher with this big up close candle. Notice that the market reprices higher towards this high. When we pay attention to the lower time frame fractal, what you can see is that the market expanded towards the downside right here. Consolidation takes place. The market expands lower once more and we see time distortion taking place, where the market is simply waiting. It's waiting for the right time before that buy program is allowed to take place. Notice that the market goes sideways around the price level of the high of that rejection block and eventually we see displacement towards the upside. Notice that the market trades above the high, which set up that final run lower into the point of interest of that bullish rejection block. Imbalance gets created and we see the market retrace into that IOFET, institutional order flow entry drill, and the market expands towards the upside, drawing towards this buy side liquidity pool right here. Again, when it comes to looking at bullish rejection blocks, pay attention to intermarket relationship. When we pay attention to the bearish examples then, what you can see is that the market expanded towards the downside on the higher time frames, a retracement higher takes place, and we then see the market expand towards the downside once more. On the lower time frames, this looks like a market maker sell model, where I can see that the market expanded towards the upside, this is the buy side of the curve, and eventually it reaches the price level of that fair value gap based on the higher time frames. Notice that the market then expands towards the downside and it's drawn towards sell-side liquidity engineered below this low. A higher time frame expansion followed by a retracement is a lower time frame market maker model. Because it's a bearish expansion followed by a retracement higher followed by a bearish expansion, in this case it's a market maker sell model. In what does the retracement stop? The retracement stops inside of a bearish value gap which will have formed throughout the expansion lower. When we pay attention to a chart example of this, you can see the following. You can see that the market expanded towards the downside with this large down close candle and we see the CB get created. Notice that the market retraces above 50% of that CB and eventually we see the market draw towards the downside. When we pay attention to the lower time frame fractal, what you can see is that the market expanded towards the upside and was in a rush to reprice higher. Notice that the market eventually forms a swing high inside of the price range of that bearish or fire gap of that CB, and the market begins to displace away from it. Notice that it begins to reprice towards the downside. What is the market drawn towards? Well, the market is drawn towards sell-side liquidity resting below this low. Now, we will discuss market maker models more in depth later, and for now, we're simply going to focus on inception of these market maker models, and that is hopefully what you're beginning to see, where we can utilize a specific method for determining our draws on liquidity. We can utilize that same method for also determining our points of interest. And these methods are the same, meaning the same process applies for determining your draw on liquidity as it does for your point of interest. The variables are the same because every single entry is someone else's exit. Every single exit will be someone else's entry. And that is one of the most fascinating things which you can see on the mentorship form, where you can literally see students just go back and forth, buy, sell, buy, etc. over and over again. It's almost as if we're handing over positions to each other. And some of you are probably smiling because you have experienced that probably with me, where I would have taken a trade and you then took the opposing side of that trade later. Meaning I initially went long, targeted an old high. When the market reached that high, it turned around and you went short. And that is what we refer to as playing ping pong. And it's one of the most beautiful things to see because it shows you that there are plenty of opportunities when you understand both draw on liquidity selection as point of interest selection. When we pay attention to the bearish breaker then, what you can see is that the market expands towards the upside and it forms this high. We then see this sudden drop lower taking place. The market has one more expansion towards the upside before it rolls over. Notice that the market takes out the low, which set up that final run higher. We then see a retracement taking place into the price range of that low, and the market then expands towards the downside. On the lower time frames, this is going to be your market maker sell model, where I see the buy side of the curve and the market is being repriced into the price range of that bearish breaker, followed by the sell side of the curve, where the market is being repriced towards the low of this original consolidation, which is the low which set up that retracement higher. Now, when we pay attention to the higher time frames, it's important to note that this range right here is your bearish breaker. And when we pay attention to the lower time frames, you will see that inside that retracement higher, followed by the expansion lower, there's going to be a lower time frame market maker sell model. Now, as outlined within the bullish examples as well, pay attention to whether or not a fair value gap will get created throughout this run towards the downside. And pay attention whether or not there's also a fair value gap on the left side right here. Because if you see those fair value gaps paired with this breaker, then you can anticipate that we're likely going to see a strong rejection of that area, because that is my market structure shift pattern. When we pay attention to a chart example then, what you can see is that the market expanded towards the downside. We saw the market retrace higher and it formed one more expansion leg towards the downside. A low forms and the market expands higher. We see the market consolidate, time distortion is taking place, and eventually it drops towards the downside aggressively with speed and velocity. Notice that the market is drawn towards this low and eventually expands beyond it. Notice that this low right here is the low of an imbalanced price range. Why? Because what you can see is that we displaced through that low with this CB. And therefore what you can anticipate is that the market is going to retrace into that level, balance out the price range by offering buy side, so that the market can then continue towards the downside. And you might be wondering, balanced price ranges, what do you mean? You haven't explained that yet. What I would like you to start thinking about is why PD arrays work in the first place. When you start thinking about why PD arrays work in the first place, you become to realize that it's all to do with balancing out of specific ranges. And that is what we refer to as balanced price ranges. In this case, what you see is that south of the curve takes place, where you can see that the market is repriced towards the downside. And what's happening throughout this south of the curve is that sell side is being delivered. When we then see the market run up higher, we see the buy side of the curve being delivered. However, what's important to note is that we're not referring to a market maker sell or market maker buy model now in the sense of the traditional market maker model factors as you know them. No, we're simply looking at delivery functions, where you have two functions of delivery, either sell side or buy side. And what you see is that the market delivers sell side, buy side, and eventually it offers sell side through this low right here with this CB. And therefore what you can anticipate is that the market has to offer buy side into that again. Why? Because we saw twice sell side delivery and we saw once buy side delivery. Let me repeat that. Sell side, buy side, sell side. You might be wondering, why are you skipping through all of this delivery for accounting purposes? Because this is all time distortion. It's a relevant price action. Notice that the market displays us through that low with that CB. We retrace higher into that old low. Buys is being delivered. And notice how the market keeps on rejecting that old low. This is why breakers works, guys. It is all a result of understanding balanced price ranges. And yes, I promise that I will discuss them more in depth later within this model series. Now what we see on the lower time frames then is that the market expanded towards that red line, which represents that old low. And we then see time distortion taking place, where the market is simply consolidating and it's waiting. Notice how every single time that it reaches that red line is rejecting it. Eventually the market displaces below this down close candle, and we see the market begin repricing towards sell side liquidity resting below these relative weak lows. Original consolidation, buy side of the curve followed by the sell side of the curve. When we pay attention to the bearish rejection block then, what you can see is that the market expanded towards the upside and eventually forms this high right here. Notice that the market then reprices towards the downside quickly. What's important to note is that inside of this swing high formation, a high with a very long wick will have formed. What we pay attention to is the range of that wick and we extend it to the right. The reason why is because this is our bearish rejection block. We see the market consolidate for a while and eventually it has one more push towards the upside right here. It's inside of this repricing higher that the market is being driven towards that reference point of that rejection block. So what is taking place is that buyers are being trapped into believing higher prices are next, so that smart money can look to go short, meaning we need willing buyers that we can short against. What we see is that the market runs up higher and it then expands towards the downside quickly. Let us now pay attention to the bearish rejection block. What you can see is that the market expanded towards the upside and eventually formed a swing high. It's inside of this swing high formation that there will be a long wick which will extend to the right. Notice that the market repriced towards the downside and we eventually see it go sideways for a bit. The market has one more push towards the upside then into the price range of that bearish rejection block, and we then see the market expand towards the downside after forming a new high right here. Now what's important to note is that when it comes to looking at the reaction to this bearish rejection block, inter-market relationship plays a crucial role. What you can see on the lower time frames is that the market expands into the price level of that bearish rejection block, forms the smart money reversal there, and then the sell side of the curve unfolds. This is a lower time frame market maker sell model inside of this fractal where the market expands towards the upside, drawing towards that bearish rejection block, followed by a reversal lower. While we pay attention to a chart example of this, what you can see is that the market expanded higher, formed a high. Do you see this long wick? I'm extending that to the right. Notice that the market drops towards the downside, and we then see the market form a new low before the market reprices higher. Notice that consolidation is taking place in advance of that rejection block. The market expands higher, drawing towards the low of that bearish rejection block. And notice that the market takes out buy side liquidity resting above this high. And we see the market eventually roll over. What is taking place here? Well, inside of this final run higher, followed by this reversal, followed by the sudden down close candle right here, you will see a lower time frame market maker sell model. When we pay attention to the lower time frame chart on the right, what you can see is that the market consolidate for a bit and it slowly began expanding towards the upside. Then speed and velocity got induced into the marketplace where the market began expanding higher quickly. Notice that we engineer buy side liquidity right here and we then see the market drop towards the downside. Notice that more relative weak lows are being created and the market then runs up higher, drawing towards the low of that bearish rejection block. Notice that the market is in a rush to reprice higher. Eventually, it reaches the price level of the low of that bearish rejection block, and we then see the market begin rolling over. Buy side of the curve, sell side of the curve. What is the market drawn towards? It is drawn towards sell side liquidity, resting below the lows, which set up that repricing higher into the point of interest taking place. Notice that from there, the premium array matrix forms on the right side of the curve beautifully. The next method of determining points of interest, which we're going to take a look at, are time cycles. When it comes to time cycles, it's important to note that you have watched the prior lecture on the topic in which I outlined what time cycles exactly are. If you did not watch that lecture yet, I highly suggest you to stop watching this lecture and go back to that previous lecture. When it comes to time cycles, it's important to note that we have a specific high, which is represented by this green line, and a low, which is represented by this red line. These highs and lows will form during specific windows of time. When it comes to time cycles, it's important to note that time cycles, their highs and lows, are dynamic. You might be wondering, dynamic, what does that mean? Well, that means that the time cycle high and lows change for any particular time cycle as time progresses. Meaning, if we are paying attention to the following chart example, this could be Monday's morning session, where the high of the morning session formed right here at this price level, and the low of the morning session formed right here at this price level. And notice that I've not written out what these levels are, because you can just put in any number, doesn't matter. What I'm about to share with you is why these highs and lows are dynamic. When we pay attention to the next day, Tuesday's morning session, you can see that the high and low of that morning session have changed, meaning both levels have moved towards the upside. You might be like, what is the significance of this? Well, the significance of this is that you can see that the engineering of liquidity is taking place around different levels. And keep this in mind moving forward. What we'll be looking for when it comes to time cycles is mainly the following. We will be looking at a purge and revert taking place, where if bullish, we are going to look for an open low, where the market is going to open low, taking out sell side liquidity, resting below the previous cycle low, followed by reversal higher to draw towards the previous cycle high. This takes place in bullish markets. If we pay attention to a bearish example where we're anticipating lower prices, we'll be looking at open high, where the market will seek to open up, run up higher, taking out the buy side liquidity resting above the previous cycle high, followed by a reversal towards the downside, drawing towards the previous cycle low. It's in this process where the market takes out that previous cycle high or that previous cycle low that you must understand that this is manipulation which is taking place, where the final manipulation leg is taking place before the reversal will unfold. Now, this is the most important framework to understand when it comes to time cycles, because time cycles represent fixed windows of time in which highs and lows will form. When you start paying attention to these highs and lows and you start extending them to the right on your charts, you will be able to gauge the order flow in a very objective manner. When you pay attention to a chart example, what you can see is that I've annotated the previous PM session low and the previous PM session high right here. Note that the market expanded higher throughout this afternoon session. We then saw the Asia session consolidate right here, and we saw London open up. London runs higher initially, but notice that it just falls short of the high of Asia. Meaning, instead we see more buys to be engineered above these highs right here. We then see the market drop towards the downside, and we see it drop below the Asia session low, which is this low. And we see it drop below the previous afternoon session low, the previous PM session low. Eventually the market forms a low here during London, and the market begins to expand towards the upside. What is it referring to? Well, first of all, it is referring to the buy side liquidity engineered above these highs right here as a first objective. And secondly, what it's referring to is the previous PM session high, where you can see that we opened low for the afternoon session, and we then saw the market take out a previous cycle low in this case a previous PM session low, and we then saw a revert taking place towards the upside, drawing towards that previous PM session high. Purge and revert. When we pay attention to key levels, however, what I would like you to understand is that key levels are fixed. The next chart example which we're going to look at is the following, where you can see that throughout the green box the market initially consolidated, and we then saw the market begin to reprice towards the upside quickly. Notice that eventually it began to slow down and it began to have a grind towards the upside, where you can see it's just going back and forth, slowly grinding towards the upside. Notice that eventually the high of the green box forms, and the green box is representing a 30-minute cycle for your info. I'm just referring to the green box so that you can visually see it. And the reason why is because of the following. These time cycles are basically the same across all different time cycles, meaning across the bigger time cycles, across the smaller time cycles. The logic is always the same. So as long as you know that these boxes represent time cycles, you can analyze why the market opened up higher throughout the next blue box, took out the previous cycle high, and then reverted towards the downside. Why? Because you understand that we are seeing an open high, taking out the previous 30-minute cycle high in this case, followed by a reversal drawing towards where? The market is drawn towards sell-side liquidity engineered throughout that previous cycle. Where is the sell-side liquidity engineered? It's engineered below the previous cycle low, below the previous 30-minute cycle low, which was the low of that original consolidation. And this is what's important to note. These market maker models are not simply price patterns. They're not price patterns that you just put on your chart and that's it. No, what you must understand is the logic behind inception to terminus. And that right there is where the true light bulb moments will take place. Now that we have discussed time cycles, we're going to be discussing key levels. When it comes to key levels, you must note that key levels are fixed. And the reason why I'm mentioning this is due to the following. The reason why I'm mentioning this is because key levels are fixed levels, whereas the time cycles, their highs and lows, are dynamic. The time cycles, their highs and lows change, meaning their price goes up and down. However, when it comes to these key levels, they remain the same regardless of what price did in the past, or regardless of what new time cycle is opening. It doesn't change. Meaning, we always have a specific range in which we have 4 quadrants. That is a very important insight which I want you to keep in mind, because there's a big difference between key levels and time cycle highs and lows. I would like you to think about the following question. When do key levels become significant? If you would like to pause the lecture to have a good thought about it, I really suggest you to do so. And the reason why is because that way you're able to think before I provide you with the answer. And I know that the majority of you are probably not going to pause the lecture, you're probably already skipping ahead. But yeah, in order for you to have crazy light bulb moments, you must be able to think for yourself and then compare that to how I'm about to explain it to you. Key levels become significant when they get blended with the element of time. It's time then price, meaning time without price means nothing, just as price without time means nothing. But when we when we blend the two elements, that is when we can anticipate what's likely going to happen next. When we pay attention to an example of this, what you can see is that I have put on time cycles and key levels. What you can see is that we see the market expand higher, originating from the 20,900 price level, which you can see right here. Notice that the market is repricing towards the upside and eventually it forms a high. This high gets formed right here. Notice that the high forms in advance of the 21,000 price level, which is our key level. We see the market then open up the new time cycle, represented by this vertical line, and notice that the market reprices higher. We see open high taking place, where the market takes out buy-side liquidity resting above this previous cycle high, and it reaches that key level which we are monitoring. But how do we know that this is our key level? Well, based upon those mathematical calculations, we already know that this is a key level no matter what. But what tells us that we're likely going to see clean delivery taking place afterwards is when we see buy side being engineered in advance of it. And that is how you can utilize the time cycles and the key levels to anticipate market swings. Meaning, what you can see is that open high takes place where that previous cycle high gets taken out. By itself, that's already a point of interest. However, when you start blending that with these key levels, you begin to become able to anticipate when and where swings are likely going to form. And next at what you could be looking at is, for example, a higher time frame array, which would have formed in the past. Think about PD arrays. We then see the smart money reversal taking place, and the market is displacing towards the downside. Notice how the market is being repriced lower, and it's drawn towards the 20,900 price level. Now, what is important to note is that when it comes to this delivery lower, what you will see is that premium arrays will get created, meaning the market will displace towards the downside and imbalances and such will get created. It's inside of these premium arrays that shorting opportunities will present themselves. However, what I would like you to investigate is where these PD arrays are forming. Think about these key levels. Let's take a look at the chart example. Here we are at the market of gold, and what you can see is that I've plotted the current range. The range that price was in was from 2700 to 2675. Notice that I'm utilizing this quadrant right here of 75% of the bigger range of 2700 to 2600. I'm utilizing the 75 level as the range where we're currently in between 75 and 100. The reason why is because these quadrants themselves also are particular ranges, because inside of these ranges you're also going to see that there's a equilibrium level. There's also going to be a 50% level. And what you can see is that equilibrium of this range is right here at 2687.5. Now what's important to note here is that what you can see is that this might seem like a pretty random level when it comes to what the price is, since it's not a full 100 number. However, what you must understand is that in any given range which you're monitoring, there's always an equilibrium level. And equilibrium by itself can also function as a rejection level. So the next time when you start looking at these liquidity pools which are engineered, pay attention to whether or not it's in close proximity to equilibrium of a bigger range. Ideally, you would like to always see it be at a full 100 number. However, sometimes what you must see is that the market will form that higher low in advance of either equilibrium of any given range or even a quadrant. And that is what I'm about to show to you. What I would like you to see is that throughout AMA, this blue shaded box, the high forms right here in advance of equilibrium of this range. And notice that the low forms in advance of the range low, in advance of the 75 level. Notice that the market runs up higher then and comes to very close proximity to that equilibrium level. Notice, however, that a new time cycle opens up and the market opens high, and we then see the market drop towards the downside. Why does this occur? The reason why is due to the following. We open high, take out buy side liquidity resting above the previous cycle high. We reach equilibrium of that bigger range which we're in. Notice that we just go above it and we then reprice towards the downside heavily. We reject it. Why does this occur? The reason why this occurs is due to the following. What happened was that liquidity was engineered in advance of equilibrium right here, but also in advance of the range low right here. And therefore what you can expect is that the market is likely going to reject equilibrium and draw towards the downside. Why? Because this is perfect engineered sell side. Run the high, run the low. So what I'm looking for actively when I come to the charts is I'm looking for liquidity to be engineered. When does liquidity get engineered? Through time. And that is why we blend both these time cycles with these key levels. We're now going to be paying attention to the bullish example of the time cycles and the key levels. What I would like you to see is that this example is exactly inversed from what we looked at within the bearish example. However, what you can see is that we're now looking at different prices right here, where I can see that we're looking at 105 and 106 to be a range low and range high. When we pay attention to the bullish example, the most important thing to understand is open low. Keep that in mind. What we see is that the market expands towards the downside right here. And the market is in a rush to reprice lower. Notice that we eventually form a low and the market then retraces higher. What is happening right here? Well, what's happening is that sales liquidity is being engineered below this low. When do we retrace higher? When a new time cycle opens up. So what's happening here is that people are being led to believing that the low is in and it's now time to run up higher. However, the market has yet to reach the key level of 105, meaning it has yet to reach this price level where the low should form after taking out a key time-based liquidity pool. Meaning in advance of a key level, you can see that time-based liquidity has been engineered right here. So what we will look to see take place is the market to drop lower to take out the previous cycle low, reach this red line right here, and from there we will be monitoring whether or not a buy program is going to unfold. All throughout this delivery on the left, you can see that the market is drawn towards the downside. But eventually, once the signs become present of a low formation taking place, that is when we can anticipate that the right side of the curve is going to take place. What is the market drawn towards? The market is drawn towards buy side liquidity engineered throughout the previous cycles, so throughout the highs which will form throughout the previous cycles, and it will reach price towards all of the highs which have been engineered in advance of these key levels. Now again, keep in mind that when it comes to these key levels, it's important that you blend them with the time cycles. Meaning, pay attention to where a previous cycle low is within a bullish example, and pay attention to what key level is near. The reaction to that key level will be very telling, because if price would not show the signs of forming a low at this level and will just displace through it, then we're likely going to see further continuation lower taking place, and then you will not see the reversal taking place. However, when you see the signs of that reversal taking place below that previous cycle low, whilst you're bullish on the higher time frames, that is when we can look for our buying opportunities to present themselves afterwards. When we pay attention to a chart example then, what you can see is that the market expanded to the downside right here, and notice that we eventually form a low right here. We then see a new time cycle opens up, and the market is just consolidating around 20,450. Notice that eventually we see the market run up higher, forming the high of this time cycle, and we then see the market drop towards the downside. Notice that the market takes out sales liquidity resting below that previous cycle low, and we then see a retracement higher taking place back into the 20,450 price level. Do you see how the market rejects this level right here? We then see this sudden drop towards the downside, and notice that that drop gets completed when the new time cycle opens up with this green shaded box. Why is this important? Because what's important to note is that in advance of the 20,425 price level, what you can see is that the market formed this low. Therefore, sales liquidity has been engineered in advance of that level. When the new time cycle then opens up and drops lower immediately, that is a purge of sales liquidity, which could potentially be in play. However, what confirms to us that this is a purge of sales liquidity and not just a sweep to continue lower is when we displace higher. It's a very important understanding to have. There's a difference between the word use in terminology of sweeping liquidity and purging liquidity. Sweeping liquidity is when the market takes out a key liquidity pool, and from that moment in time, we have swept the liquidity. However, what confirms to us that this sweep is in fact a purge of liquidity is when we see the market begin displacing higher. Because that shows to you that liquidity has been purged and that smart money has now positioned themselves long. What is important to note when it comes to these key levels is that they are not always going to be respected to the tick perfectly. Meaning sometimes you must allow for the market to simply move beyond them a bit. Meaning when the market just goes below this horizontal line, which represents the 20,425 price level, you're not thinking to yourself, okay, it's going to continue dropping, it's going to continue dumping. No, you're still anticipating that low formation to take place. These key levels are here to provide you with structure behind your analysis. Same with these time cycles, highs and lows. And the reaction to them will be very telling. So what you see is that we open low for this new time cycle, purge sells liquidity, reach this key level, and eventually we see the market displace towards the upside. Do you see where this imbalance forms? Throughout the repricing through that key level. Imbalance forms, market retraces into that buying opportunity, and then the market expands towards the upside. Whilst the market run towards, first of all, it's run towards that 20,450 price level and the buy side liquidity which is engineered around that. So for example, this previous cycle high, purge previous cycle low, refer towards previous cycle high, and eventually we see the market run up even higher, drawing towards that 20,475 price level. Do you see how the market retraced into this very large imbalance right here? This imbalance got created whilst we repriced into that 20,450 price level. This is equilibrium of the bigger range, by the way. Market retraces into that, and as long as that does not get displaced below, you're still anticipating continuation higher. Market forms a new low here, and what do you note? Hey, expansion higher, followed by retracement lower, followed by expansion higher. So what will be present right here? This will be a lower time frame market maker buy model. Do you see how I just blended everything with each other? This whole lecture? Yep. Beautiful, isn't it? We see the market expand towards the upside and it's drawn towards the 20,475 price level. And that is the trade idea done. Summary. What I want you to investigate is I want you to investigate the following. I want you to investigate liquidity being engineered in advance of key levels. When you start paying attention to the higher time frame PD arrays as well, that are in close proximity to these levels, you'll begin to see repeating signatures there. And that's something which I'm going to give to you as a homework assignment as well. As a homework assignment, what I would like you to do is I would like you to find 15 examples of price reaching a point of interest based upon either a higher time frame PD array, time cycle, or key level, and price rejecting it. Meaning, I would like you to begin training based upon a higher time frame chart, your ability to recognize what points of interest are. Once you're able to recognize what points of interest are and you're able to see these rejections taking place, you must understand that on the lower time frames, market maker models will present themselves. I want you to log both the higher time frame as the lower time frame chart. Meaning, I want you to save both a screenshot of the higher time frame as the lower time frame chart. So for example, an hourly and a 1 minute chart, and would like you to annotate them as in-depth as possible. Meaning, be sure to fill in all of the blank areas on your chart with text or with symbols, etc., showing what you're seeing within the markets. Keep in mind, blending the different elements leads to more significant POI selection. And that is what I would like to end this lecture with. Meaning, your focus should be on blending all of these different elements which I have outlined to you during this lecture when it comes to points of interest selection. Because once you start blending all these different elements, you will see exactly where these turning points are forming. And that is something which you can only find out by investigating on your own. So now it's time for you to go into the charts and investigate what I outlined to you. I want you to go into the charts with an open mind and I want you to investigate everything which I explained to you during this lecture. I want to thank you for watching this lecture all the way to the end. Good luck with your studies and I look forward to speaking to you in the next one. Be safe.
I hope that you are doing well. Welcome to this new lecture of the 2025 model series. This lecture is in a bit of a different format than what you're used to within this series, and the reason why is because I want to create a raw lecture for you in which I share with you how to actually investigate what I've taught so far. I've taught a lot already within this model series, and therefore it's important that you do not forget about going into the chart yourself and actually investigating what I've outlined. However, I understand that can be quite tricky, and therefore I want to give you some examples of how you can actually go into the charts and investigate everything which I've taught so far, but also log it. Therefore, I'm going to be using the opportunity logging tool, which has been provided within my mentorship. I will share with you where you can claim access to it. You can claim access to this Notion database, which I'm going to show to you now right here. You can claim access to it by going to the
description, and you're able to see a link there. If you press on that link, you'll be able to find the steps to copy and paste this Notion, and we're going to be using this Notion to just basically outline some opportunities, and so that you're able to get a grasp of how I'm actually going into the chart myself and how I actually backtest myself. Now, when it comes to backtesting, what a lot of people do is they utilize the replay tool, and they place the replay to wherever, and they just go candle by candle, and they try to basically predict what's going to happen next within delivery that has already occurred, right? I'm sure that some of you are probably like, damn, you just nailed me. Yes. However, I do not believe that that's an effective way of backtesting. And the reason why is because your goal throughout backtesting is to train your eye to see algorithmic signatures. It is to train your eye to see these repeating phenomena within the delivery of price. Therefore, your job is to play a volume game where you're able to say, okay, I'm going to get a lot of examples of these same algorithmic signatures taking place, and therefore I know that this is what's going to happen next when I see a similar situation in the future. Meaning, my opinion of backtesting is that backtesting should merely function as a data collecting tool. Meaning, all I want you to start thinking about when you come to the charts with the desire to look at historical market data is to train your eye to improve your ability to see these signatures within the delivery of price, so that in the future when you're looking at the live markets and you're looking to tape read or you're looking to demo trade, that you're able to recognize them. And therefore I'm going to show to you how I go about this. So first of all, my main objective is the following. My main objective is to determine what the high time from institutional order flow is. Over these past couple of months, we have been bearish on the indices, and in front of you, you have the daily chart of the Nasdaq, by the way. Because we have been bearish on the Nasdaq, what it means is that we have been looking for lower prices, and therefore we are going to be looking at shorting opportunities which present itself throughout this repricing lower. You might be wondering, how do you know that the institutional order flow is bearish? How do you know that the market was being repriced towards the downside? Well, there's a lot which we can discuss in order to confirm that we were in a sell program. But for now, I would like you to understand that when we pay attention to this delivery here, what I would like you to see is that on the bottom right here, we see time. And what this represents is it represents basically the months. Because in front of you, you have a daily chart, and you can see that we have January, February, March, April. Yes? My eye is immediately always drawn to where are the previous month's high and the previous month's low. I'm just going to show you where the January low is. The January low is right here. And when we pay attention to where the January high is, what I would like to see is that the January high is up here. Throughout the month of February, which opened up right here, and by the way, I walked you all through this live in real time when the market was delivering, so don't think, oh, he's just sitting in hindsight. No, if you paid attention to the market reviews at the time, you will have seen that I literally outlined this full sell program before it occurred, targeting sell-side liquidity pool objectives. But what I would like to see is that at February, we opened up, ran up higher, took out January high, but did not utilize the January high as support on price. Eventually, the market rolled over inside of this box right here. And I have severe OCD, by the way, so I need to make sure that everything is just clean, and that is what you will notice. So I apologize that this is going to be a very raw lecture, but I hope that you will find great benefit in seeing how I'm actually coming to the charts and actually basically going about my day-to-day process. Because this is so important that these small little details get investigated. So what I would like you to see is that the market failed to utilize the January high support and price, rolled over. What is it drawn towards? Well, the market is drawn towards the January low, which is right here. Notice that we slammed through that low with this big downward candle, and we then see something get created right here. What gets created? We see a CB get created. We can extend this CB to the right here. And the reason why is because as long as this CB functions as resistance from price, we are bearish and we are expecting lower prices to come in. But when you pay attention to the January low, the candle itself, what you can see is that I can extend that to the right as well. And what do you notice? We expanded below the January low. And do you see how we retrace into the higher end of the January low? We wick above it, but notice that the bodies keep on closing inside of this. this shows to you that a continuation model is in play. Where at first we saw a purge and reverse from January high to January low, we are now seeing continuation taking place. And when you see continuation taking place, you can anticipate that we're going to see further repricing lower. See the market expand towards the downside, and what I would like to see is that every single premium array which got created functioned as resistance from price. And that is a crucial insight which I would like to share with you. Now, what we see eventually is that the market expands lower and it slowly begins to grind towards the upside. We see a retracement taking place into equilibrium of that monthly range up until that point. We see SMT get established and the market expands towards the downside. Notice that we see this large dayeqt get created. We see the market retrace into that dayeqt and then expand towards the downside. So now that we have defined that the underlying order flow has been bearish, what I'm going to do is I'm going to press right here on the top right where it says this screen, the camera, my bad, sorry. And I'm going to press on take a snapshot. I'm going to press on copy image and I'm going to go to the Notion tool. And what I'm going to do is I'm going to create a new page right here. And this new page is going to be filled with the opportunities which we're going to log now. I'm going to copy paste the image which I've just collected. And this is the daily chart of Nasdaq. The next chart which I'm going to log is the hourly chart of Nasdaq. So when we go to the hourly chart, the next chart which I'm going to log is the following. When we go to the hourly chart of Nasdaq, what I would like you to see is that when we pay attention to this past week's delivery, it's important to note that we have seen a trending week where the market initially opened up, ran up higher, and eventually it began rolling over. When we pay attention to this week, I would like you to understand that literally every single swing point right here was absolutely algorithmically driven, meaning every single swing point was anticipated. And that right there is something which I want to show to you. And that's what we're going to be looking at during this raw lecture. All right. First of all, let us begin with Monday. On Monday, I outlined that I would be monitoring the 90,000 price level. The 90,000 price level was my objective that I anticipated price to draw towards. You know what? Let's actually do it fully how I'm doing it when I'm actually going through logging all the charts and such. What I do is I place the replay tool right here on the day itself and I go to the APR indicator. And what I actually do is I place the ranges right here on 1,000 because we're looking at Nasdaq. And then I have the ranges. What I would like to see is that we saw the market stop right in advance of that 90,000 price level when we formed this low right here. So we engineered sell-side liquidity right here. We saw the market consolidate for a while and we saw it go back and forth, back and forth, back and forth. Eventually the New York morning session opens up and we see the market begin to expand towards the downside. Notice that the market reaches that 90,000 price level, we just step below it and we then form a low and begin expanding towards the upside. Now, when we pay attention to a swing formation like this, because that is what our focus is going to be on, recognizing market swings, it's important to note that we pay attention to time cycles and price cycles, and we could even look at PD arrays, but in this case, I do not need any PD arrays because we're at levels which have been met a long time ago. We have to go far back into the past before we could even see any arrays, and therefore it's simply not worth it looking at the arrays. Simply focus on the time cycles and key levels. But what I would like to see is that we see liquidity be engineered in advance of what? In advance of that 90,000 price level right here. What low is this? This is the Asia low. When we pay attention to where the London low formed, what I would like to see is that the London low formed right here. So the London low also formed in advance of that 90,000 price level. So what exactly does New York do? Well, what New York does is that it opens low, drops into this 90,000 price level, and this full leg, which I'm outlining now from the New York Open, which takes place at 7 a.m. to the absolute low, which forms, that right there is manipulation which is taking place. We just wick below that 90,000 price level and we see the market eventually expand towards the upside, drawing towards the new week opening gap, which is right here. What I would like you to see is that inside of this delivery, there are a few things which you can recognize from that RE chart already. You can recognize the engineering of liquidity, you can recognize the influence of time cycles, and you can recognize where manipulation is taking place. So what I'm basically going to do is I'm going to outline this to be the Asia low, and I want you to keep in mind that the London low is right here. And I'm going to save this chart, and we're just going to stick to the hourly chart, by the way. I'm just showing to you how you can recognize these opportunities on the higher time frames at first, where you can short into that 90,000 price level like I did, and you can also buy afterwards like I did as well, because that is the power of this information. I'm not saying that you should go out here and trade based upon this information. I'm just sharing with you my thought process and my logic. And this is a real raw insight on how I'm actually doing so. So what we're then going to do is we're going to type H1 hourly and we're going to log that. And the reason why we're just going to stick to the hourly chart is because I want you to understand that based upon the hourly chart, you can already see these moves taking place. Meaning, all you need to define is you need to define where the draw on liquidity is and where the point of interest is within a trending market. So what we're going to do is we're going to log the date. This date was the 31st of March. The day was Monday. Market was Nasdaq. Session was New York AM, since looking at that opportunity. Newsday, we would have to go to the Forex Factory and actually check whether or not there was news on that day. SMR time, we're not going to log now. SMT, we're also not going to log now. We're simply focusing on everything which we can look at from the hourly chart. If you are familiar with these variables above and you have already studied the 2024 model series, then I suggest you to just go into the lower time frames and investigate them. But for now, we're focused on the following. We're focused on the draw on liquidity and the point of interest. Now, here it's interesting to note that the draw on liquidity could be that 90,000 price level for the sell program, and it could also be, for example, the buy liquidity pool for that buy program afterwards. But for now, what we're going to do is we're going to log simply the sell program. So the Asia low was the draw on liquidity, and what was the objective? The objective was the range low, and this is something which I did not put in the Notion database at first when I released it. Point of interest then, well, the point of interest when we pay attention to this delivery right here is what? Do you see this 19,250 price level? Do you see 25% of this range? Do you see how the market opened up, went higher, and then eventually formed the high of London around that area? That right there shows to you that this is the A to B which is taking place. A to B. That's a very bad A and it's a very bad B, but I'm using the wrong drawing tool for this. But that's the A to B. Eventually B turns into A. So what you can see is that you can simply play this range back and forth until we displace outside of it. You know what? Since we're doing it all right now raw, no, I'm not going to save that one. It's clear. And some of you probably already clicked off, so they wouldn't have understood that. Doesn't matter. All right. Point of interest is going to be the 25% of the range. And the entry pattern, etc., we're going to leave out. However, what I want you to pay attention to is the following. I would like you to pay attention to what the sessions did. And the reason why is because this is a very important thing to log when it comes to daily delivery profiles. The Asia session was a consolidation because the market was simply going back and forth. The London session was also a consolidation. However, the morning session was an expansion. Meaning, what you can see is that when we pay attention to the chart, what I would like you to see is that throughout both Asia as London, the market didn't really do anything. It just went sideways. Meaning, you can see that it just consolidated. We then, however, see the London session also consolidate. The New York morning session expands towards the downside. But hey, a consolidation followed by an expansion into a draw on liquidity, into a POI, could be manipulation to do what? to then reverse and expand towards the opposing side. Expand lower, expand higher. Shorting opportunities, buying opportunities. So what we're going to look at then within our database is the following. What we're going to be looking at is both a market maker sell model as market maker buy model. So technically speaking, we're doing two looks at once now, where you could short into that 90,000 price level and you could look to go long from there. Meaning this is a short, this is a buy. And both are valid. So therefore, we're simply going to lock just one for the sake of simplicity. However, I would like you to understand that you can lock both opportunities here. And eventually, what is possible is that as we proceed with the future parts of this model series, I will show you how to lock more specific variables as well within these databases. And we might actually add some variables here and there. What I'm just going to do is I'm going to type out range high as well. And the reason why is because that's an important lock. And next at point of interest, also 75%, range low, range high. Now, when we pay attention to the charts again, what I would like you to see is the following. What I would like you to see is that we saw the market expand higher from that 90,000 price level. I'm just going to remove my drawings because we're going to continue to the next block. I outlined throughout my review on Tuesday on this day that I anticipated that as long as we would not see the market displace below this, we see right here, I would anticipate that we would likely draw towards the upside. What was my eye drawn towards? Well, my eye was initially drawn towards the 90,500 price level right here. And the reason why is because what do you see? You see that we stopped on Monday right in advance of that level. And therefore what you see is that this is engineered buy side liquidity. So what I'm looking for is the following. I'm looking for the market to expand towards that level. And what do you see here? Do you see how the market repriced higher, drawing towards that buy side liquidity pool, reaching that 90,500 price level and then rejects it right here? This right here shows you that buying opportunities present itself throughout this run higher, that shorting opportunities present itself after. And again, because the hard time from institutional order flow is bearish, I'm more interested in the shorting opportunity. And therefore what we're going to do is we're going to be looking at this delivery and we're going to be logging it within our journal again, within our database. What I would like to see is that we see the market expand towards that previous day high, which is right here, throughout the London session. We see the market eventually take out previous day high, and we see the market reach that 90,500 price level. Do you also see how the market reached a daily CB by doing so? Because remember on the daily chart, this was the daily CB which I had outlined. When we pay attention to the hourly chart then, what I would like you to see is that the market repriced higher, taking out the previous day high, reaching the daily CB, reaching the 90,500 price level, forming daily SMT with a yes, and then repriced towards the downside. What do you see? You see a perfect swing high formation, and therefore on the lower time frames, this is a market maker sell model which is present, and specifically within these three candles, but maybe I'll discuss that later. Therefore, what we're going to focus on is the following. This whole run higher, I'm just going to make that annotation. Whole run higher right here is all manipulation. And therefore that run higher is all the engineering of sell side liquidity. They're trapping people into believing higher prices are next. And they're actually making them believe that they should go long on the market now, engineering sell side liquidity, so that when enough buy side liquidity has been taken out, we will revert towards sell side liquidity. So what we're going to do is we're going to copy this image and we're going to go back to the Notion. And what we're going to do is the following. I'm simply going to put right here that this is log number 2, because what you can see is that we also put numbers here. And the reason why is because I want you to start keeping track of how many logs you're actually doing and how many chart examples you're actually getting. So this day was the 1st of April 2025. It was Tuesday. The session was the London session. Market was the Nasdaq. Mmxm, market maker sell model. News, we would have to check that on the Forex Factory, which we're not going to do today. If you want to fill in this news day right here, always go to Forex Factory for your historical logs and find whether or not there was news on the day. SMR time, we can also ignore for now next to SMT. Well, you know what, I already mentioned that there was SMT with ES, so I'm just going to log it. And the draw liquidity in this case was the following. The draw liquidity was sales liquidity, which was engineered throughout this repricing higher. Meaning, therefore, we can say that the low which we were targeting was the current London low up until that point. Because what we can see that occurred is eventually that the market actually expanded even lower, creating a new daily low. So therefore, draw liquidity, London low, and we could also argue that the Asia low was the draw on liquidity, because that is what price was drawn towards. When we pay attention to the delivery, what I would like to see is that when we play the delivery just a bit forward, eventually the Asia low also gets taken out right here when this 10 o'clock candle opens low. However, ES already took it out prior, and that is why the SMT detector also showed you SMT there. And therefore, Asia low was the draw liquidity, but failed to get reached on Nasdaq within the same period of time as on ES. But what we're going to do is we're going to say, okay, London low, Asia low, and imbalance. Think of that RE imbalance. All right, so when we pay attention to the point of interest, then the point of interest in this example was the following. First of all, it was the previous day high, as we had mentioned. And next to that, it was equilibrium of the range, meaning 50% of the range, 90,500. What I would like you to understand is that when we pay attention to when that previous day high formed, we can also pay attention to the time aspect. What I'm then looking at is I'm looking at the exact hour that this high formed, and that was the 3 p.m. hour. Therefore, this is the high of the afternoon session. So what I'm going to do is I'm also going to log that right there, meaning I'm going to log that it was the PM high. Like this, PM high. And I'm also going to type out PM low, because that wasn't in this database yet, and I apologize for the rawness, but this is what it looks like when everything is completely raw. So what I'm going to do is I'm going to post the chart in here, because I didn't do that yet, and we're simply going to be zooming in here for a moment, and we're going to be looking at the market maker sell model which was present here. And what actually would be a good tip, which I would like to share with you, is to annotate the full delivery like this, make it red to show that it's a market maker sell model, and basically to train your eye to be able to see based upon RE chart that this is buy side of the curve, sell side of the curve on the lower time frames. So here's the RE chart, I'm saving that. Keep in mind we're working within the premise of what we established on the day chart prior. What did Asia do? Well, Asia right here, I would say this is where a bit of subjectivity is involved when it comes to defining what the sessions actually did. But when we pay attention to Asia, what I would like to see is that if we measure Asia from this opening right here at 6 p.m. to the following, to 2:30, which is around this candle right here, what I would like to see is that you could argue that this is a consolidation. And therefore, I'm still going to look at Asia as a consolidation, and that's how I'm going to log it. Asia consolidation, London expansion. But expansion in both directions, because London both expanded higher and expanded lower, meaning it ran up higher and then it ran down lower. Buy side of the curve, sell side of the curve, full market maker sell model. Absolutely beautiful. All originating from what? From that key level and the previous day high with SMT. Now, when we fast forward the delivery, what I would like to see is that the market eventually reprices higher and spends more time inside the dayeqt. What does the market reach? Well, the market reaches our next objective. What was our next objective? Well, I outlined on this day that after that 90,500 price level, the next objective which I had for Nasdaq on the upside would be this CB right here, this early CB. Do you see how that early CB formed in very close proximity to 50% of the range between 19,750 and 90,500? What you can see is that we see the market expand throughout the morning session into that CB, and eventually we reach that CB throughout the lunch, do you see how the market eventually rolls over right here? It's inside of this retracement that a shorting opportunity presents itself. Therefore, what we're going to be looking at is the following. What we are going to be looking at is we're going to be looking at this delivery in particular, and we're going to be paying attention to this sell program which unfolded. Why? Well, first of all, we want to define where the London high is. This is the London high. That's a very important reference point when you're looking at the New York morning session. London high. Therefore, what we see is that the market expands above the London high, reaches that early CB, reaches a deep premium, and therefore, when the time is right, we see the market roll over, retracing. It's inside of this delivery in particular where you see that we have this REBC which formed right here. And I know I'm making a lot of annotations now, but don't worry, I'm going to walk through it. This REBC right here, I would like you to see that inside of this delivery you are going to see a sell program on the lower time frames, market maker sell models, because the market is retracing into what? It's retracing into this BC and the monthly open right here. When we pay attention to this delivery, what we're going to do is the following. What we're going to do is we're actually going to drop into a 15-minute time frame as well, because we're going to be investigating something. So first of all, RE chart is going to get saved, and the RE chart which is going to be saved is for the April 1st right here for the Tuesday, and we're looking at the afternoon session now. So we have discussed the New York morning session, we have discussed the London session, and we're now discussing the New York PM session. Could you be looking at Asia? Yes and no. The concepts which I'm teaching to you based on time and price cycles work across all sessions. That's a given. However, I do not understand why you want to look at Asia session over, for example, London or New York AM, New York PM. And I understand the argument that it might fit better in your schedule, but at the end of the day, the delivery is not as clean as within those other sessions. So therefore, choose wisely whether or not you would be willing to look at the Asia session. So what I'm doing is I'm outlining the RE chart first of all, and we're just going to log the variables which we can see from this RE chart already. What I would like to see is that the market is Nasdaq. Newsday, again, we would have to go to Forex Factory to check whether or not there's news. SMR time, not relevant to us now. SMT, we're going to leave intact as well because there's no SMT relative to the sessions, it seems, based upon this RE chart. But when we drop into the lower time frames, we'll be able to double check that. Draw and liquidity. The draw and liquidity inside of this delivery is the following. The draw and liquidity, since we're focused on the sell model, meaning the buying opportunity into that REC was also an opportunity, don't get me wrong. However, since we're focused on the selling opportunity, the draw and liquidity is going to be an imbalance and it's going to be monthly open. And this is one of the most important things which I would like to understand as well when you go about logging these charts, is that the amount of, I'd say, variables which you have at first within this database will increase as you proceed. And therefore, when I created this database at first, I simply put in the most simple variables. But as you go through the charts, please feel free to add more and more to them. Point of interest. Point of interest for this repricing lower is the CB. So that's an imbalance right here. And it is the London high. And we see a purge taking place of that London high. And we see the market draw back into the range which was established up until that point. Asia consolidation, London expansion, AM expansion. And you might be wondering, why are we only logging consolidation expansion? This has a deeper meaning, and when I am going to explain this to you, I'm going to do this throughout a specific lecture in the future, where I'm going to outline to you that all that matters is that you recognize sell and buy program. Sell and buy program. That's the only two variables which you need to know. Are we in a sell program or are we in a buy program? Why? Because in a sell program, every single premium array will function as resistance. In a buy program, every single discount array will function as support on price. The Mmxm, which we're working, is a market maker sell model. So what we're going to do is we're going to drop into the 15-minute time frame, and on the 15-minute time frame, what we're going to be looking at is the following. What we're going to be looking at, and this is why I wanted to drop into the 50 minutes, because I already knew that we would likely see this on the 50 minutes, and what I would like you to see is the following. What I would like you to see is that we have these nice boxes. These boxes are being plotted by the time cycles indicator, and I'm sure that the majority of you probably already have it on your screens. However, if you don't yet, go to the mentorship platform, go to resources, and you can find the time cycle indicator, you can find the advanced price range indicator, you can find all the stuff which you need, which is like an extra besides the educational content which is available here on the mentorship platform, and I really suggest you to make use of those resources. What I would like to see is that we have this green shaded box. This green shaded box represents the 90-minute cycle from 10 to 11:30 a.m. This is the final 90-minute cycle of the morning session. Notice that when I outline the high of this 90-minute cycle is right here, meaning this is the AM high. Do you see how at 11:30 a.m. we opened up for lunch, ran the AM high, reached that RECB, and we then saw the market eventually roll over? Yep. That right there shows you that we purged the AM high and we then reverted towards the low. We didn't, however, reach the full low because the full low was down here, but we came back into a deep discount of the range which was established up until that point. The range being like this, the range of the previous session and the previous cycle. That's something which I didn't teach yet. However, we run the high and then revert towards the downside, drawing towards sales at liquidity. Beautiful sell program. Now what we're going to do is we're going to first of all annotate this high, AM high, and then we're going to save this, copy image, and we're going to paste this in our Notion as well. And when we go to the point of interest then, all of a sudden what we can say is, hey, we're not just looking at the London high and the imbalance as our point of interest. Nope, we're also looking at the AM high right here. And that right there is a crucial insight which I would like you to keep in mind. Now, when we're paying attention to everything which we have discussed during this lecture, during this showcase video, I would like to understand that based upon the RE chart, you're able to see these lower time frame opportunities. Meaning simply based upon this RE chart or the M15 chart within our final example, you're able to just go out here and you're able to see market maker sell models, market maker buy models, etc. Everything which I've taught so far throughout these lectures, up until this point, all have to do with recognizing swing points. Recognizing, are we now changing from sell to buy program or from buy to sell program? That is what I want you to focus on within your studies right now. Later, we're going to dive into all of these lower time frame signatures that I'm going to share with you. But for now, focus on those higher time frames. If you have the experience already, you can drop into the lower time frames and investigate the delivery as it took place. However, I believe that for the majority of you, it's better to just train your eyes to see these bigger price swings and understand the lower time frame fractals right now. With that being said, this lecture comes to an end. I hope that you found it insightful, and I hope that everything when it comes to audio quality, etc. was good, because right now I'm on holiday whilst I'm actually recording this, but I really want to get a lecture out for the model series, so I hope that you found it insightful. Let me know in the mentorship forum if you did, and I want to wish you good luck in your studies, and I look forward to speaking to you soon again in a new presentation. Be safe.
Hello there, I hope that you are doing well. Welcome to this new lecture of the 2025 model series. This lecture is going to be on times of interest. Before we begin with this lecture, I just want to apologize if the audio may sound a bit different than usual, and the reason why is because I'm currently traveling and I'm right now recording this lecture whilst being on the airport. I, however, didn't want to delay the release of this lecture, and therefore I'm just going to record it now. When it comes to times of interest, it's very important to understand the following. Times of interest allow you to know exactly when you are looking for specific algorithmic signatures and the delivery of price. This removes the hurdle of having to sit behind the charts all day through bad price action. Meaning, when we come to the charts, we must understand when we are looking for specific algorithmic signatures within the delivery price. That is what I will show to you during this lecture. First of all, you must understand that there are different methods of defining times of interest. First of all, we are looking at the concept of SMT. The reason why we're looking at SMT is because SMT is a crucial element when it comes to timing key market reversals. Next step, we're going to be paying attention to macros. And thirdly, we're going to be paying attention to delivery profiles. It's important to understand, however, that we haven't discussed the topics of SMT or delivery profiles yet within this model series, and therefore I'm going to create separate topical lectures on these topics as well. But for now, we're simply going to focus on the basics when it comes to SMT and delivery profiles. First of all, let's take a look at the concept of SMT. On the left right here, you can see a schematic where you can see two markets which are highly correlated. You can see that both markets are creating a reversal. However, when we're paying attention to this reversal, I would like you to see that the first market creates a lower low, whilst the second market creates a higher low. When we see this right here, whilst we are anticipating higher prices because the higher time from institutional order flow is bullish, we're expecting the market to draw towards an objective above market price. We can anticipate that when we see this sign become present, that we're likely seeing that key reversal taking place. On the right here, you can see the opposing scenario where you can see that there are two highly correlated markets and we see a swing high formation. Where I can see that market one takes out the previous swing high, whilst the other market doesn't. And that right there is SMT, which is present on the highs. We look for SMT when we're in a bearish market environment and we are anticipating the market to drop towards the price objective below market price and we have reached a higher time frame POI. It's important to note that both forms of SMT are exactly the same but simply inversed. What I would like you to understand is that what you can see right here is that I've plotted boxes on the final fractals before the expansion took place. What I would like you to understand is that it's inside of this run lower, followed by that expansion higher, that a lower time frame market maker buy model is present. The same is, of course, taking place on the opposing side, where we're seeing a market maker sell model inside that final run higher, followed by that expansion towards the downside. It's very important to understand that by seeing this SMT on a bigger time cycle, we can anticipate that on the lower time frames, we're likely seeing these market maker model fractals playing out. When we pay attention to a chart example then, what I would like you to see is that on the left you can see the Nasdaq and on the right you can see ES. What I would like you to see is that the Nasdaq initially consolidated and then we saw the market expand towards the upside. Notice that the market was drawn towards previous day high, which is right here, and notice that the market did not take out this high. Instead, we created relatively equal highs. If we pay attention to the right then on ES, what I would like you to see is that ES also consolidated and we saw ES expand towards the upside. Notice, however, that when this expansion occurred, ES took out the previous day high, whilst NQ didn't. And that right there is SMT relative to the previous day high. What I would like you to see then is the following. As you can see, I've plotted a red box around this delivery. And what is important to note is that when you pay attention to this delivery, you can see that this run up higher is the buy side of the curve, and the run lower which follows is the sell side of the curve within a market maker sell model. Buy side to sell side. When you start to understand that this S&P is literally signaling to you that we're forming that swing high, you must then begin looking at the lower time frame factors to in fact confirm that reversal taking place. We're now going to be paying attention to a bullish scenario, and what I would like you to see is that on the left you can see Nasdaq again, and on the right you can see ES. What you can see on the left is that Nasdaq expanded towards the downside, and the market was drawn towards this daily low of the Tuesday low. Notice the market reached this objective, took it out, and then reversed. If we pay attention to ES, however, what you can see is that ES also expanded towards the downside, drawing towards the Tuesday low, but notice that ES did not take out that low, and instead ES created a high low. I know these rows seem relatively equal, but Nasdaq took out the low whilst ES didn't, and therefore that is S&P which is present on the lows right there. That S&P signals to us that we're likely going to see the market begin to reverse. What we will then do is we will drop into the lower time frames and confirm to us that we're in fact drawing towards buy side creating next, because this is a market buy model where I can see the sell side of the curve followed by the buy side of the curve. Now it's important to note that the reason why I want to touch on S&P as first when it comes to time of interest is because a lot of people seem to believe that macros are the only way that you're able to basically try and time the markets. However, I want you to understand that macros are simply an introduction when it comes to time and its influence on the delivery of price. You must understand that we can utilize S&P to anticipate order flow changing already before it even occurs. And therefore, whenever you see S&P relative to a bigger time cycle, that's your first sign of, all right, pay attention now. And that also basically shares with you when you can anticipate a certain macro to deliver in a specific way, which we're going to touch on next. When we pay attention to macros then, what I want you to understand is that between every single hour, it's 45th minute, and the next hour, it's 15th minute, what you can see is that there's a 30-minute interval in which order mix signatures, as I'm teaching them to you, will present themselves. When you start investigating these specific time windows, your mouth is going to fall open because it's literally hidden in plain sight that within this specific 30-minute interval, you're going to see the same order mix signatures again and again. However, this doesn't mean that I want you to look at the markets all day. I don't want you to do that. It's possible, don't get me wrong. However, you must understand that at the end of the day, your job is to filter out the cleanest opportunities, and you filter out those clean opportunities by looking at delivery profiles, by looking at bigger S&Ps and all of that stuff. And therefore, as a general rule of thumb, these are the macros which I am personally paying attention to. Meaning for the London session, I'm paying attention to the 2:45 to 3:15 a.m. macro. Please note that all these times are in New York time. Next that for the London session, I'm paying attention to the macro from 3:45 a.m. to 4:15 a.m. Then for the morning session, I'm paying attention to the 9:45 to 10:15 a.m. macro. And next that I'm paying attention to the 10:15 to 10:45 a.m. macro. For the afternoon session, then I'm paying attention to the 1:45 to 2:15 p.m. macro. And I also paying attention to the 2:45 to 3:15 p.m. macro. As you can see, for all sessions that I've plotted here between the London to New York afternoon session, I have two macros which I'm paying attention to. Please note that I'm not paying attention to each one of these macros every single day, because I'm not doing that. I'm staying on the RU chart and we're recognizing, all right, when do I anticipate a swing higher, swing low to form? When I'm able to anticipate when it's swing higher, swing low forms, I'm able to then drop into the lower time frames and pay attention to these macros during the sessions to say, okay, this is when I'm going to engage. This is when I'm going to fill my positions, etc. Or this is when I'm anticipating price to behave in a specific manner. And that's the power of these macros. Now, when we pay attention to the Asia session, then I would like you to understand that during Asia, the same time windows apply. However, I want to ask you something. If you know that for the index futures specifically, the London AM and PM session are way cleaner than the Asia session, why would you look at the Asia session? I understand that some of you might be living in a continent where the timings for Asia are simply better, but even then, I would still suggest you to mainly focus on the London AM and PM. And the reason why is because throughout Asia session, you usually do not see a lot of volatility, and therefore, in my opinion, it's not worth looking at. When you pay attention to a chart example then, what I would like to see is that in front of you, you can see a London session delivery. And what you can see is that throughout the other part of the Asia session, the market expanded towards the downside, and then eventually the market from 2:45 to 3:15 a.m. began. Notice that we see the market expand towards the downside, form this low, retrace, and we then have one more push towards the downside. What is this factor right here? Well, the moment that this push lower occurs, you must immediately think to yourself, all right, we might be setting up a bullish breaker formation. Why? Because we form a low, high, low, high. And therefore, the moment that we see displacement through this high, which formed inside of a CB, that confirms to us, all right, we have likely formed the SMR right here. And when we have formed the SMR, we can anticipate that we're likely going to see the next delivery taking place. When are we likely going to see that next delivery taking place? Or we're likely going to see that next delivery taking place either shortly after the macro, or as you can see right here, time distortion takes place, and then throughout the next macro from 3:45 a.m. to 4:15 a.m., the real delivery takes place. When we pay attention to the next chart example, then what we would like to see is that inside of this chart example, you can see that the reversal occurred outside of our macro window, and therefore, what we're paying attention to is the following rule. Whenever a market reversal occurs outside of the macro window, we pay attention to the following. We pay attention to the next macro to anticipate the expansion to take place. Meaning, what you can see is that at 5:18 a.m., we saw the market reverse right here. We saw it begin to displace towards the downside. Notice that when this displacement towards the downside occurs, we're immediately thinking to ourselves, okay, Let's wait a bit until the next macro window so that we can then anticipate that we're likely going to see the next expansion occur. Meaning, what you see taking place is that displacement lower occurs, and you see that we in fact begin to roll over. Where we initially reprice towards the upside, you see that if that begins to displace towards the downside, and we see a sell program unfold. Notice that we form a bearish value gap right here, and the market retraces into that right here. Notice that we see consolidation occur, and eventually the market begins to roll over, drawing towards engineered sells and creating resting below this row. When it comes to delivery like this, it's important to note that whenever an SMR forms outside of a macro window, we pay attention to the next macro window to anticipate when the next expansion is going to take place. Write it down, please. When you pay attention to the New York morning session then, what I'm going to see is inside of this chart example, what you can see is that the market was consolidating up here ever from 8:30 a.m. Notice that 9:30 opened up and we saw the market reprice towards the downside heavily. Notice that we saw a quick expansion lower. Then at 9:45 a.m., we saw the first macro of the morning session that we truly pay attention to taking place. This 9:45 to 10:15 a.m. window, guys, man oh man. If you would just focus purely on this macro, you would find all the opportunities which you would ever need to make a living from these markets. What you can see is that at 9:45 a.m. we see a reversal taking place and we then begin to see the market expand towards the upside. Now I would like to think about the following. What is present inside of this delivery on the lower time frames? It might seem like we just reprice the lower very quickly and then expand towards the upside very quickly. But on the lower time frames, you must understand that we actually see the signs of a lower time frame market making buy model taking place. When we pay attention to, for example, the seconds charts or such. When we pay attention to another chart example then, what I would like you to see is that we see the market expand towards the upside, we see the market reprice higher. Notice that we see the market consolidate eventually, and at 10:28 a SMR unfolds, where you begin to see that the market is being repriced towards the downside all of a sudden. You see these big downward candles? You're probably wondering why is exactly at 10:28 the market turning around. We'll get to that in a bit. What I would like you to see is that the market displaces lower and a retracement occurs. In our minds, we immediately think to ourselves, okay, wait a minute. The macro isn't present yet, and therefore we must wait for the next macro from 10:45 to 11:15 a.m. What we can see is that between 10:45 to 11:15 a.m., the market begins to eventually expand towards the downside and begins to accelerate. Now, when it comes to anticipating expansions, it's very crucial that you understand this rule, which I'm outlining to you now, that whenever the SMR unfolds outside the macro, we pay attention to the upcoming macro to anticipate that there is a security run taking place. So it means if we look to position ourselves short inside the market, it means that we are going to look for that opportunity to present itself throughout that macro window. Notice that the market eventually expands towards the downside and draws towards sales liquidity resting below this row right here. When it comes to delivery profiles have the following rule. You must focus on recognizing the manipulation cycle. Once you recognize the manipulation cycle, you can anticipate the distribution to follow. Meaning, your job is to recognize manipulation, because once you recognize manipulation, you can anticipate distribution to always follow. And that is one of the most important insights which I would like to share with you. One of the most important lessons which I had to learn the hard way was, instead of just chasing price patterns for the sake of chasing price patterns, such as value gaps or breakers, my job became recognizing delivery profiles, meaning my job became literally just focusing on recognizing manipulation, because always after manipulation, we see distribution unfold. That's a general rule of thumb. And therefore, inside that manipulation, we can anticipate to see the signs of an SMR forming. Because once those signs become present, that is when we can anticipate, all right, we're now going to distribute towards the opposing side. Focus on recognizing manipulation, guys, because by focusing on recognizing manipulation, trading the distribution becomes very straightforward. What it looks like within the charts is like the following. When we're looking at a bearish example, we're looking for the market to consolidate. And what's happening inside of this consolidation is that both buy side and sell side are being engineered. We eventually see the market open up for a new time cycle. And we see the market begin to open up and run higher, taking out the high of the consolidation. This right here is the manipulation taking place. The moment that this manipulation takes place, I'm immediately thinking to myself, okay, who is now being trapped into breathing higher price next? Retail minor traders. And therefore, what I'm looking for is I'm looking for the signs that confirm to me we're rolling over. Because once those signs become present, that's to me confirmed that the manipulation has ended. Then I can anticipate that we're now going to distribute towards the downside. When we pay attention to a bullish example then, what I would like you to see is that the market is consolidating and it's going sideways. Inside this consolidation, both sell side as buy side liquidity are being engineered. We eventually see the market open up for a new time cycle. Throughout this opening, what's taking place is that the market will seek to open up, drop lower, taking out sell side liquidity engineered below the low of the consolidation, and this is manipulation which is taking place. The moment that this manipulation takes place, we can anticipate that distribution will follow afterwards towards the upside. How do we confirm this? By looking at S&P and, for example, macros. Now, I understand that when you're looking at these chart examples, you might be a bit confused and you might be looking at them and you might be like, it can't be that simple, right? It can't be that straightforward. What if I told you it is? What if I told you can literally go into the charts and lose countless nights of sleep over investigating what I'm outlining to you here? Especially when you start blending it with the time cycles logic which I've taught you prior. When we look to blend these three elements to confirm to us that the time is right for the market to behave in a specific manner, we are going to be paying attention to, first of all, SMT to confirm a swing low or swing high formation, because it's inside of that swing formation that a lower time frame market maker model is presenting itself. Next step, we're going to be paying attention to the macros, so that the reversal is taking place preferably throughout the macro window. If it doesn't throughout the macro window, we know that we must wait for the next macro window to anticipate that expansion taking place. This does not mean we cannot engage prior to the macro window. However, if you want to enter and immediately see the market expand in your favor, it's best to wait for the macro window. Next step, we're going to be paying attention to delivery profiles in the sense of AMD. We're looking for manipulation because once that manipulation is taking place, we know the distribution will have to follow afterwards, always. When we pay attention to a chart example then, what I would like you to see is that on this chart example, you can see that the market opened up at 1 p.m. right here. We saw the market expand towards the downside. It's inside of this expansion lower, and a lot of retail mind traders are being led to believe that lower prices are next, meaning they're being led to believe that we're going to see the market just continue dropping forever. It's inside of this one lower that manipulation is taking place. What we're now waiting for is we're waiting for the market to show the signs to us that it's in fact turning around. What are we looking for? Well, we're looking for the market to reach a point of interest, and from there we're going to be looking at the right time. We confirm that the time is right when we're looking at, for example, the macro window right here from 1:45 to 2:15 p.m. What you can see is that the market forms a low during that macro window, and should begin to expand towards the upside. Do you see how it runs up higher? We then see a retracement taking place, and we see a 10-minute cycle S&P become present with the Dow Jones right here. This is being detected by the S&P detector. Notice that the market then expands towards the upside, and we see these big green candles form right here. From this moment in time, when you see this run up higher taking place, you must immediately think to yourself, okay, wait a minute. We have just manipulated towards the downside. We have seen that every retail mind traders think to themselves lower, lower, lower. We have seen a reversal form throughout our macro window. We have seen S&P, therefore the BC which forms this discount array right here is a potential longing opportunity. Targeting what? Targeting the current high of this 90-minute cycle with buy-side liquidity resting above that high. When we pay attention to a bearish example then, what I would like you to see is that we're back at the same bearish example, and what you can see is that the market opened up at 9:30 right here and initially began consolidating. Notice that it eventually expanded towards the upside, and we saw the market begin shopping around shortly after 10 o'clock. It begins to deliver in a high resistance grid run, where you can see it's just going back and forth, back and forth, back and forth. Whenever the market is consolidating, it's important to note that S&P ends this consolidation, and the reason why is because it's inside of that S&P that is being presented that we are going to see the market eventually begin to roll over. Notice that at 10:28, the reversal unfolds, and we will see the market begin to displace towards the downside. From this moment in time, we have two key variables that we're aware of. First of all, we saw 10 o'clock open right here, and we saw it run up higher. This is manipulation which is taking place. Next step, we have seen S&P unfold between Nasdaq and ES, and therefore that confirms to us, all right, we're likely going to see the market roll over soon. Now we're simply waiting for the 10:45 marker to anticipate the market effect beginning to expand towards the downside. Notice that at 10:45 we see the market retrace into a CB which formed shortly prior, and notes that the market then expanded beautifully towards the downside, drawing towards also the creating resting below this low. Why in particular this low? Why not any low prior? Well, this low formed shortly after 9:30, and therefore this was the regular trading hours low up until that point, and therefore that's a key sales liquidity pool to target. Understand that I discussed a lot during this lecture, and it's totally understandable if your heads are spinning right now, because time is one of the most fascinating concepts when it comes to looking at the market through this algorithmic perspective. And it's also the most important because it's time, then price. It's not price first and then time. No, it's time, then price. We're only looking at the markets at the right times, because when the right times are present, we can anticipate what the next delivery within price is going to be. With that being said, this lecture comes to an end. I hope that you found it insightful. I again apologize if the audio quality is different than usual, because I'm recording this whilst being on the go. I'm recording this whilst being at the airport, so I hope everything got picked up clearly. And if not, I'm probably going to do a lot of editing afterwards, and we're going to make sure that the audio is as best as possible. I'm going to discuss the topics of delivery profiles and SMT way more in depth in the future. And I'm also going to drop further hints when it comes to timing the market within very specific intervals. But that will all come later within this model series. Thank you for watching this lecture all the way to the end, and I want to wish you good luck in your studies. Be safe.
Hello there. I hope that you're doing well. Welcome to this new lecture of the 2025 model series. This lecture is going to be on SMT, Smart Money Time. First of all, before we dive into this lecture, I would like to share with you that SMT is a confirmation tool, nothing more. Meaning, SMT is not a tool which you utilize to simply determine bias. It's not a tool which you utilize to determine where to buy or sell. SMT is merely a confirmation tool of your existing analysis being at play. Smart Money Time. Let us define what SMT actually means. SMT gets looked at after the prior steps of a protocol are present. Meaning, within this model series, you have been introduced to concepts in a specific order. SMT forms in this order, meaning the prior steps first need to be present before we even consider looking at SMT. If this is not clear to you, don't worry. Down the line within this series, I'm going to show you the full protocol during a separate lecture. Because SMT only gets looked at when the prior steps of the protocol are present, we must only look at SMT as a confirmation of the prior existing steps of the protocol. Meaning, SMT functions as a confirmation tool of our process indeed being in play. Meaning, our focus is on detecting reversals, and SMT confirms to us that the reversal is taking place. There are multiple forms of SMT, and during this lecture, I will share multiple with you. First of all, we're going to be paying attention to the following form of SMT. This SMT forms over a larger time cycle, and what you can see is that on these two markets, you can see that they are highly correlated. However, the market on the left right here created a high and then saw the market retrace. What happens between this retracement leg and eventually the lower high which gets established doesn't really matter. Meaning the market can just consolidate, it can drop even lower, doesn't matter. Therefore, I've labeled this as irrelevant price action. What you can see on market 2, however, is that market 2 also forms that first high and it then eventually creates a higher high. This means that market 2 created a higher high whilst market 1 created a lower high. This is SMT. Therefore, this is a cracking correlation between these highly correlated markets, and when this is present, this tells you, alright, we're likely going to see the underlying order flow change soon. Now, it's important to note that whenever we are paying attention to these swing points, we must blend this with the time cycles. Meaning it's not just a current correlation and therefore the market is now expected to turn around. Nope. It is all paired with the logic of the time cycles as I've shared them with you prior during this series. Meaning we focus on the open of a new time cycle and then we pay attention to the previous cycle high. If one market doesn't take out the previous cycle high whilst the other market does, that is a time cycle SMT. When we pay attention to a chart example of this then, what you can see is that on the left you can see the Nasdaq and on the right you can see ES. What I would like you to see is that Nasdaq formed this high right here, and we then saw the market reprice towards the upside. Notice that the market came very close to taking out this high, but the market just fell short of it. If we pay attention to ES, however, what you can see is that ES took out that same high right here, and therefore that shows to you, hey, this is actually a correct correlation between the Nasdaq on the left and ES on the right, where ES created a higher high, Nasdaq created a lower high, and that SMT set up the reversal which followed afterwards. When we pay attention to a bullish example then, the bullish example looks like the following, where I can see that market 1 creates a low right here, then we see irrelevant price action. Again, it doesn't matter what happens between here, all that matters is that we form this low. Then a new time cycle opens up and we see the market eventually create a higher low relative to this previous cycle low. If we however pay attention to the market on the right, you can see that the market on the right also forms this low and eventually creates a lower low. Therefore, that's a correct correlation relative to this low. But in particular, it's a correct correlation relative to a previous cycle low. So that's time cycle SMT. Now, I understand that for some of you it might be confusing what I'm labeled here, irrelevant price action, but what I mean by that is that price can literally do whatever it wants to do. Meaning it can consolidate, it can expand, whatever, it doesn't matter. What matters is that we see a new time cycle open up and on one market create a lower low relative to the previous cycle low, whilst the other market creates a higher low. That is the importance of this SMT. When we pay attention to a chart example then, what you can see is that on the left, we can see that the Nasdaq formed this low and we saw the market expand higher. Eventually a retracement occurs and we see the market form a higher low relative to this low. If we however pay attention to ES on the right, what you can see is that ES also formed that low, expanded higher, and then eventually took out this low, whilst Nasdaq didn't. And that is a SMT relative to again a previous XL. Now, what is very important to note is the following. Everything which I'm sharing with you during this lecture is fractal, meaning this works across all time cycles. Whether you're looking at monthly cycles, whether you're looking at weekly cycles, whether you are looking at daily cycles, whether you're looking at session cycles, whether you're looking at 90 or 30 or even 10-minute cycles, it's the same logic. And it shows to you that the time is fractal. Now, when we pay attention to another example of SMT then, what I would like to see is that market 1 on the left right here creates a higher high. Market 2 on the right here creates a lower high relative to this swing high. Now, this is your regular form of SMT, as the majority of you are probably already familiar with it. But it's important to note that even this SMT is also a time cycle SMT, but it forms on a smaller scale. Every single market reversal either forms with a breaker formation, as you can see on the left right here, or it forms with a mitigation block formation, as you can see right here on the right. There's always either a breaker or a mitigation block. Now, when we pay attention to a chart example then, what you can see is that on the left you can see that the Nasdaq expanded towards the upside and it formed this high. Eventually, multiple higher highs formed relative to this high. First higher high formed right here, and eventually second higher high formed right here. Notice, however, on the right that we did not see ES take out this high, which is annotated by this red line. Meaning ES created lower highs, whilst Nasdaq created higher highs. And that is important to note because that shows to you that Nasdaq and ES had SMT present right here. Now, again, SMT by itself doesn't mean anything. However, because you're anticipating a swing high to form, that is when that SMT begins to hold a lot of significance, because that shows to you that the time is right for the underlying order flow to begin changing from buy program to sell program. Now, when we pay attention to a bullish example then, what you can see is that this is literally the same schematic but then in first, where I can see that market 1 on the left creates this low, and we then eventually see a retracement taking place, and then a lower low gets created. Notice, however, that the market on the right also forms this low. We see a retracement taking place, and the market creates a higher low. The Kraken correlation is present relative to these swing points, and therefore that shows to you, alright, we're now going to see the underlying order flow likely change. Why? Because you're already anticipating a swing low to form, so this SMT serves as the confirmation of that existing idea. Again, here we are looking at a chart example, but before we discuss the chart example, I want you to understand that this SMT also takes place relative to smaller time cycles. And what I would like to see is that on the left, you can see that the Nasdaq formed a low right here. And on the right, you can see that ES also formed that low. Notice that ES, however, formed a lower low relative to the low which I have annotated by this red line, whilst Nasdaq formed a higher low. And that is that Kraken correlation which we have just seen within the schematic. Another form of SMT has to do with opening times. This is a more rare variant of SMT, however, I still find it important to share with you, and the reason why is because especially when it comes to anticipating price swings, this is an important concept to understand. So, for example, when it comes to anticipating a low resistance security run, or for example, when anticipating that the underlying order flow might change when you're in a position, it's important to pay attention to key opening times. When it comes to key opening times, I'm referring, for example, to a weekly open, a midnight open, 9:30 open, or even every single 90-minute cycle it's open. Each one of these opens has to be monitored when it comes to an intermarket relationship perspective. And the reason why is because by looking at intermarket relationship relative to the opening times, you're able to see whether or not cracks of correlation are present. And whenever there's a crack correlation present, that's usually a sign for either a deep retracement to occur or consolidation. What I would like to see is that on the left, you can see that the market expands towards the downside, forms this low, retraces higher, and then expands lower once more. Notice, however, that the market did not reach this key open. Instead, we stopped right in advance of it. When we pay attention to the market on the right, then what you can see is that the market expands towards the downside, forms this low, retraces higher, and this market does reach that key open. Where market 1 did not reach the key open and stopped right in advance of it, you can see that the market 2 actually reached the key open and then begin turning around. So whenever you see SMT relative to a key opening price, pay attention to how the market is likely going to react off that level. And whenever you are in, for example, a short position from up here and you're riding the markets lower, be sure to take partials accordingly when you recognize this form of SMT. The amount of times that I was in positions and I saw open SMT taking place and the market just turn around and immediately begin retracing deeply is a lot. And therefore, I made the rule for myself, whenever I recognize open SMT, that is a key warning sign. And that's why I'm sharing it with you. When we pay attention to a chart example then, what I would like to see is that we are paying attention to the weekly opening. Now, the weekly open is shown by this orange line right here. And on the left, you can see that the Nasdaq tapped this weekly open multiple times within these boxes right here. If we, however, pay attention to ES, you can see that ES did not reach that weekly open. Do you see how the market reacted off that weekly open on NQ? Do you see how the market expanded away from it multiple times? Right there. Do you see that the fact that ES did not reach this weekly open is a big warning sign if you are in shorts, because it shows to you that we're likely going to continue the bullish order flow. There's a rush for ES to get somewhere, and that will also mean that Nasdaq is likely going to follow, being repriced towards the upside. So again, weekly open SMT is a result of market 1 reaching the weekly open, whilst market 2 doesn't. Now, it's important to note that when it comes to all of these different forms of SMT, that they can be blended. Yep. When we pay attention to a bearish example, then it's simply the bullish example in first, where you can see that the market expanded towards the upside, stopped in advance of the key open, retraces, and then we see another expansion leg higher taking place. Notice, however, that the market does not reach this key opening price, and instead we see the market roll over right here. Market 2, however, also expands towards the upside, retraces, and then expands higher once more, but it does reach that key open. Meaning market 1 did not reach the key open, whilst market 2 did. And the reason why that's important, because that is open SMT, but now within a bearish schematic. When we pay attention to a chart example, what you can see is that on the left you can see Nasdaq again, on the right you can see ES. Notice that we see ES reprice into that orange line which represents the weekly open. Notice, however, that Nasdaq did not reach the weekly open and stopped right in advance of it. This is an important warning sign like I outlined. Now, in these schematics, in these examples, I've shown to you the hourly chart and I've shown to you the weekly opening. However, the same logic applies to those smaller opening times as I mentioned them to you. Even, for example, to, let's say, a monthly open or a yearly open. It's the same logic, just using a different opening price. Now, as a final schematic for this lecture, I would like to share with you the following. What I would like to share with you is that I have put the first two SMT schematics together within this slide. And what you can see is that on the left, you can see that schematic where I outlined to you the bigger time cycle SMT. When it comes to this time cycle SMT, this SMT can be, for example, relative to a daily low. Or, you know what? Let's say a session low. Yes? Let's say that this is our London low right here. The market eventually does whatever. This is irrelevant price action. And then throughout the New York morning session, we see the market open low and we see it make a higher low relative to that London low. Inside of this SMT, which is being established right here, followed by this expansion higher, you are going to see on the lower time frames, a lower time frame market maker buy model. Now, what I prefer to see within that lower time frame market maker buy model is the following. Within the low formation of that lower time frame market maker buy model, I prefer to see a smaller time cycle SMT. So where we have a session SMT, I absolutely love it when I also see, for example, a 30-minute or 10-minute or even a 3-minute cycle SMT present on the lows right here. This is a smaller time cycle SMT. So what you can see is that in this circle, you can see that schematic of that smaller time cycle SMT. But I love to see that inside of a bigger time cycle SMT. And this is what I refer to as double SMT. When I see double SMT, that's to me a great confirmation of, all right, we have likely formed the low. It's time to buckle up for expansion higher. When you look back at the chart examples which I shared when it comes to these two big time cycle SMTs and small time cycle SMTs, I want you to pay close attention to them because you might notice something when it comes to the chart examples which I've outlined. When it comes to SMT, it's important that you train your eye for recognizing SMT because you must be able to see these correction correlation between these high correlated markets. If you, however, want to automate this approach and you want to save a lot of time and mental hassle, etc., try out the SMT detector because the SMT detector saves you the effort of having to go out and pay attention closely to what both markets are doing. It simply shows you whenever there's SMT present. But again, SMT is merely a confirmation tool, meaning without all of the prior steps of this process being in play, the SMT means nothing. Therefore, SMT can only be looked at as a confirmation of an existing idea. With that being said, this lecture comes to an end. I hope that you found it insightful. I want to wish you happy Easter because it's Easter at the time of this recording, and I look forward to speaking to you in the next lecture of this model series. Be safe. Hello there. I hope that you are doing well. Welcome to this new lecture of the 2025 model series. This lecture is going to be on CSD, changes in the state of delivery. Now, before we dive into this lecture, I find it very important to share with you that I want you to have watched the prior lectures of this 2025 model series. And the reason why I say that and why I put emphasis on it is due to the fact that a lot of people seem to believe that CSD, changes in the state of delivery, are merely a pattern within the delivery of price. However, this is not the case. CSD only holds any significance when the prior steps of the protocol which I'm teaching to you are in play. Therefore, to simply just look for CSD is not enough. And with that being said, I would like to begin this lecture. CSD confirms the right side of the curve taking place, meaning everything which I'm sharing with you has to do with market maker models. Meaning I'm sharing with you how you can anticipate how the right side of the curve is likely going to deliver. When we see that the left side of the curve is done delivering, CSD, a change in the state of delivery, will confirm to us that we're going to see the opposing side of the curve deliver, whether it be the buy side of the curve in a market maker buy model or the sell side of the curve within a market maker sell model. During this lecture, I will share with you how you can anticipate that curve to unfold. Change in the state of delivery, CSD. When it comes to CSD, there are two states of delivery. First of all, there's buy side and there's sell side delivery. This is important to understand because during buy side delivery, price is drawn towards buy side liquidity, which is resting above old highs. That's why it's called buy side delivery. During sell side delivery, price is drawn towards sell side liquidity. This sell side liquidity is resting below old lows. The reason why it's important to understand these two delivery functions is because you must understand that at every single given moment in time, if that is either being drawn towards buy side or it's being drawn towards sell side. Change in the state of delivery means that price changes from sell side to buy side delivery or from buy side to sell side delivery. So what CSD basically represents is that it represents the change between sell side to buy side or buy side to sell side. And that's also where you begin to see the importance of it. Because by paying attention to CSD, you are in fact able to anticipate when that right side of the curve is likely going to unfold. So when we pay attention to a visual example of this, what you can see is that we see the buy side of the curve deliver in the form of the green line. Then we see a change in the state of delivery taking place. And then the sell side of the curve delivers where the market is drawn towards sell side liquidity. This is being represented by the red line. If we would look at an opposing schematic, we could see that the red line lower represents sell side delivery. We then see a change in the state of delivery taking place and the market draws towards buy side next. So this is buy side delivery. What's important to note is that these schematics which I've created are of course simplified. They represent the bigger picture. However, within this overall bearish delivery, you are going to see short-term buy-side deliveries taking place, where you're going to see short-term retracements higher taking place. These are lower time frame buy programs which are occurring, and therefore you must understand your fractals, from the bigger fractals all the way down to the smaller fractals. This is something which we're going to touch on later throughout this model series more, because at the end of the day, you must understand that both time as price are fractal. Your job is to align all the factors with each other. When we pay attention to this example schematic, which I've shown prior throughout this series as well, I would like you to understand that CSD confirms the bullish price cycle taking place. Meaning, a bullish change in the state of delivery confirms to us that we're going to see the market expand higher from point A, which is below here, to point B, which is up here. The moment that a change in the state of delivery takes place, that is when we can anticipate the market is going to draw towards point B. This is of course the right side of the curve within a market maker buy model, where the sell side of the curve is going to be to the left right here. When we pay attention to a bearish schematic then, what I would like to understand is that a CSD confirms the bearish price cycle taking place as well, of course, where I can see that the market is drawn from point A to point B, which is below here. What the bearish change in the state of delivery shows to us is that the market is in fact in a rush to draw towards sell side liquidity next, and therefore we can anticipate that the right side of the curve, which is in this case the sell side of the curve, is going to pan out, where you have seen the left side of the curve being the buy side of the curve. Within these schematics, I've only shown the right side of the curve, but I anticipate that if you have studied the prior lectures, which I've outlined throughout this model series, and you have also investigated charts, you should be able to follow along nicely. I hope that you understand as well that the level of difficulty within these lectures as we're proceeding throughout this series is also increasing. Meaning, I'm not speaking to a beginner anymore. I'm not speaking to someone who's just getting started. Surely you might have just started with basically getting into trading and such. You might not have been doing it for a long time, but if you have been following my guidance and you have been exactly following that what I'm been outlining you to do. So doing the homework, investigating the charts, looking for these algorithmic signatures, you should have seen already a great sense of algorithmic precision by the time that you have come to this video in particular. When we pay attention to bullish market structure, what I would like you to understand that the most simple way of looking at bullish market structure is through the following perspective. Where you can see that the market expands towards the downside, we see a retracement higher taking place, and the market has one more push lower, taking out sales liquidity resting below this low. When the sales liquidity resting below this low gets taken out, what we'll be monitoring is the reaction to this level. The moment that price displaces above that old low, but more in particular above this old high right here, which set up this final push lower, that is telling to us, hey, this is a bullish breaker fractal, where I saw a low, high, lower low, higher high taking place. Therefore, we anticipate that this high is likely going to function as support on price next, because when the market retraces into that high, it has to function as support on price to confirm the next expansion leg higher occurring. Now, when it comes to this bullish market structure, I can understand that some of you are probably already like, okay, we've seen this before. Where does the change in state of delivery take place? Where does it get confirmed that we're going to change from sell to buy program? The change in the state of delivery gets confirmed right here. The moment that the market trades above this high, I'm looking for the signs of bullish order flow stepping in. And what you can see within this schematic is that I've outlined a light bulb emoji. And the reason why I've outlined the light bulb emoji has to do with market maker models in general. So therefore, we're going to look at a different schematic to understand that. But the moment that price displaces above this high, I'm anticipating that we're now changing from sell to buy program. But do you understand what I outlined prior when it comes to you must have the proper understanding behind the overall process which we're adhering to, because simply looking for this fractal of a bullish breaker is not going to serve you any well. There are a lot of bullish breakers which form throughout each day, but it's not about simply recognizing the price pattern that's going to lead to the consistency you're looking for. The consistency that you're looking for is going to be a result of you having defined when this price pattern will work, and that is what I'm sharing with you throughout this lecture series. So if you investigate in depth, you are going to see exactly what's leading up to these buy programs and sell programs event first. When we pay attention to the full schematic of a market maker buy model, what I would like to see is that inside the schematic you can see that we have our drawing liquidity established right here, original consolidation, sales out of the curve, and we see the market reach our point of interest, which is outlined by this red line. Notice that the market reaches our point of interest and we then see the market reverse and draw towards the drawing liquidity. This is the buy side of the curve unfolding. When it comes to this schematic, it's important to understand that on the left side of the curve, there are going to be imbalances which will be formed. These imbalances are going to form the moment that price expands away from a prior retracement. And the reason why this is important is because the left side of the curve determines and influences how the right side of the curve is likely going to deliver. So what you can see is that I've outlined two blue boxes down here. A lower CB right here, a lower bearish value gap, and one slightly above it. Do you see how the retracement higher, which set up that final push lower? This is exactly that fractal which we've just discussed, by the way. Do you see how this high formed inside this CB on the left side of the curve? What I would like to see is that when the market displaces above imbalances which formed on the left side of the curve, I need to see these imbalances function as support on price if we are in a buy program. Therefore, this is a market structure shift pattern which is being set up. The market structure shift pattern is a pattern in price action which I've coined years ago, and is the strongest algorithmic signature which you can look for to confirm market reversals. The reason why is because it occurs at the key level. What I would like to see is that we see a CB high, and what I'm then looking for is I'm looking for an imbalance to form inside of this price swing whilst the market trades above this high. If that occurs, I want to see that imbalance function as support on price. I need to see it function as support on price. But what if I told you that you can already anticipate this market structure shift pattern taking place before it is even formed? Because when the market displaces above this lowest CB right here, the final bearish value gap, it's already a sign of the underlying order flow beginning to change. Next to that, and this is something which I want you to think about, is what do you think is taking place if I would say that this is our previous cycle low, and that previous cycle low fails to function as resistance on price, which it should if we're going to continue bearish, and it not functioning as resistance on price is telling you something. Have you thought about that? Yep. Market maker buy model schematic, investigate this in depth, and the way I want you to investigate it is by paying attention to the left side of the curve and how it's influencing the delivery on the right side of the curve. The way that you investigate this is literally by doing one thing, and that's extending the imbalances to the right. And next to that, I want you to pay attention to whether or not these runs are originating from a point of interest which you already established prior. Pay attention to time cycles as well when it comes to previous cycle highs and previous cycle lows in particular to confirm that we're changing from sell to buy program. When we pay attention to a chart example then, what I would like you to do is I would like you to look at this area chart of Nasdaq, and I would like you to pause the recording, and I would like you to try and annotate as best as possible what you're seeing right here. Now, for those of you that are watching this lecture right away after it has been released, you will have of course seen me outline in real time that I was looking for buy side delivery to take place on Nasdaq after we showed the signs of wanting to displace higher, and the buy program was originated down here. But that's something which I want you to just ignore. Try and follow this assignment as best as possible. Pause the lecture and annotate in your mind to make a screenshot or however you want to do it. But try and annotate where you see the change in the state of delivery taking place. Try and see whether or not you're able to recognize where we're changing from sell to buy program. I hope that you paused the lecture, because I'm going to put on my lipstick. Here you can see my lipstick, and what I would like you to see is that first of all I've annotated buy side liquidity resting above this high. This is my drawn liquidity for the buy program. This is the level I anticipate that price is going to be drawn towards like a magnet. Next to that, you can see that I've annotated this sales liquidity pool. And the reason why this sales liquidity pool is important is due to the fact that it formed right in advance of a key level. Pay attention to 18,000 right here. What I would like to see is that when we open up for this week, the weekly open is represented by this orange line right here. So the market displays lower. Do you see how this RECB formed right here? The market retraces into that RECB and then expands lower once again. Do you see how the market finds resistance inside of his old low, the sales liquidity pool? We see the market then expand lower aggressively, and notice that this sequence of imbalances get created. Once this sequence of imbalances gets created, what I'm monitoring is the following. What I'm monitoring is whether or not they're going to function as resistance on price. If these imbalances are going to function as resistance on price, then we are still bearish. However, the moment that price would displace above this sequence of imbalances and we would see them begin to function as support on price, then it would signal that the right side of the curve is currently unfolding. What do we know about the right side of the curve? What have I been outlining to you? When a bullish price cycle has started, what we're paying attention to is the creation to discount arrays on the right side of the curve. Do you see any discount arrays being created inside this delivery? I see one imbalance right here. I see a second imbalance right here. I see a third imbalance right here. I see a fourth imbalance right here. I see a gap being created right here. And that's how I can continue with outlining to you all the discount arrays which we utilized for expansion higher, retracement lower, expansion higher. What I would like to see is that when we go back to this initial CB which I had marked up for you, I would like you to see that inside of that CB this high formed. Why is this high in particular so important? Because this high formed inside of that CB and we saw the market displace through it with a sequence of imbalances. Do you see how the market retraced back into this old high and into this CB before expanding higher aggressively? Must be random, right? What I would like you to understand, guys, is that what I'm sharing with you right here works across all markets, across all time frames, whether you're making a mega trade analysis where that's going to take you months to play out, or whether or not you're trading a 50-second chart of Nasdaq. It's all the same. Time and price are fractal. And that's the beauty of that, what I'm teaching to you. And I promise that once you see this, once you understand what I'm actually showing to you, you will get a sense of calmness, because you realize that this is what has been going on in front of your eyes all this time. And this system will never change. They will never be able to make any adjustments. They will never be able to go out here and say, oh, you know what, we're going to completely throw it around. No. Surely there might be some changes when it comes to the timing elements, or the time it takes to fulfill specific orders, or how quick the market moves. So for example, what you're seeing now is that the volatility is through the roof. But in general, the same concepts always apply. Why? Because this is how these markets are literally rigged. Once you start seeing this, you will never be able to unsee it. Think about it. How else am I able to call week in, week out, day in, day out these markets with such precision? If it was just buying and selling pressure, please explain to me how in this example which is in front of you, which is from the end of April, I was literally able to walk you through each day in real time throughout my market updates within the lectures on the mentorship platform, or through my market updates on the mentorship forum. Outlined on Monday, sell program, Tuesday buy program, Wednesday buy program, Thursday buy program, and Friday also buy program. Think about it. It's because I recognize these price cycles. I recognize what the draw and query is. Once you know higher time from institutional order flow, draw and query, point of interest, everything else becomes clear as daylight. Start thinking in sequences, because that is how icttrading is coded to deliver price. So a short little rant in between this lecture, I hope you don't mind. When we pay attention to bearish market structure then, what I would like to see is that when it comes to bearish market structure, what we can be looking at is we can looking for the market to expand higher, form this high, retrace, and then have one more expansion leg higher. The moment that this swing high forms and we see the market displace below the low, which set up this final run above this old high, that is to us the confirmed change in the state of delivery. A change in state of delivery can already be confirmed higher up. However, to play it safe, I would like you to start investigating this low being displaced through. The moment that we displace through that low, we would like to see it be utilized as resistance price. Meaning, the moment that we displace below this low right here, that's our change in state of delivery confirmed, and we now know price would change from buy program to sell program. Now I understand that some of you might be looking at the schematics which I've decided to put in this presentation. You might be thinking to yourself, but is there always a higher high, or is there always a lower low within the bullish examples? No. And the reason why is because what could happen is that we see a failure swing taking place, where a mitigation block gets created. If that occurs, look for intermarket relationship and whether or not the correlated or inversely correlated market actually did that full run, did that full manipulation leg, because that would be SMT of course. But in general, the moment that we displace below that low, which set up that final run higher, that is to us the change in state of delivery which has taken place. When we pay attention to the full example then within our market maker sell model, what I would like to start investigating is the following. Here you can see that we have an original consolidation. During this original consolidation, sales liquidity is being engineered right here. This is our draw liquidity. Notice that the market expands towards the upside and we see the bias of the curve deliver. Throughout this bias of the curve, what will happen is that multiple imbalances in the form of bullish for value gaps will form. We see the market eventually reach a point of interest, and once it reaches this point of interest, what we will be looking for is the reaction to that point of interest. The moment that the market displaces through this final imbalance, which formed right here, it's already the first sign that the underlying order flow is beginning to change from buy program to sell program. Buy side delivery, sell side delivery. The moment that price, however, displaces below this low, which set up this final run higher, that is when the CSD is truly confirmed, and that is the safest entry. This is why it's called the low risk sell within our market maker sell model. This low forms ideally in a bullish value gap on the left side of the curve. Why? Because then we not only have a bearish breaker right here, But we also have this bullish value gap, which we can extend to the right and treat as an inversion of the value gap. If these two arrays are getting displaced through by the creation of a bearish value gap right here, a CB, that is when you have three different arrays forming in each other. And once you start thinking about time cycles and once you start thinking about the key levels, yep. And this is not like, I'm hinting at this now because this is not something which like I'm going to try out easy. It's simple as that. So some of you want to get to know exactly everything to the tick, and I definitely suggest you to pursue that path, but some of you just want to keep it simple, so to say. If you want to keep it simple, just stick to what I'm outlining to you here, but if you want to take it to another level, investigate previous cycle highs, previous cycle lows, and investigate the element of price. And when you start looking for the alignment, where these specific arrays are forming, you'll smile. When we pay attention to a chart example then, what you can see is that in front of you, you can see a market maker sell model with an original consolidation being down here, buy stuff of the curve, sell stuff of the curve. I would like you to pause this part of the lecture for a moment, and I would like you to highlight for yourself where the change in state of delivery took place. And I understand that this delivery might be tricky to look at, and that's exactly why I chose it, so that you can really dive deep into where this CSD got confirmed. I know that some of you never pass these lectures because you just want me to give you the answer. Honestly, just watching a lecture or just, like going through these lectures as if it's some type of Netflix series is not going to do you any well. You must treat it as if you're really studying. That is so important, guys. Right, I hope that you passed the lecture, because here I've added lipstick. What you can see is that I've outlined a bearish value gap. And this bearish value gap by itself doesn't really mean anything just yet. However, what I would like you to see is that when we pay attention to this delivery, what you can see is that the market was expanding towards the upside. This was very slow and there was a lot of back and forth going. Notice, however, that around 10 o'clock right here, you can see that we formed this imbalance. We see the market then expand higher, and notice that it slowly delivers towards the upside. It's in a very slow way being delivered higher. This is a high resistance liquidity run. What you can see is that eventually around 10:30, right here, the market forms this high, and we see it displace towards the downside with these large down close candles. The market retraces, right here, and consolidation is taking place. We then see the market expand towards the downside, and this is where our first value gap is being created, right here. Do you see that this value gap is being created once the market displaces below the low, which set up this retracement higher and this consolidation? That's a crucial algorithmic signature, because from that moment in time, you need to see this CB function as resistance price. Therefore, I'm anticipating the moment that I see the market expand away from that CB, that we are in fact now in a sell program, that it is confirmed. However, when you pay attention to the left side of the curve, it isn't really clear yet how you can utilize inversion value gaps to basically gouge the order flow, except for this imbalance right here. Whenever that's the case, I'm giving you the tip now to zoom into a lower time frame. So in front of you, you can see the 1 minute time frame of Nasdaq. We're now going to drop into the 15 seconds. Here on the 15-second time frame of Nasdaq, and when we pay attention to that same delivery which occurred around 10 o'clock in particular, you can see that all of a sudden there's a sequence of imbalances which is very clear right here. Do you see how the market tapped that sequence of imbalances multiple times? And when I mention sequence of imbalances, I'm literally meaning this full area in which we saw 3 imbalances in a row form. Imbalance 1, imbalance 2, imbalance 3. I'm extending that full range to the right. Do you see how the market tapped that range multiple times throughout this delivery? Here, 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 and here something interesting occurs. Do you see that we retrace into that higher bullish box, which was that 1 minute CB? Do you see that we form a high in that area and then displace towards the downside? Do you see how we expand lower? And here something important occurs. Do you see how the market reprices outside of the range of this sequence of imbalances and how it retraces into the imbalance which got created throughout this exponential leg through that sequence of imbalance on the left side of the curve. Yep. Hidden in plain sight, only visible for those that know what to look for. So again, if you do not see any imbalances on the time frame that you are looking at the markets at, zoom into a lower time frame, because I promise they're going to be there. And when you extend them to the right, you are going to see their importance. What I would like you to do, now that we've come to the end of this lecture, is I would like you to literally go into your charts and I would like you to collect as many examples as possible of a change in the state of delivery taking place. The way that I suggest you to do this is to literally just go to a blank chart, doesn't matter what market it is, but just go to a blank chart and pay attention to how the left side of the curve influences the right side of the curve within a market reversal. If you start paying attention to the prior steps which I've outlined throughout this model series as well, you are going to smile. We are going to expand upon this information moving forward, but I've dropped many gems throughout this lecture and I really suggest you to dive deeper into it. I want to wish you good luck in your studies and look forward to speaking to you soon again. Be safe! Hello there, I hope that you are doing well. Welcome to this new lecture of the 2025 model series. During this lecture, I will be discussing a requested topic, and that is entry patterns. Entry patterns are methods of getting into the marketplace. It's important to understand that entry patterns by itself mean absolutely nothing, and that is something which I'm going to put emphasis on during this lecture. With that being said, let us dive into today's lecture. First of all, I want you to understand that an entry pattern is a way of getting into the move of point A to point B. That's all an entry pattern is. It's nothing more than that. The entry pattern itself is the least of importance. Your job is recognizing A to B. Pick your favorites and stick to them. What I mean by this is the following. In due time, you are going to have tried out multiple entry patterns and you're going to have seen which ones suit your personality and which ones don't. Some of you could be taking a particular entry pattern, whilst others take a completely different entry pattern. Whilst in reality, it doesn't really matter what entry pattern you choose, because as long as you're good at recognizing point of interest to draw liquidity, then everything will fall into place. Here we are at the example which I've been utilizing throughout this full model series. Inside of this chart, what you can see is point A to point B. And what this represents is the following. What this represents is a bearish expansion towards the downside, where you can see that the market moved from this inception to this terminus, with point A being inception and point B being terminus. It's inside of this range that your entry patterns on the downside, meaning bearish entry patterns, will present itself. I'm going to walk you through 3 entry patterns, which I believe to be the most important, and I'm going to share my thoughts on each one of them. First of all, we're going to be paying attention to the breaker block. The breaker block is, in my opinion, one of the strongest algorithmic signatures which you can look for. And the reason why is due to the following. When it comes to trading low risk sells within any market maker sell model, it's important to understand that the breaker block itself is basically the first real entry opportunity after the smart money reversal has taken place. Meaning, what the breaker block looks like is the following. What I would like to see is that the market expands towards the upside and we see a high get created. A retracement occurs and we then see the market create a higher high. When the market then displaces below this low, which set up the creation of that higher high, we are waiting for the market to retrace back into that low, into that down close candle, because that is our bearish breaker. The moment that price displaces below the breaker, it's low right here, what we can look for is we can look for a retracement into that low, and when the market retraces into that low, that's a potential entry. Our stop loss will be placed above the smart money reversal, meaning above this high. If you would like to be a bit more aggressive, you could also place it above the breaker's high, but there are specific rules on that when it comes to, for example, lower time frame balanced price ranges, which I will discuss later throughout this model series. But what is important to note is that when it comes to breaker blocks, it's important that you begin looking for these from your point of interest. Meaning, don't go into the charts and simply say, oh, I see a breaker block, therefore it's a trade. No, that right there is a common misconception which a lot of people make. Look, you must understand that the logic from point A to point B is ruling. Meaning, point A has to be recognized because when you see the market expand away from point A and you have already predefined point B, only then will you consider taking a bearish breaker block entry on your demo account, of course. I will never tell you to go out here and trade on the live account. I'm not a financial advisor. I'm not putting myself at any risk. However, if you get confident with this entry setup and you see it play out again and again and again, you can decide for yourself whether or not you would ever want to put real money at risk right there. When we pay attention to the second entry pattern then, the second entry pattern looks like the following, and this is the mitigation block. What the mitigation block basically is exactly the same as the bearish breaker, except there's one adjustment. And what the adjustment is the following. What I would like to see is that the breaker created a higher high. But with the mitigation block, what you can see is that a lower high got created. Meaning we saw the market expand towards the upside, a retracement occurred, and we then saw the market form this low. The market then expands higher, but notice that it does not take out this previous high. Instead, we create a lower high. The reason why this is important is because when market 1 does this, whilst market 2, for example, creates that bearish breaker, we're seeing S&P. Meaning one market creates a mitigation block, whilst the other market creates a breaker. Something to think about. When the market displaces below this down close candle, and we see the market retrace into that low, that's a potential shorting opportunity. We can place our stop above the high, which set up the expansion lower. Keep in mind that this is how we trade a mitigation block. Now, I can already hear you ask yourself, but is there one pattern which is stronger than the other? Is there a difference between the significance of a breaker or a mitigation block? No, there isn't. Meaning, I want you to understand that both a breaker as a mitigation block both have the same level of significance. And the reason why that is the case is because they are both swing formations which are occurring. It's always either a breaker formation or it's a mitigation block formation. There's no other way. Meaning, you must understand that inside of every single market reversal that takes place, you will see either a breaker or a mitigation block. And when you see one market create a breaker, whilst the other market creates a mitigation block, that is SMT. And if you have watched my lecture on SMT, on Smart Money Time, you should already have seen that. When we pay attention to the third entry pattern then, what I would like to see is that the third entry pattern is the fair value gap. And this is a rather simple entry in my opinion, and it's also the entry pattern which in my opinion stands out the most. I can come to any chart and I can just mark up fair value gaps just like this. What I would like to see is that what the fair value gap creation looks like is the following. What you can see is that there are 3 candles which get created right here towards the downside. Notice that when we pay attention to candle 1, it's low, right here, and candle 2 expands through candle 1's low. Notice that candle 3 then doesn't reprice higher back into candle 1's low. Instead, we see the high form below it. That right there sets up the creation of a fair value gap, where there is a lack of buy side delivery between the range of this low, so candle 1's low, and candle 3's high. That means that price will seek to retrace into that CB, into that bearish fair value gap, and we will see the market offer buy side into that, and that is our entry opportunity. When we enter in a fair value gap, our stop loss is always placed above candle 1's its high right here. One thing which I want you to understand is that it's possible that there are multiple fair value gaps in a row. In my chart example, you can see that that's not the case because I've chosen to just show one fair value gap. But if there is another fair value gap above here, you must allow for the market to trade into that fair value gap, meaning your stop will even be wider then. Now again, the entry pattern itself is the least of our importance, meaning we pay attention to becoming very good at recognizing point A to point B, and the entry pattern is simply the method we use to get in sync with that move. Now there are ways of anticipating that fair value gaps are likely going to be left intact. This has to do with breakaway gaps, but again, this is something which we're going to discuss later. For now, it is important that you begin recognizing what these patterns within the delivery of price look like. What we're going to do is we're going to look at a chart example. In front of you, you can see a chart example, and I would like you to pause this lecture for a moment, and I would like you to investigate where you can see the creation of the arrays as I've just outlined them to you. I would like you to investigate where your entry would be. I hope that you paused the lecture because I'm now going to add my lipstick to the chart. What I would like to see is that inside of this delivery, what you can see is that the market was consolidating right here. We then see it expand towards the upside, and we see this high form right here. We then see the market expand lower aggressively, and do you see that throughout this expansion towards the downside, there are two imbalances which get created. We see one imbalance form up here, and a second imbalance right below it. When the market retraces into the lowest imbalance right here, that's a potential shorting opportunity. But keep in mind that simply looking at this chart, you might be thinking to yourself, but why is this a short then? There's of course a way bigger picture in mind here why I took this short exactly at this price level. However, I want you to understand that when it comes to entry patterns and becoming good at recognizing them, all you do is you pay attention to, okay, where does price expand from? So this is point A, and let's say that point B is down here. You look for an expansion lower, a retracement higher, and you pay attention to where the high of that retracement forms. And what you can see is that it forms inside of this CB right here. We see the market expand lower, and notice that we take out sales at greatly resting below this low. Instead of continuing expanding towards the downside, we form this low right here. We see the market retrace higher once more, trading into that lower CB, into that lower bearish value gap, and we then see the market expand towards the downside once more. What I would like to see when you pay close attention to this delivery here is that we have this down close candle right here. Do you see how the market expands below that down close candle its range and how the next candle retraces into that range? Notice, however, that we did not create a lower low yet relative to this low. We see the market take out this low right here, and notice how the market retraces into that long wick right here. What's happening here is that this price range is being balanced out, and balanced price ranges are crucial to understand. But what I would like you to see is that when we pay attention to this delivery, you can see that this higher fair value gap was left intact. And the reason why was because there was no reason for the market to be repriced into that fair value gap. Think about the logic of inversion to value gaps when you pay attention to the left right here. As a newer student, I would suggest the idea of using a wider stop. But as a more experienced student that has already gotten a good understanding of balanced price ranges, you should be able to understand why this gap was allowed to be left intact, and you understand why that is actually the invalidation level for this idea, meaning you don't want to see the market trade into that gap. When we pay attention to another chart example, what I would like to do is I would like you to pause the lecture once again, and I would like you to try and see where the entry patterns present itself. Now, please keep in mind that when you are looking at this chart, you might see different entry patterns than the ones that I'm about to highlight, and that's all right. You must understand that everyone has their own personality. Everyone has their own perception, so to say, about the markets. Don't run away from your personality. Do that what feels best to you. Meaning, if you are not confident in trading low risk sells, then wait for that next displacement leg. Wait for that next imbalance to form, for example. I hope that you paused the lecture because I'm going to add my lipstick to the chart now. Here you can see my annotations on the chart, and what I would like to see is that we saw the market expand towards the upside, but notice that this was a very slow expansion. where I can see that the market was just grinding towards the upside. Eventually, the market begins to roll over right here, and we begin to see it displace towards the downside. What I would like to see is that we see a bearish breaker formation, where you can see that we formed this high, the market then retraced, and this big downward candle forms, and the market reprices higher, creating a higher high relative to this high. We then see the market displace towards the downside with this sequence of imbalances. Do you see how big those candles are? That's it by tipping its hand to you. And we see the market retrace into that imbalance before expanding towards the downside. Now, one thing which is important to note is that when it comes to these entry patterns, we can look for these entry patterns to line up with each other, meaning we can stack them on top of each other. So one of the best ways to look at this is, for example, when you look at a bearish breaker and you pair that with, for example, a CB forming inside of that range. Notice that the market retraces into both the bearish breaker as that CB, as in that bearish value gap, and the market expands lower. Now again, if you are not confident yet in this entry right here, what you can wait for is you can wait for the next imbalance to form. Meaning what you can see is that we form a new imbalance right here during this expansion leg lower, and the market retraces into that imbalance, and that's again a potential shorting opportunity. The stop loss gets placed above this high right here because that high should remain intact. Notice that the market expands towards the downside beautifully after some short consolidation here, and it draws towards point B. Again, keep in mind, point A to point B. It's not simply the entry pattern and therefore we look to trade. There's way more to it. Now, one thing which I would like you to think about is the following. What I would like you to think about is how the left side of the curve influences the right side of the curve. Because if you begin looking to pair these entry patterns, what you can look for is you can look at the significance of the left side of the curve to anticipate where these entry patterns are going to be presented on the right side of the curve. And it's something to think about. When we pay attention to the opposing side then, we're going to be looking at bullish examples. So when it comes to bullish examples, it's important to note that we anticipate price to move from point A, which is down here, to point B, which is up here. Inside of this leg higher, we are going to be looking for bullish entry patterns. Again, point A is the inception of this bullish expansion and point B is the terminus. The schematics themselves for the entry patterns are purely inverse. However, I'm going to still walk you through every single one of them. Here we can see the breaker block. When it comes to the breaker block within a bullish scenario, it looks like the following. Where you can see that the market expanded towards the downside and we formed this low. A retracement occurred and we see the market form this high in here. The market then expands towards the downside one more time, taking out this previous low. When the market takes out this low and we see it then displace above this old high, which set up that final expansion lower, the last upclose candle right here becomes our bullish breaker. When the market retraces into that upclose candle, that right there is our potential buying opportunity. Our stop loss gets placed below the smart money reversal right here, and that's the safest stop which there is. When it comes to the bullish mitigation block then, what it looks like is the following. When it comes to the bullish mitigation block, what I want you to see is that the market forms a low right here. We see it then expand towards the upside. And notice that we still make one more leg towards the downside. Notice, however, that we create a higher low relative to this low. That's important because within the bullish breaker block, what you saw was that we saw the market create a lower low. When the market then displaces above the last upclose candle right here, we anticipate that this upclose candle is likely going to function as support on price. So when the market retraces into that upclose candle, that's a potential buying opportunity. Our stop loss gets placed below this low right here. That's the safest stop loss placement. When it comes to both breakers as mitigation blocks, it's important to note that when market 1 creates a breaker, whilst market 2 creates a mitigation block, after we saw the market form the smart money reversal, it's very important to understand, that is SMT. And when that SMT is present, that's to us the confirmation that the low is in and then we're likely going to see the market displace towards the upside when this is all occurring during our time of interest. When it comes to the fair value gap creation then, what I would like to see is that a bullish fair value gap looks like the following, where you can see this sequence of 3 up-close candles. When we pay attention to this sequence of 3 up-close candles, what you can see is that between these 3 up-close candles, you can see that there's a lack of sell-side delivery. Meaning, when you pay attention to candle 1 is high and candle 3 is low, you can see that there was a lack of sell-side delivery. Meaning there's a difference between this high and this low. So when candle 2 expands higher, you must understand that there's no sell side which is being offered when the market expands above this high. Therefore, we are monitoring whether or not the market is going to retrace into the fair value gap which is being established right here. We see that retracement taking place, and when that retracement occurs, that's a potential buying opportunity inside of a bullish fair value gap with our stop loss being placed below candle 1's low. Now again, it's possible that there will be multiple imbalances. If that is the case, we place our stop loss below the lowest imbalance. There are methods of recognizing breakaway gaps. However, for the sake of simplicity throughout you recognizing entry patterns right now, I'm not going to be discussing that, because then this lecture is going to be on a completely different topic, which is balanced price ranges as such, and that is something which I'm saving for later within this model series. For now, simply focus on recognizing these fair value gaps. And when you recognize these fair value gaps and you become good at recognizing A to B, you will see that the retracement into a fair value gap will set up the next expansion into your anticipated direction. When we pay attention to a chart example then, what I would like you to do is I would like you to pause this lecture for a moment, and I would like to try and break down why the market expanded higher the way that it did. Now, if you want to look for entry patterns on the left side of the curve, meaning through this down move, you can also do so. I hope that you paused the lecture, because I'm now going to add my lipstick to the chart. Here you can see my annotations, and what I would like to see is that when you pay attention to these annotations, is that I've outlined the buying opportunities which present itself. Notice that we saw the market form a low right here, around 10 o'clock, and notice that we saw the market reprice higher significantly. Do you see how quick these up-close candles right here are? Do you see how we create this imbalance, this BC, bullish fair value gap? Do you see how there was a lack of sell side delivery between candle 1's high and candle 3's low? When price retraces into that imbalance, that's the first entry opportunity. That's our potential low risk buy. However, if you miss this opportunity, or you want to wait for more confirmation, so to say, it doesn't feel right yet, because you are more confident in trading the second entry opportunity, what I would like to see is that when the market expands away from this imbalance, you can be looking for the creation of another imbalance. So here you can see that there's a tiny imbalance which got created. Do you see how the market retraced into that imbalance right here? But if you want to see more than simply that imbalance, look on the left side of the curve. Do you see this up-close candle? This is your bullish breaker. The reason why I did not annotate it was because I wanted to purely focus on the imbalances with you within this example. But it's important to see that you recognize this is a bullish breaker. Expansion lower, we form a low, retracement higher, and we see the market expand towards the downside. Therefore, this is your bullish breaker. This up-close candle can be extended to the right, and pay attention in what range this imbalance formed. Now, one thing which is also important to note is the following. When you pay attention to the left side of the curve, you can see that we have a tiny bearish value gap right here in which this high formed. When we see the market reprice above a high which formed inside of an imbalance and a new imbalance gets created on the right side of the curve, that's why market starts shift pattern. And when you start looking for that pattern, you will see that in every single key market reversal, that pattern is presented. If you do not see it on the time frame that you're looking at, zoom into a lower time frame because it will be there. Now, when the market retraces into this imbalance, we see it expand higher once more. Do you see that there's a new imbalance which gets created right here? Do you see how the market retraces into that imbalance and then expands higher once more? and it creates a new imbalance right here. Now you often hear people say that it's hard to enter into positions, it's hard to find the trades, but it's hard to see an opportunity. In front of you, you have 4 different entry opportunities. Simply using fair value gaps. Think about that. By simply focusing on the fair value gaps, there were 4 entry opportunities inside this example in front of you. Do you understand that there's absolutely no reason for you to feel the fear of missing out, or to feel like you've missed out on a move when you saw the market expand away from that first value gap and you're not in yet? Look, there will always be a new entry opportunity as long as the move that you're anticipating from point A to point B is still large enough, meaning as long as there's still enough room within that anticipated expansion. And that's what is crucial to understand. Now, every single fair value gap which got created, every single entry had the same stop loss criteria. But if you would like to play it safe and you would like to basically give it a bit more room, whenever the market retraces into, for example, this fair value gap right here and decide to take this entry, what you can do is you can say, okay, instead of taking it with a stop loss below this low right here, meaning the first candle's low which set up the creation of this imbalance, you can play it safer by giving it a bit more room and placing a stop loss below the low which formed inside this imbalance. Because we never want to see lows that form inside imbalances be taken out if the market displaced higher. The only scenario in which that would be allowed is if that low is the high of a higher time frame imbalance. So for example, in front of you, you have a 1 minute time frame. It could be that that low is the high of a 5 minute imbalance. Only then would it be allowed to be taken out. But in general, you never want to see lows be taken out that formed inside imbalances and that set up new displacement legs higher. Here we're at another chart example, and this one is a bit more tricky. However, I would like you to again pause this lecture and I would like you to try and investigate where the entry opportunities present itself. If you would like to pay attention to the expansion towards the downside, that's possible, but we're purely focused on the expansion towards the upside here. I hope that you paused the lecture because I'm now going to add my lipstick to the chart. Here I've added my lipstick to the chart, and what you can see is that we saw the market expand towards the downside throughout the left side of the curve here. Do you see how the market was very slow and it was very gross delivery, where the market was just delivering lower in a very slow manner with a lot of back and forth going right here? That's a high resistance liquidity run. Whenever you see a high resistance liquidity run on the left side of the curve, you can anticipate that a low resistance liquidity run will take place on the right side of the curve. Now, I am sure that a lot of people probably clicked away from this lecture early on because they thought, oh, this would simply be a simple lecture on entry patterns and whatever, and they're not picking up on those gems. And the reason why I teach this way is because I'm not teaching simply weak-minded people. I'm teaching to the people that are actually strong-minded, that have the patience to sit through long lectures, that have the patience to investigate these boring things. Because you must understand that it's by investigating these simple schematics, these simple boring entry patterns, that you will see how freaking often they repeat. And once you start seeing that again and again and again, you begin to realize, hey, they're actually algorithmic signatures. And when you recognize those algorithmic signatures within the right bigger picture from point A to point B, that is when you're able to say with great confidence, this is what's likely going to happen next. What I would like to see is that we see the market expand towards the downside, and eventually we see the market have one more push lower right here. Do you see how the market begins to accelerate towards the downside right here? Notice that we form a low and the market reprices higher. We see a bullish value gap getting created, but notice that the market does not retrace into this value gap. The reason why it doesn't have to is because on the left side of the curve, we have this bearish value gap, which we can extend to the right. Therefore, this is a breakaway gap, since this is already a balanced price range. Notice that the market takes out this high, which set up that final expansion leg lower. And when it comes to recognizing the final expansion leg lower, that's relative. Meaning, you could also argue that this is the high which set up the final expansion leg lower. Both are valid. This is the more aggressive way of recognizing a change in the state of delivery, and this is the more safer way. Notice that we see the market form an imbalance right here. And notice how the market consolidates around that imbalance. Why is the market consolidating? The reason why the market is consolidating right there is because long orders are being fulfilled right there. So price is being held inside of a tight range, time distortion has taken place, and inside of that consolidation, longs are being filled. Notice how the market reprices into that high, which sets up that final expansion lower. Notice how we reprice into this downward candle, but notice that the fair value gap below remains intact. We see the market eventually expand towards the upside, and notice that we see this very tiny fair value gap getting created right here. The market retraces into that fair value gap, and the market then begins to consolidate once again. What's happening right here? What's happening throughout this consolidation is again that the long orders are being fulfilled. Why? Because they're waiting for the right time. And when the right time eventually presents itself, that's when you see the market begin expanding towards the upside with a lot of speed and velocity. And that is how you can recognize expansions before they occur. Small ranges turn into large ranges. And I know that this is not about entry patterns anymore then, but this is something to think about. And with that being said, I would like you to thank you for watching this lecture. I want you to investigate everything which I outlined to you. I would like to go into your charts and try and investigate these entry patterns. I would like you to go out here and try and become very good at recognizing these entry patterns. Once you have confirmed that the smart money reversal is in, that's a keynote which I would like to end this lecture with. And I promise to you that if you investigate these entry patterns in depth, in the right order, meaning not simply going to the charts and look for an entry pattern. Now look for all the previous swings which I've taught to you and only then look for the entry pattern. You'll be amazed. Want to wish you good luck with your studies and look forward to speaking to you in the next lecture of this 2025 model series. Be safe. Hello there. I hope that you're doing well. Welcome to this new lecture of the 2025 model series. During this lecture, I will be discussing trade management. So far throughout this series, I've outlined to you how to anticipate when and where a trade setup is likely going to present itself, how to frame the trade idea, and how to actually enter into the position. However, during this lecture, what I will be discussing is how you can manage your position as it is ongoing. Now, when it comes to trade management, one of the most important things to understand is that you must align yourself with icttrading. This, however, takes place before you even enter the position, meaning in advance of you pressing the buy or sell button, you must have already determined how you anticipate that the market is going to deliver. Do not make that anticipation and to make that analysis would be foolishness, right? Only put on a position when you know exactly what should happen next. If there's any doubt about what's likely going to happen next, you shouldn't even be in the trade. If you do find yourself in a trade that you know you shouldn't be in and your subconscious is signaling to you to get out, so you could notice this by, for example, that your heartbeat begins to rise or that your palms begin to get sweaty or that you begin to get a headache or you begin to just notice that you're overthinking, etc. All those signs that are present then are signaling to you, get out, meaning get out of the position and log the outcome, journal it. And the reason why this is very important and why I'm bringing this up at the beginning of trade management is due to the fact that you do not want to fall into the trap of creating a toxic cycle for yourself where you're justifying getting into poor trades and that once you're in that trade, you're just managing it, so to say, simply because you put on the position. No, whenever you put on a trade, and you realize that you shouldn't be in that position, you immediately get out of the position. That right there has to be the standard operating procedure. Because that is something which I'm teaching to you within this model series, is that I'm basically teaching to you how to make your whole process and your whole approach to the markets way more objective and way more mechanical in the sense of these are the standard operating procedures. This is the SOP. This is what I'm supposed to do at this moment in time. And that sometimes means that you need to simply say, okay, you know what? I'm not going to go out in the markets and risk equity right now. Simply close the position and lock the outcome. Now, when it comes to trade management from a technical perspective, however, there are a variety of things which we can look at. And those are the things which I want to put emphasis on during this lecture. In front of you, you can see the Nasdaq 1 minute time frame. And we're not going to be discussing how we framed this market maker buy model and how we were able to ride the market up higher. It wasn't just me who took this trade. Many other students took this same trade on the 6th of May 2025. And the reason why I mention this is because that should be a source of inspiration, that the information which I'm outlining to you is transferable, meaning other people are able to do the same things as I'm doing them. And that shows that the theory which I'm teaching with regards to time and price, it's transferable. And therefore, that should be a huge source of inspiration. That is not me guaranteeing to you that one day you'll be able to trade like me. I'm not saying that. However, I am saying that if you put in the required time and effort, you are going to look at these markets from a completely different perspective. And you decide on your own to one day maybe put on risk or not if it isn't for you. But with that being said, what I would like to do is I would like you to pause this lecture for a moment. And I would like you to look at this delivery which occurred. And I would like you to try and basically visualize for yourself where you would feel comfortable entering the position and how you would manage the position as it's continuing to move higher. Now, when it comes to trade management, it's important that we begin looking at trade management through the lens of the following perspective. First of all, we have defined the whole idea already. We have defined that this is likely going to be the smart money reversal. So we saw the sell side of the curve. Now we anticipate the buy side of the curve. That's a given. That's a must. However, when we look at trade management in particular, we must pay attention to entries, invalidations, and targets. Entries are the price at which you look to enter the position, at which you want to, in this case, buy the market. Invalidations are your stop loss. This is where your idea of higher prices gets invalidated if that level gets crossed. And that is basically where you put your stop loss. That is where you protect your capital, your equity. And your target is the level that you're aiming for. And usually it's not just one target, you have multiple targets. Invalidations, you only have one of. But this invalidation level moves as price continues to expand in your favor. That's something which you will see. So I hope that you paused the lecture and I hope that you paid attention to this delivery and that you investigated how you would have managed it. Because what I'm going to do is I'm going to zoom in with you. I'm going to make my lipstick appear on the chart. And what I would like to see is that I've just put my lipstick on the chart. And what you can see is that first of all, I've outlined an original consolidation. This original consolidation is up here. And what I would like to see is that when you pay attention to this original consolidation, you can very clearly see that the market consolidated here, expanded lower, and we saw the market eventually turn around and begin drawing higher. Now, what we are discussing during this lecture has to do with how we manage our position as the market is expanding in our favor. Now, as price is turning around right here at exactly the opening of the third 90-minute cycle of the morning session at 10 a.m., what you can see is that the market has this imbalance which gets created right here. This imbalance gets created inside of this bullish breaker, this upgo candle. Why is this breaker? Well, you see an expansion lower. We form a low, market retraces higher, and it forms a high inside of the CB right here, below the CB which I've annotated, but we'll get to the importance of this higher CB in a bit. And we then see the market have one more push lower, forming SMT, and we reach a point of interest. Point of interest is 19,750, as you can see. And do you see how the bodies are respecting that level right there? This is one of those algorithmic signatures which I like to see, where I see that the market is respecting specific levels which I'm monitoring to the tick. Because when I see that, that is signaling to me IPDA and the algorithms which are delivering price. You must look at IPDA, by the way, and this is just a side note. IPDA by itself is just a term which we utilize for all these algorithms which are responsible for the repricing of markets. That's something to think about. But when it comes to the market respecting a specific price level which we already know in advance, and we see the body is respecting that level to the tick, that right there is the algorithmic signature, which shows to you that these high frequency trading algorithms are firing long orders at this stage. They're beginning to change from sell program to buy program. This large opco candle right here, which forms this BC, shows that to you because you see my market structure shift pattern. CB, high, BC. The retracement into this BC right here can be your entry. Where is your stop loss going to be? Now, this right here depends on a variety of reasons. And as a newer student, you should consider placing it below the SMR, placing it below the smart money reversal. That is the safest possible option. And the reason why I mention that is because when you're completely new, your job is to basically make sure that you're in a position and that you're able to manage it as best as possible, right? When it comes to experienced students that have seen what I'm outlining right here in front of you over and over again, you know that the stop loss can actually be placed higher. Why can it be placed higher? Well, the reason why it can be placed higher is due to the following. When we pay attention, I'm just going to zoom in for you right here. When we pay attention to this old low right here, do you see how this sell-side liquidity pool was taken out by this long wick? And do you see how the body's kept on closing above it right there? That sell-side liquidity pool was engineered at a specific level. There's no need for the market to ever return back towards that level unless your idea is wrong. So what that means is that your stop loss can be moved towards this low right here. Now you see that the difference in this example is only minor. There aren't a lot of difference in terms of points. However, you must understand that as the volatility increases and you begin looking at, for example, bigger price swings, you must understand that that minor difference can really be the difference when it comes to your position sizing. And therefore, this is where the invalidation is for me. Notice that this lines up with that key level right here. I would never want to see the market trade below that key level again after we already saw the reversal sequence in play right here. Meaning, this is my initial entry with invalidation. Target is that buy side liquidity pool. Now, what I would like to see is that as the market continues to find support inside of this BC, and I'm not saying, by the way, that this is the final objective, because the final objective was way higher, right? However, when it comes to trade management, I'm simply showing to you, this is how you can objectively define entry and validation target. And this is simply an example of a market maker buy model, which we're discussing now. But understand that you should frame these setups from the sequence as I've been teaching it to you within this model series. So always from a higher time frame down into a lower time frame. What I would like to see is that when the market forms this low inside of this BC and we see this expansion higher taking place, do you see how the market then reprices above this CB to the left right here? This CB is important because when you pay attention to this CB, you can see that this was the highest CB which formed throughout the left side of the curve. Meaning you have a sequence of imbalances right here which displaces through this low, 930 low. My eye is drawn towards the highest CB of that sequence of imbalances. I can already frame a long setup from the lower CB once we displace through that. But when we displace through the higher CB, that's when I know, okay, price is now actually in a buy program and it's absolutely 130% confirmed. So what I can do then is say, okay, well, when the market closes outside of that CB, I want to see that CB function as inversion value gap. I want to see it function as support and price. Therefore, when the market eventually retraces right here, that's again a potential buying opportunity. That's again an opportunity to get long if you weren't long yet. Here comes the thing. What I'm doing is I'm pyramiding into my existing position. So that means I'm adding more to a position which is running in my favor. And by adding more contracts to the position which is running in my favor, I'm able to increase the potential profit on that position whilst keeping the risk relatively equal or whilst having way less risk. Because here comes the thing. When I see the market reprice higher like this, and I see it reprice above the high which set this retracement lower, there's absolutely no way that I would want to see the market trade below this low. The reason why is because of the following. This low already showed a willingness to reprice higher. Why? Because do you see how the bodies kept on closing outside of that BC? The only scenario in which this low could be taken out is if there would be SMT present quickly, meaning where one market would take out this low whilst the other market does, and then a quick rejection to go higher. However, that is not a preferred scenario in this case, and the reason why is because we already displaced above this CB. So what I want to see is I want to see the market retrace. I'm buying more in this area right here, understanding that the market is going to expand likely soon. And therefore, when the market has this push higher, where you see this large upclose candle and you see it just run right here, from that moment in time, my invalidation moves. Meaning, initial invalidation was down here, as we said. New invalidation becomes here. I would not place my stop loss right here. I would instead manually close it if I see displacement below that low taking place. So what I'm doing is actually basically monitoring my positions actively. And the reason why I'm doing so is because I want to be in sync with icttrading. This is not to promote the idea of basically being fearful or being like over worried about the position whatsoever. That's not what I'm doing. I'm making sure that I'm aligned with icttrading, because I know when I'm aligned with icttrading, it should expand when I anticipate it to expand. It should form a low where I anticipate it to form a low. And that is what a lower security run looks like. And whenever the market is not delivering as I'm outlining it to you here, and it instead trades below an invalidation level, that right there is a huge warning sign for the delivery which is about to come. When we see the market then displace higher away from this CB and we see this large BC get established, what my eye is drawn is the reaction to that BC. Do you see how we again tap into the BC and then expand higher? This is again eye of fact which is taking place, institutional order flow entry drill. Therefore, we should never see the market displace below this BC area again, and particularly this low, because this was a protected low, but that's something which we're going to look at in a bit. So when the market expands higher like this, what we're doing is our invalidation moves towards this low. Why this low? Because this low set up the creation of this imbalance. So every single time that the market is displacing higher, our invalidation level is moving and moving and moving. And what we're doing is we're minimizing the risk on a position which is running in our favor. Here comes the thing. As a newer student, your goal is to remove risk. You're fearful. You're not able to have risk on the table. Why? Because your mind isn't in the right state of mind yet. And that is something which we're going to discuss later during this model series and throughout future sit-downs, where I'm going to be teaching to you how to actually think like a trader. But what I want you to understand is that as a newer student, you're fearful of risk. However, if you have more experience, you know that there should be risk on the table, always. And therefore, what we can do is we can basically say, okay, instead of removing risk completely, the market is showing exactly what we need to see. Why not pyramid? Why not add to a position which is winning? And by adding to a position that is winning, we're able to maximize our profits whilst keeping the risk relatively equal. So when the market displaces higher like this, what I'm looking for is I'm looking for these new discount arrays to function as support on price. So what I would like to see is that when we pay attention to intermarket relationship, then on the left you can see Nasdaq, on the right you can see ES. What you can see is that when we pay attention to the low which formed inside of this BC, right here, this low got taken out on Nasdaq. Look closely. Do you see that? Let me zoom in. Do you see how they took out that low? Whilst on ES, when you pay attention to that low of 1009, you see that ES did not take out the 1009 low. So that right there is a very small SMT where you can see that ES created a breakaway gap right here, whilst Nasdaq traded into the imbalance. And that's important because that shows to you that there's an urgency for the market to begin running higher. There's no need for the market to retrace deeper into that imbalance. If there would be a deeper retracement, then you would already anticipate, okay, we're likely going to chop around for now moving forward. When the market eventually has this sequence of down close candles and we see this low form at 1014, what I'm thinking to myself is, okay, the moment that we expand above the high of this retracement, there's absolutely no scenario in which price should ever reprice below this low again. Why not? Because what's actually happening, and this is probably going to be too advanced for the majority of you as I mentioned this, but what's happening in the buy program is that every single key level is being displaced through and it's going to function as support. It might function as resistance as a first, that's going to set up a retracement, but when that retracement is completed and the market expands above the retracement high, that should now function as support and price. Why? Because orders are constantly being filled. Retracements are used to engineer new liquidity. This is our fractal market maker buy model. Sell side of the curve, buy side of the curve. So the moment that the market continues repricing higher, we anticipate a quick repricing to occur. Why? Because the buy side liquidity pool which we're targeting, or objective, is so close. And therefore, this is going to be a very quick expansion higher. So you see that the market keeps on running, and as it completes this market maker buy model, from that moment in time, what you can do is you can extend the original consolidation to the right, and then you can say this must function as support and price in order for continuation higher to occur. And this is an important insight to share with you, because when an original consolidation gets taken out, it must function as support and price within a market maker buy model for continuation of order flow to occur. And do you see how all these concepts come back to time cycles? How it all has to do with PXH, PXL. On the bottom right here, you saw a purge of the previous 30-minute cycle and then a revert taking place towards the previous 30-minute cycle high. When this previous 30-minute cycle high was taken out, we had to see it function as support and price for the market to continue expanding towards the upside. And please note that the previous 30-minute cycle high is this down close candle right here, but I'm outlining this up close candle because of the following. When you pay attention to this up close candle, what you can see is that it formed as a bullish breaker, where you see low to the left, and you see a high form, lower low, higher high. So this up close candle should function as support and price. It's a very important level therefore. Now, what I would like you to see is that the market eventually just chops around, but this is where we are able to say this is a low resistance market maker buy model. And when it comes to defining low resistance liquidity runs, you must be able to anticipate them coming from the higher time frames. So if you follow all the steps of this protocol, you will see where low resistance liquidity runs are taking place and where not. Later throughout this model series, I will touch on the full protocol, and we're going to be looking at flowcharts which you can use to investigate the delivery. When we pay attention to a bearish example then, what I would like you to do is I would like you to pause this lecture for a moment, and I would like you to try and see where you would enter in this sell program, where you would place your invalidation, and how you would manage this position. I hope that you passed the lecture, because I'm now going to add my lipstick to the chart. What you can see right here is that I've outlined multiple imbalances on the chart, and next to that I've annotated some levels. What I would like to see is that the market repriced above the 18,250 level right here, and we saw the market distort time up here. Do you see how it was just consolidating? Eventually the market reprices higher at 1028 right here, takes out buy side liquidity resting above this high, and we then see this large displacement leg lower taking place. Do you see how large these down close candles are and how quick they are? We see the market retrace, and the market just consolidates. It's going back and forth, back and forth, back and forth. Do you see, however, that there's a certain pattern which is being set up, and that's the following. What I would like to see is that we form this high, form a low, higher high, lower low. So what I would like to see is that within this bigger reversal which is taking place, you're seeing a smaller reversal occur, where you see that the market actually showed a willingness to displace below this low, which set up the final run higher. And therefore you know that between the time cycle of 10:30 to 11 o'clock, this low should function as resistance price. But here comes the thing. When you pay attention to a low to the left as well, this low, you can see that this low is also important because it's the low that formed exactly at 18,250, and it's the low that formed at 1031. Now, what I'm outlining to you is that I'm paying attention to at what time important lows and highs are forming. And by paying attention to time, and in this case, through the lens of 10-minute cycles, what I'm about to share with you is the following. What I'm about to share with you is that when we pay attention to 10-minute cycles, what you can see is that between 10:30 to 10:40 we have a 10-minute cycle. The low of the 10-minute cycle is right here. And do you see that between 10:50 to 11 we also have a 10-minute cycle? So what we're doing is we're dividing the 30-minute cycles into threes. And what you can see is that the market reprices between 10:40 to 10:50 through these lows that are crucial on the left. So first of all, this low right here, and through the previous 10-minute cycle low, this low. Do you see how this CB forms right here? Now, this CB by itself is a short. And the reason why is because at what time is this short being presented? At exactly 10:45, which is the beginning of our second macro for the New York morning session that we're interested in, meaning from 10:45 to 11:15. There are macros in advance of this, so 9:45 to 10:15 is also one which I like, and next that we also have them prior to the regular trading hours. However, the main focus should be on 9:45 to 10:15 and 10:45 to 11:15. So exactly at 10:45 the market retraces into the CB, and we see the market form a high there. Now, when it comes to managing this position, what I would like to understand is that when we refer back to the trade management of the entry patterns, as I've taught you throughout the previous lecture of this series, what I outlined to you is that whenever you have a CB, the stop can be placed above the first candle's high, which sets up the creation of the CB. So this candle's high right here. There's absolutely no way that price should get towards that level if we are in fact in a sell program. Why? Because look to the left, you have that previous 10-minute cycle low, which should function as resistance price, and there's no way that price would displace above this CB if we are bearish. Therefore, you must look at this as, okay, this is indeed a crucial CB. Now, if you believe that this stop loss placement is too tight for you, and you would like, and I'm referring to a market structure perspective here in terms of too tight or too wide. And the reason why is due to the following. When you look at the points, you can see that this is already a 40-point stop loss. And when you place it above this high, right here, you have a 76-point stop loss. That's a result of the increased levels of volatility at the time of this recording. However, understand that it's all around basically position sizing. And therefore, don't look at a maximum amount of points to be your stop loss. Surely, if your stop loss on a day trade is going to be hundreds of points, that's not worth it. However, when we are looking at, for example, a 76-point stop loss and we're aiming for a run of, let's say, 200, 300 points, that's still worth taking. Why? Because what you can see is that our objective at first is this southside liquidity pool, which formed throughout the first 10 minutes of trading. Think back to the market maker buy model, which I showed to you. I know it's majority of people, they skip through these lectures. They take the parts which they find interesting and then they move on to the next one. However, if you listen closely, you will hear that throughout the lectures that are completely on a specific topic, I actually hint at other things. That's just how I hide certain gems in plain sight, because I'm not teaching for the easy. I'm not teaching the person that is like, oh, show me how to do it and I'll do it next day, right? That's not how it works. You need to investigate the fine details, because by investigating the fine details, you're able to see what is hidden in plain sight. But what I would like to understand is that the stop loss placement which I showed here is the safest possible option. So for newer students, this is the stop loss placement, which is likely going to be the most comfortable at first. And the reason why is due to the fact that there's a lot of room for the market to retrace deeper than that initial entry pattern. However, if you're already more experienced and you have already gotten more chart, you know how icttrading delivers price and when it should deliver price. So when these volatility injections are going to take place, then you can of course manage it tighter. But for the sake of easiness, let's just say that this is going to be the invalidation at first. Now, when it comes to the next invalidation, which then gets established, you should see the following. What I would like to see is that when the market reprices lower and it takes out the low which set up the retracement into the imbalance, we want to see this high remain intact, the high which formed inside of the CB. And the reason why is because of the fact that if we would see CB high and then displacement above that high, that would actually be a bullish market structure shift, especially when a BC gets created. And therefore, the moment the price displaces lower here, and this comes back to what I outlined with regards to what happens in a low resistance security run towards the upside, but now inverse since we're looking at the sell program, it's a matter of basically aligning yourself with icttrading during a low resistance security runs, where every single expansion is going to get followed by a retracement, is going to get followed by an expansion. Whenever that second expansion occurs, you want to see the retracement leg which occurred function as resistance price. Therefore, your stop loss can be placed above this high next. And if you are not short yet, you can short the retracement into that low. Why? Because that low right here, too high, should function as resistance price. So when the market then reprices lower eventually, and we see it reprice below this sequence of imbalances, we want to see this sequence of imbalances function as resistance price. This does not mean that you're going to place your stop loss right above the box. Why not? Because price distortion should or could take place. It's not should, it's could. And you're probably like, price distortion? What's price distortion? Price distortion is when icttrading core is outside of the lines. Yep. Did he really just say that? Yep. Man, oh man. I have so many tools in my arsenal, and I'm slowly introducing some of them to you. But what I would like to see is that when icttrading trades below this sequence of imbalances, reaches 50% of the range between 18,250 to 18,000 right here, we want to see the market retrace into that sequence of imbalances, but we need to see the market close inside of this sequence of imbalances. Do you see how at 11:02 right here, we wick above the imbalance right here, but do you see how the bodies keep on closing inside of it? That right there shows to us that the underlying order flow is still bearish. But since this lecture is on trade management, you're probably asking yourself, how would I manage this position when the market displaces below the sequence of imbalances? Well, what you could be looking for is you could manually be looking for the following. What you can say is, okay, if price closes aggressively above this blue box, so you would see a big upclose candle above it, then you could say, okay, I'm going to cut the position. Why? Because you didn't see that sequence of imbalances function as resistance price. When it comes to placing a hard stop, so a fixed invalidation, I would say that when price expands lower like this, go to basically the latest upclose candle which formed before that expansion lower, or the latest high which formed, I should say, and then simply put your invalidation there. So my eye is drawn immediately towards this level right here. And the reason why is because I see this high right here at 10.53 and the market then expands towards the downside. So what you can see is that invalidation is simply due to the fact that, manual intervention could take place, an announcement could be made, and then you want to make sure that you're out of the short. However, if price would close above this sequence of imbalances, and you would see a big green candle, then it's already a sign of, okay, we're likely not going to roll over, manually close the position. And this is how you see that you must allow for basically I don't want to call it a room of less objectivity. That's not what I'm saying, because it is very objective. It's a very straightforward rule. When price does not utilize that sequence of imbalances as resistance price, you get out. That's the rule. However, you must monitor the position. It's not like you can just set the trade and walk away. Because think about it, right? And this is one of the things which really pisses me off about the whole trading industry. You have people that say, okay, you put on the trade and you just let it run. You don't manage it, you don't look at it, and you just lock the outcome in a few hours, right? But when you think about it, right, your perspective on the markets is becoming so objective where you're beginning to understand time and price. Once you get to that level of understanding, you can anticipate every single price swing. You can anticipate reversals before they form. And therefore, to not then protect yourself and actually take some small profit when you see that the underlying sequence has changed from sell to buy program is foolishness, right? So do you see what I'm getting at right there? Very important insight which I'm sharing with you here. So that's not to say, oh, you should not use fixed invalidations. Absolutely, you should use fixed invalidations. But in an example like this, you cannot say, oh, I'm going to, place my stop loss above the blue box, because you would get taken out here and then you would be frustrated when the market runs in your favor. Eventually, the self-set liquidity pool as the drawn liquidity gets reached, and from that moment in time, what we're monitoring is whether or not that row is going to function as resistance price. So what we can do is we can say, okay, this down close candle, this row can be extended to the right and should function as resistance price in order for the underlying order flow to remain bearish. What you see is that the market retraces into that down close candle, into the low of 930 to 10, and eventually continues expanding lower. Now, as price continues to trade lower like this, what you can do is say, okay, once this swing high forms, stop loss can be drilled to this high. However, when the 18,000 price level gets met, that's usually already a good level to get out. However, when we pay attention to the delivery which occurred, you can see that the market eventually just drops around for a bit before it continues to expand lower. You cannot look at this and think to yourself, oh, I should have been a part of that. No, why not? Because you already participated in the low resistance liquidity run, which provided you with a range of opportunity from here to the 80,000 price level of about 275 points. So when you think about that, I don't know where you're from, but if you're able to make 275 points on just one mini or a few minis, or even micros to be fair, that's already a good amount of returns which you're able to make right there. So don't think that you should be trading 1,000-point moves or whatever. No, learn to be content with enough. I hope that this raw style lecture has basically given you some good insights when it comes to trade management. When preparing this lecture, I thought to myself, do I want to make a presentation style or do I want to make more of a raw lecture style? And I believe that trade management is something which you learn through experience. So I hope that by me explaining these things whilst going over the charts with you, you have gotten a good insight from my own experience and that you have gotten a good idea of what to look for when it comes to managing positions and whatnot. I want to wish you good luck in your studies. Trade management is again something which you learn through chart time. So paying attention to what happens the moment that your entry presents itself. Don't think, oh, it's just entry, stop, target. No, look at what happens between the movement from your entry to the target. Because you will see that there are usually more opportunities to pyramid into a position. We'll dive into all of this with risk management and sure. However, look at where the opportunities are being presented and look at how your invalidation level can be moved as the trade progresses in your favor so you can decrease risk and such. Good luck with your studies, and I look forward to speaking to you in the next lecture of the 2025 model series. Be safe! Hello there, I hope that you are doing well. Welcome to this new lecture of the 2025 model series. During this lecture, I will be discussing risk management with you. Technicals make you fall in love with the game. Risk management keeps you in the game. Now, the reason why I would like to begin this lecture with this statement in front of you is due to the following. Many of you probably got introduced to the world of trading with concepts such as supply and demand, or you might have gone down the indicator path where you were trading based upon mathematical systems or whatever it might have been that you were using in the beginning of your trading career. And even with the strategies which I'm teaching to you within my mentorship, I would like you to understand that all these technical things that get you into a trade are all only working in the long run with proper risk management, and therefore risk management is crucial. And therefore during this lecture I want to put emphasis on 3 different strategies which you can look into when it comes to risk management. Now, first of all, I would like to pay attention with you to what I define as regular risk management. This form of risk management is used by the majority of traders, and it's in my opinion also the most easy way of managing risk. And the reason why this is the case is because when it comes to this form of risk management, there aren't a lot of moving parts. So what I would like to see is that when it comes to regular risk management, the first trade is always going to be 1% risk. Now, by the way, it's important to note that when it comes to all of the percentages, which I will be discussing during this lecture, they can be basically changed to whatever you are comfortable with, as long as what you do after a win and loss, in terms of what to do for the next position, in terms of percentage risk, stays the same. So meaning what you will see is that within regular risk management, what we do is that after a loss gets taken, the risk on the next trade gets decreased by half. So if you're risking for the beginning trade, let's say 0.5% risk, on the next position it will be 0.25% risk. But what you can see is that when it comes to this example right here, where we're using 1% risk in the beginning and we take a win, what we will do is we're going to maintain the same risk, meaning on the next position, we're going to maintain 1% risk. If we, however, take a loss and we have an idea which doesn't pan out as we had anticipated it to, we're going to decrease our risk to 0.5% risk on the next trade until the drawdown is recovered. So what you can see is that we're halving the risk on the next position. The reason why we're halving the risk on the next position is due to the fact that that way we're able to maintain our equity curve as smooth as possible. Let's say that this second trade is also a loss. If this second trade is also a loss, we're going to stick to 0.5% risk until the drawdown is recovered. So what you can see is that our job is to try and smoothen our equity curve by making sure that we do not have deep drawdown. If the next trade, however, turns out to be a winner, we're going to go back to 1% risk on the next position, and the same cycle repeats itself, where we're going to begin with 1% risk and move from there on. Now, what I would suggest you to do is I would suggest you to take screenshots of all the different risk management strategies, which I'm outlining to you during this lecture, and I would like to think about which one suits you best, and that's the risk management strategy which I would suggest you to investigate. It's important to note that I'm not telling you to use these risk management strategies. I'm only sharing with you my personal suggestions when it comes to these type of risk management strategies and trading. Let us take a look at a hypothetical example of applying regular risk management. Here you can see a sequence of trades, and we're going to be walking through the sequence of trades. What you can see is that this trader applies a fixed 1-to-3 risk to reward. And I personally do not believe in fixed risk to rewards. I believe that risk to reward should be dynamic, meaning it should change trade by trade. However, some people use fixed risk to reward, and for the sake of me showing to you the power of regular risk management, we're going to be using that. So what you can see is that at the first trade, the beginning equity is $100,000. The risk on this trade is going to be 1%. The outcome of this trade is that it's a loser. Therefore, the result of this trade is approximately minus $1,000. For the second trade then, what we can see is that the equity is $99,000. The risk on this second trade, however, is going to be 0.5%. And the reason why is because we're sizing down the amount of risk relative to the first trade, which was a loser. What you can see is that the outcome of this trade was a winner, and therefore the result is approximately $1,500 in profit. This means that for trade 3, we're back above the beginning equity of $100,000. We're going to be risking 1% again, and what I would like to see is that this trade turns out to be a winner, and the result therefore is $3,000 in profit. This means that for the fourth trade, the beginning equity is going to be $103,500. And as you can see, the risk on this position is going to be 1% once again. So what you can see is that this is a very simple way of applying regular risk management, where the risk maintains 1% unless the trader gets into drawdown, because then the risk gets decreased until the drawdown is basically recovered with interest. And therefore what this does is that it makes sure that no deep spirals take place within the equity curve. And this is a simple way of applying risk management, and this repeats itself until the profit objectives have been met. However, when it comes to this style of risk management, the focus has to be on what's occurring right here, where you can see that by trade 2, the risk gets halved. And the reason why this is so important is because whenever this trader enters into drawdown, he immediately decreases his position size, so he makes sure that he doesn't lose a lot during a losing cycle. And therefore what's occurring is that the moment that he gets back into profit with this 1.5K of profit, and he gets back above that $100,000 beginning equity, what it allows for is that it allows him to go back to the original risk. So the focus has to be on sizing down during a period in which losses are being taken. And notice that with this strategy, no sizing up takes place, meaning the risk maintains 1%. When it comes to prop firm risk management, however, I would like to discuss a different approach. And this is the approach which I would suggest to look into during challenge phases. I'm not telling you to go out there and go into prop firms, because I believe that prop firms actually are a bad way of getting into trading, and the reason why is because they are made for you to lose. The prop firm profits from you failing, and therefore there are all these type of different rules in play which are basically trying to make trading harder than it needs to be, and therefore it basically cultivates a very bad mindset for a lot of traders. However, if you would like to go down the prop firm route, then this is a style of risk management which you can look into. There are two different stages when it comes to approaching prop firms. First of all, there's a challenge phase, in which you're basically proving to the prop firm that you can trade consistently profitable. And secondly, there's the live trading phase. During these phases, I suggest utilizing different risk approaches. And the reason why is because throughout the challenge phase, you would like to be more aggressive. And that means that risk stays the same. Where during the previous risk management strategy, we decreased the risk when we went into drawdown. For this phase, we're going to maintain the same level of risk. And the reason why is because we do not want to spend too much time within the challenges, since there's no return on it, meaning there's no money to be made from the challenges. Therefore, within a challenge, what I suggest to look into is applying 20% of the total allowed drawdown in a challenge. So let's say that you're allowed to lose a maximum of $3,000 on a $100,000 account. What that means is that you would divide that number that you are allowed to lose by 5, and that's how you get 20%. And that is the risk which I would suggest utilizing during the challenge phase. And the reason why is because that way you're not going to be spending too much time within the challenge, because that's an issue a lot of traders face, where they go to these prop firms, they go through these challenges, and they stay in those challenges for a long period of time. Eventually they get funded and they think they have made it, but they realize that there's no money that gets made the moment that you pass a challenge. And therefore you wasted all this time, whilst in reality you should be more aggressive throughout the challenge phases. Now, when it comes to managing risk once funded on the prop firm, I would suggest the following approach to risk management, where the main focus should be on being conservative. This means that risk is going to change. And the reason why risk is going to change is because throughout bad periods, we need to make sure that the drawdown stays at a minimum. So this comes very close to the risk management approach, which we saw for the regular risk management. What I would suggest looking into is using 10% of the total allowed drawdown once funded as the initial risk. If there is a win which gets taken, the risk remains equal unless you have a big buffer, but we'll get into an approach to increase the risk in a bit. However, as a general rule of thumb, risk remains equal regardless of that you're winning. However, when you take a loss, I would suggest looking into halving the risk, meaning only using 5% of the total allowed drawdown until the drawdown which you're in gets recovered. So this approach comes very close to the regular risk management approach. However, please keep in mind that this is kind of different than the regular risk management approach, because we're not using 1% of the total equity. Now we're using a percentage as our basically risk based upon the amount of drawdown which we're allowed to have. And the reason why is due to the following. Why regular risk management does not work on prop firms. 1% risk of a 100k funded account equals $1,000. If your total max drawdown is $3,000, it means that you are risking 1/3 of your max drawdown. Meaning, in 3 trades, you could lose your funded account. Do you understand that that's way too quick, and therefore you cannot use simply the regular risk management as I've shown to you prior on prop firms? Now, if you're trading your own capital, it's a different story. However, when it comes to trading prop firms, you need to make sure that you're very conservative. And the way that you become conservative once trading a funded live account is by making sure that the percentage which you use as risk on every trade is a percentage based upon the amount of risk which you can have, meaning the total allowed drawdown, not simply based upon equity size, because that stuff doesn't work with prop firms, as you can see right in front of you. Now we're going to be looking at the third form of risk management, and this third form of risk management is called exponential risk management. And exponential risk management is a method of increasing accounts at a very rapid pace. However, this is a form of risk management which is not suggested for new traders. And the reason why is because when it comes to exponential risk management, first of all, you need to know exactly what you're doing. Meaning, you need to know exactly what you're looking for and when you're looking for it in the markets. Secondly, what you must be able to do is you must be able to distance yourself from the fact that you just made money, because on the next position, you're going to be risking a lot of that money which you just made. And that's something which we're going to get into. But when it comes to exponential risk management, what I would like to see is that we begin once again with 1% risk. And the reason why we begin with 1% risk is that for the sake of doing these calculations with you, it's just an easy number to work with. Whenever we take a loss on this first trade, what we do is we apply regular risk management, where we decrease the amount of risk on the next position until the drawdown is recovered. If we lose again on trade 2, we're going to stick to 0.5% risk until the drawdown is recovered. Let's say, however, that we take a win. We're going to go back to 1% risk and the cycle starts again, so to say. The fun with exponential risk management occurs when you go on win streaks, and the reason why is due to the following. If you take a win on your first trade, on the second trade, what you can look into doing is risking 50% of the trade, its profits. So think about that. Let's say that your initial risk was $1,000 and you just made $5,000. What exponential risk management suggests is that on the second trade, you're going to be risking 50% or maybe even 100%, but I would look into using 50%, using 50% of the profits which you just made on trade number 2 as risk, meaning you're going to be looking to risk $2,500 on the next position. If you then take a winner with the same risk to reward, so 1 to 5, you can see how the profits begin to increase very significantly within a short period of time. If you take a loss, however, on the second trade, you're going to go back to 1% risk, so the cycle begins again at step number 1. Let's say that you win again on trade number 3, that is where 25% of the profits of trade number 2 will be risked. And if this trade turns into a loser or a winner, we're going to go back to step number 1, which is risking 1%. So what you can see is that whenever you go on a win streak and you're applying exponential risk management, this can really make your equity curve quickly grow. However, you must understand that in order for you to go on a win streak in the first place, you must be able to know exactly what you're looking for and when you're looking for it. And therefore, this is a style of risk management, which is, in my opinion, not suited for the majority of new traders. And this is a style of risk management which is very aggressive and it requires capital. Meaning, if you do not have a lot of capital yet, I suggest you to be cautious when it comes to trying out exponential risk management. I understand that you might be looking at this and you might be thinking to yourself, hey, I'm able to make a lot of money when I'm on a win streak by just risking the profits which I just made. Yes, that's true. However, it's going to be a mental burden for you if the risk which you're using on these positions is too big. So therefore, be mindful of that. However, let's say that you're trading with prop firms, and let's say that you're trading a live account with a prop firm. First of all, 1% risk of the total equity is not possible, like we have seen prior. However, let's say that you're simply working with, for example, a regular amount of risk, so 10% of your max allowed drawdown. Let's say that you have a max allowed drawdown of, let's go back to $3,000. So let's say $3,000. That means that you're risking $300, and that is basically the risk for that first trade. Let's say that that first trade turns out to be a winner and you make $1,500 on that trade, 1 to 5. For the next trade, what you can look into doing then is risking $750, which is 50% of your profit. And if this trade turns out to be a winner as well, what will happen then is the following. What will happen is that you're going to be making 5 times 750. Think about that. Whilst your initial risk was only $300. So do you see where exponential risk management can come in handy when you're trying to grow your equity curve in a very quick manner? But again, please keep in mind that when it comes to trading prop firms and such, there are a lot of rules, and I'm not familiar with the rules. They have changed, I'm sure, since I've last traded them, which is a few years ago. So I know not all of the little things that are present right now, but based upon what I'm hearing sometimes from students when it comes to emails or support messages, etc., I know that you're limited a lot. And therefore, be cautious when trying out exponential risk management. And therefore, this is an approach which is, in my opinion, mainly suitable for personal accounts. And that is something for the people that are trading personal accounts to potentially consider. Now, with that being said, I've shown to you 3 different risk management strategies. But do you see how each different risk management strategy comes back to decreasing risk when in drawdown? And the reason why I'm putting so much emphasis on decreasing risk when in drawdown is due to the fact that that makes sure that your equity doesn't take deep dives. But it also shows to you that you're able to maintain a sense of discipline where you're able to say, hey, you know what? I do not need to regain this lost equity right away. Now, if you would like to use exponential risk management, again, be cautious because it takes a lot of experience and you need to have a thick skin within your mind because you must be able to handle bigger numbers fluctuate. That takes time, guys. You don't immediately go to trading multiple minis when you just start out with trading. Simply doesn't happen. Therefore, that's why we always suggest begin with micros. And once you are comfortable with micros, you can consider on your own. I will never tell you to go out here and trade live money. However, if you decide on your own that you're ready to trade minis, that's when you consider trading minis as well. I hope that this lecture has provided you with a good insight on different risk management strategies, which I personally use, except the popcorn ones, of course. And I hope that you have gotten a great deal of insight on when it comes to navigating risk management accordingly. I want to thank you for watching this lecture all the way to the end. After this lecture, we're going to be diving into different delivery profiles for the different sessions from London all the way to New York PM. And I will be sharing with you specific algorithmic signatures to look for during those sessions. I look forward to speaking to you in the next one. Be safe. Hello there. I hope that you are doing well. Welcome to this new lecture of the 2025 model series. During this lecture, we will be discussing protocol development. This lecture is going to be in a completely different style than the prior lectures of this series, and the reason being is because I'm going to take you with me into a free program which I like to use called myro.com. Myro.com is a platform which you can use in order to create flowcharts. And the reason why I wanted to create this lecture for this model series is because I understand that many of you have gone through the lectures of the model series and have probably not yet created your own protocol as a result of that. Therefore, I'm going to guide you into developing your own protocol and how I would suggest you to begin looking at all of the lectures which are released for this model series. Now, what's important to note is that when we began the model series, I began focusing on, first of all, discussing individual concepts such as price cycles, time cycles, and PD arrays. After these individual concepts were discussed, I began diving deeper into the protocol itself, where it begins with higher time frame institution order flow and where we're now at delivery profiles. Now, what's important to note is that when it comes to the overall structure which I utilize within the release of this content, I would like you to understand that everything was released at exactly the right moment in time. Meaning I planned out in advance at what moment I wanted to release and discuss specific topics, and therefore I'm going to show you more behind this structure now. Now, understand that many of you have probably not recognized this structure because you were probably treating each lecture as if it was a new individual lecture. However, everything is connected, and that is something which I would like to begin seeing. So what I will be sharing with you is a flowchart example of what your protocol can look like moving forward. It's important to note that when we eventually look at protocol development from a personal perspective, every single trader is going to have its own protocol, meaning every single trader is going to create its own variation of what I'm about to share with you. But it's important to note that the foundation should always remain similar as that was what I'm about to share. Now, when you go to myro.com, what you can do is you can just create an account for free and you can log in with your email. Once you have created your account with Myro, you can go to a flowchart and you can open up a new board. Now, when we pay attention to a new board, what I would like to see is that I've outlined right here the reversal sequence. The way that I've created this reversal sequence is by utilizing the following, utilizing the shapes tool right here and squares. Once you put a square on the screen, what you can do is you can type in that and you can give it the background color, etc. But for the sake of simplicity, I've already did all of that, so I'm just going to walk you through what I've put in front of you. Here you can see the reversal sequence, and the reversal sequence is basically the core of everything which I've been discussing throughout the model series. And the reason why this reversal sequence is important is because I want you to understand that in advance of every single market reversal, the same steps always apply. And that's the beauty of the model as I'm teaching it to you. This is the core of icttrading. This is literally what icttrading is doing all the time. And this is fractal, meaning it applies on all different time frames. So what's important to note is that the reversal sequence looks like the following, where you can see that it begins with higher time frame institutional order flow. This right here is very important. If you are unable to define the higher time frame institutional order flow, you cannot continue moving forward, meaning your focus must be first on determining the higher time frame institutional order flow. After the order flow has been established, the next step is determining the drawing quantity. This is the price level that icttrading is drawn towards like a magnet, so to say. It's going to keep on repricing until that level has been met. This is our DOL. After we established our DOL, the next step is recognizing our point of interest. And the reason why it's important to understand that DOL comes prior to POI is due to the following. Whenever you come to the charts, it's not simply, oh, we take out the previous cycle low and therefore the market should reverse. No, there has to be a higher time frame, bullish order flow, which is in play, and you must have already determined a drawing quantity above market price. Only then can you look at a point of interest in the sense of, okay, I'm going to be looking for a reversal to originate from here. And the reason why it's important to understand this is due to the following. What I would like you to understand is that whenever we come to the charts, our job is on determining, okay, let's say that the higher time from institutional order flow is bullish and we're anticipating price to draw towards, for example, an old high. This is our DOL. What we then anticipate for the next time cycle is the following. We're looking for the market to open up, drop lower. Why is it important that we drop lower? Because it's inside of this move lower that retail is being trapped into believing that lower prices are next. Usually this drop is rather quick and sudden, and the reason why it has to be quick and sudden is because it's inside of that quick and sudden repricing lower that manipulation is taking place. That drop lower induces emotions of fear. It induces the thoughts of, oh, the market is going to continue dropping, it's going to continue expand towards the downside. But it's exactly in that fear which is being established that smart money is beginning to position themselves long. Until when are we likely going to drop? We are likely going to drop until our POI has been met. Meaning, what you can look for is the following. You can look for open low of a new time cycle into your point of interest, but only after you establish that the higher time frame order flow is bullish and you establish the drawing quantity. This is why POI comes after DOL, because once our POI has been met, we can anticipate that price is likely going to expand towards the DOL. Now, the opposing schematic will of course be true for bearish order flow, where you can see that the market is repricing towards the downside on the higher time frames. You're bearish, and therefore you look for a drawing quantity below market price. So what are we going to be looking for the next time cycle? We're going to be looking for the next time cycle to open up, run higher. It's in this run higher that's manipulation is taking place. And usually this run higher is rather quick with big green candles. Why is this important? Because those big green candles induce retail into believing that price is likely going to continue expanding forever, that price is likely going to continue running, and it induces feelings of fear of missing out. So everyone is going to try and buy it as the market is running up higher like this. But this is exactly in that manipulation that smart money is positioning themselves long. And once the POI has been met, we can anticipate that the market is likely going to reverse to draw towards the downside. Now, I hope that by me drawing these schematics in real time that you're able to experience light bulb moments, because these are these fundamental concepts which are very important to understand. If you do not understand what I've just drawn up when it comes to higher time from institutional order flow, DOL, and POI, I highly suggest you to go back to the respective lectures within the model series and study them. Because what I'm going to do during this protocol development lecture is I'm going to simplify everything and bring it back to the core. And the reason why this is important is because you want to be able to basically fit your whole model, your whole protocol on the business card. And the way you do that is by having these fundamental concepts well understood within your mind, and that you can simply look at a schematic like this and say, okay, yes, this is the beginning of the reversal sequence playing in right here, because this is what our focus is on, recognizing reversals. And that's the whole model as I'm teaching it to you throughout this model series. Now, it is definitely possible to also be looking for continuation trades. However, when it comes to continuation trades are merely a result of understanding that price is yet to reach a higher time frame DOL. So continuation trades will provide itself on the lower time frames throughout this run lower within the sell program, or throughout this run higher within the buy program on the fractal and smaller time cycles. Now, after the reversal sequence has been established from the higher time frame institutional order flow to the POI, the next step is paying attention to the time of interest, to the SMT and the CSD. So these are basically the fundamental concepts from a basically simplified perspective. However, each one of these individual steps has its own sub-steps. It has its own smaller steps which we can pay attention to, and those are going to be shared with you shortly. However, before we dive into those, I would like you to understand that this sequence literally means that every single step leads to the next step. If you're unable to define, for example, what your point of interest is, you're not going to say, hey, you know what, I'm going to continue to the time of interest and I'm going to continue for a trade. No, the whole sequence is built around every single step being well defined, every single step being predefined. And therefore, if you do not see any of these steps, doesn't matter if you can't see the POI, doesn't matter if you can't see the DOL, doesn't matter if you can't see the SMT or the CSD, if any of these steps is missing, you are not going to find yourself in the right environment. Therefore, I want you to start becoming process-oriented in this sense. And the way that I always suggest that people study this is through the following. I suggest you to have a protocol defined according to this reversal sequence, and then make sure that you have it on another screen, or maybe you can print it out and put it on your desk. But whenever you come to the charts, I would like to start thinking in the sense of, okay, step 1, step 2, step 3, step 4, step 5, step 6. And it's exactly in that order that you're going to be able to align yourself with what is like going to do next. Because once this whole sequence is complete, what's like going to happen next? We're likely going to see a reversal taking place, and we're likely going to see the right side of the curve be developed. So I hope that this is clear to you, and if you need some more time to process everything which I'm shared with you so far, please pause the lecture right now, because I'm going to continue shortly. But before we continue, I would also like you to look at this reversal sequence and look at all of these bigger blocks, all of these bigger steps, and would like you to try and define as best as you can for each individual step how you can determine the higher time from IOF. How can you determine the DOL? How can you determine the POI? How can you determine the time of interest? How can you determine SMT? And how can you determine CSD? Because by practicing your recognition of being able to define each one of these individual steps and comparing that to what I'm about to share with you, you're able to test whether or not you understood the majority of that what I've discussed throughout this model series. Now, with that being said, I'm going to move lower towards the sub-steps as well. So here you can see the reversal sequence, but then with the stop steps as well. And what I would like you to see is that the higher time from institutional order flow begins with the following. First of all, we must define whether or not there's a market maker sell model or market maker buy model in play. Meaning, is price right now in a sell program or in a buy program on the highest possible time frames? And we're speaking about monthly delivery now, we're speaking about weekly delivery now, we're speaking about daily delivery now. Once you're able to define on the higher time frames where price is drawn towards, Whether it is, for example, a sell program or buy program, this is direction, higher time frame institutional order flow. That's when we move on. However, there's a very important role which comes to mind as well when it comes to higher time frame IOF establishment. And that is narrative, meaning you must be able to define why. Why should price expand lower? Or why should price expand higher? What's the overall logic behind that? Why would this make sense? What are the masses led to believe right now? What is everyone else thinking? But if the charts tell you a completely different story, that's when you know that you have a high probability trade setup environment, which is now being established because you know that the masses are wrong. And that's a level of confidence which will be developed over time as you gain more experience. Right now, you probably don't have that confidence just yet. Some of you do, I know that, because some of you are absolutely crushing it already. But I know that for the majority of traders, they are too new when it comes to looking at these concepts. And therefore, it will require more time and effort for you to get to that level of confidence. But that will come in due time. Submit to time. Don't try to rush the process. Literally just aim for, let's say, 6 to 12 months. And within 6 to 12 months, I believe that if you study everything which I'm outlining to you during this lecture and that I've outlined to you throughout the whole model series, I'm 130% confident that you are going to achieve that level of confidence because it doesn't change. Like, this remains always the same. And I think that's a very beautiful experience for you to start feeling that way for the first time. I remember what it felt like for me when I began realizing that this is all that icttrading does all the time. And my job is recognizing the reversal sequence. Because when I can recognize the reversal sequence, that's when I can anticipate the right side of the curve. And that is what I do within my reviews. That is what I do within all of the analysis which I share with you. That's what I do with all my trades. Everything is based around the reversal sequence, recognizing reversals. Now, once we have established the higher time frame IOF, the basically next step is determining draw liquidity. Now, when it comes to draw liquidity selection, there are a variety of tools which we can utilize to determine the draw liquidity. First of all, we can be paying attention to PXH and PXL. And what PXH and PXL means is the use of time cycles. And when it comes to draw liquidity selection, it's important to note that there are multiple draws on liquidity. But you move from the bigger draw liquidity to the smaller draw liquidity. Meaning, once you have defined, for example, that the higher time from institutional order flow is bullish, you're going to be looking for a draw liquidity above market price for the upcoming month, if not weeks or days. Once you have established that bigger draw liquidity, you can utilize smaller time cycles to frame draws on liquidity throughout the days. Meaning you can be using a previous session high, or you can be using a previous 90-minute cycle high, or even previous 30-minute cycle high. Depends on how big the trades are which you want to target. But this is important to note because we move from the bigger time frames, the bigger time cycles, to the smaller time cycles when it comes to draw liquidity selection. The next step for determining the draw liquidity is by paying attention to old PD rates. You can be thinking of old imbalance price ranges, old imbalances, you name it. As long as you have a higher time frame old PD array, which you see that icttrading has yet to reprice into, and you can pair it with a previous cycle high, then it is a beautiful signature because that shows that liquidity has been engineered in advance of that higher time frame premium array. The next step for determining draw liquidity selection is paying attention to key levels. And when it comes to key levels, you can be monitoring the reactions to the ranges as I've been teaching them to you throughout this 2025 model series. Pay attention to the big figures and pay attention to whether or not there are key arrays which have formed inside of those levels or around them, and pay attention to whether or not liquidity has been engineered in advance of them. Because when you see liquidity in advance of a key level, it's a beautiful sign. The next step is paying attention to opening prices. And I'm not referring to opening prices in the sense of just midnight openings, so daily openings or whatever. No, I'm referring to bigger time cycle openings. So we're speaking about monthly openings, then we're speaking about quarterly openings, yearly openings, etc. Because once you start paying attention to those bigger time cycle, their opening prices, you're able to have a premium and discount filter. Where above the specific opening, you're going to be looking for shorting opportunities if price is range bound. And below that open, we are going to be looking for buying opportunities if price is range bound, or if we're going to trend where manipulation is taking place. Manipulation below the opening price, form a swing low, and then expand towards the upside. But keep in mind that we can also use opening prices to determine draws or liquidity, because price will seek to revisit, for example, a yearly open a lot. Why? Because it is a crucial level for the whole yearly delivery. When we then pay attention to point of interest selection, what you can see is that the point of interest is actually exactly the same 4 steps as it is for the draw and liquidity selection. And that's a very important insight which I'm sharing with you. And this comes back to the concept which I've been discussing a lot lately, and that's the following. A to B, the B gets met and turns into a new A to B. And once the B gets met, a new A to B gets established. And this process is infinite. And this is also why what you see taking place throughout the days is that where some of you enter positions and eventually exit those positions, others will look to get into new trades. And this is what I refer to when I say, hey, we're playing ping pong on these markets, where my exit could be your entry, and when your exit could be my entry. And that's what I mean when I say A to B, A to B, A to B, A to B. Meaning, all it is about is the following. It's about recognizing the A to B, the price swing from inception to terminus. And once your terminus has been met, that's when your idea is done. But that terminus could be someone else's inception. And that's a beautiful sign to see. Now, I don't want you to think that you should be trading all directions all the time. Meaning you shouldn't be looking for shorts to longs or longs to shorts or whatever when you're completely new. That will take a lot of experience. But in the future, I believe that if you investigate everything which I'm outlining to you during this lecture, but also throughout this whole model series, I believe that you will be able to anticipate when delivery like this is going to take place. And it's all about being content with enough at the end of the day, guys. Like, don't think that you should be living to trade. I believe that the right mindset to have is that we're trading to live. Meaning, once we make our money, we're done. We don't care anymore. Because else what will happen is that you're trying to do too much. And it's not about doing more, it's about doing less actually. So therefore, focus on the reversal sequence from a perspective of the move which makes the most logical sense to you. And the only way to define it is by paying attention to the bigger time frames. Paying attention to, okay, where are the higher time frame swings forming? And once a higher time frame swing is forming, whether it be a swing high or a swing low, that is when we know, okay, low resistance liquidity run is likely going to flow next. Now we can lock in and focus. Now, for the point of interest selection, what's important to note is that we pay attention to the opposing PXH or PXL as we did for the draw and liquidity. Meaning, if we are bullish and we're looking for higher prices, we are targeting a previous cycle high. But that means our point of interest becomes a previous cycle low. Why? Because we need to see sell-side liquidity be taken out before the market can reverse. Why? Because we move from sell-side to buy-side to sell-side. Now, what I love to see is sell-side liquidity be engineered in advance of an alt PD array, in advance of a discount array in the case of bullishness. Next that, I love to see a key level being around that array. And if I see price open up, drop lower below an opening price, and I see that clear manipulation taking place, think back to the schematics which I've outlined right here, where I mentioned that the beginning of this drawn right here is the beginning of a new time cycle. You should begin to smile, because this is how you can see that everything is connected. Now, once we have defined a point of interest, what we'll be waiting for is we'll be waiting for a time of interest. And when it comes to times of interest, there are 2 methods of looking at times of interest. There are way more, but to keep it simple for you throughout this foundational protocol, so to say, we are going to be paying attention to the macros from XX45 to XX15, and we're going to be paying attention to manipulation cycles. Now, the macros themselves are pretty straightforward. I've already discussed them in depth throughout this model series, so if you do not understand them yet, I highly suggest you to go back to those lectures and study the importance of macros. However, manipulation cycles are something which for the majority of you probably doesn't click as much yet. And the reason being is because you probably think that the manipulation cycle is purely the respective 90-minute cycle within each session. So for example, within London, AM or PM. And that's correct. However, the time cycles shift, meaning manipulation cycles shift throughout each trading day. Not every single day the low of day is going to form between 8:30 to 10, for example. It doesn't happen. Why not? Because if it would happen that way, then it would be obvious to the masses that ictt, or that there are entities out there that are manipulating always between 8:30 to 10. And that is of course not possible because we need that counterparty. So it must seem random, so to say, to the masses. But it's exactly in that understanding that your focus has to be on, okay, what is the delivery profile for the day? And the way we define what the delivery profile for the day is by paying attention to manipulation cycles. So I'm boxing it in right now. This is where your focus has to be. Recognize manipulation, because once you recognize manipulation, you can anticipate distribution. Now, I can already hear you think, but Zeus, how can I recognize manipulation? How can I recognize that price is manipulating? And it comes back to that same foundational schematic. Open low into a point of interest after you have established DOL and your hard time from institutional order flow. The moment that a new time cycle opens up and manipulates into your point of interest, that is when we can say, okay, this cycle is manipulating, so we're either going to distribute heading into the end of this cycle, or we're going to distribute heading into the next cycle. And that is how you recognize manipulation cycles. Then the next step is confirming this manipulation cycle, confirming that we're forming a swing low or swing high. The way we do that is by paying attention to SMT. Why SMT? Because SMT stands for Smart Money Time. Keep that in mind. SMT literally shows to you that there's a manipulation leg, which is likely coming to an end now. How can we look at SMT? Well, I've taught you 3 different forms of SMT besides some other forms of SMT. However, for this foundational protocol, I've decided to purely focus on the 3 most important forms of SMT. And those are, first of all, big time cycle SMT. So think of SMT relative to bigger time cycles. A smaller time cycle SMT inside of the absolute reversal right here. Or double SMT, where you have both forms of SMT present. So it's important to note that the SMT is relative to the duration of the analysis which you're making. Look, if you're making an analysis for the upcoming quarter, for the upcoming 3 months, right? You're not going to be looking at a 1-minute SMT and going to be saying, okay, this confirms to go over the quarter. No, it doesn't work that way. You'd be more inclined to utilize a weekly SMT or a monthly SMT. Maybe even daily, to be fair. But when you pay attention to, for example, an analysis for the day or even the session, then you can utilize, for example, a 90-minute cycle SMT, 30 minutes, 10 minutes, maybe even 3-minute cycle SMT to confirm the low of that smaller time cycle. Now, it's important to note is that SMT by itself means absolutely nothing. So do you see where that statement comes from? SMT only holds any significance after all of these prior 4 steps are checked, meaning after all of these prior 4 steps are in play. That is also why within the model series, I didn't release the SMT lectures at the beginning of the series. Look, I've outlined literally a sequence. So I hope for those of you that have gone through my model series up until this point, that you have studied it in depth and that you've paid attention to these smaller details, because it's literally a sequence in which I've been explaining everything to you, because this is the sequence of ictt. And I understand that for some of you, you've probably been not putting in the work. You've probably just watched through the series and you're now at this lecture and you're like, damn, I don't understand it yet. Look, if that is the case, you rush through it. That's the easiest way to say it. You rush through it and you need to take accountability for that. And the way that you're going to make sure that you get to that right level of understanding is by going back through the lectures, doing the homework assignments, looking in the chart for that what I'm explaining to you, and then simply diving deep and beginning to see the repetition, because it's the same process all the time based around time and price. Now, the final step which we're going to be paying attention to is CSD, change in the state of delivery. Now, for CSD, I've defined 3 different ways that you can be looking at CSD. First of all, imbalances displacement through. Meaning, imagine that there is, for example, a reversal which is taking place on the upside, and you have imbalances which formed right here on the left side of the curve. You have imbalances which formed here, and you have imbalances which formed here. These are CBs. These CBs, these premium imbalances, should function as resistance from price to continue lower if the underlying order flow is going to remain bearish. However, why are we going to be paying attention to these imbalances now? Because all of the prior steps of the reversal sequence are in play, which signal to us that the swing low is in the making. Therefore, we are not looking at these CBs to short of, to go market short against, so to say. No, we're anticipating that price is going to rip through them. And once price runs through that sequence of imbalances, which reached our point of interest right here, that's the first sign that the underlying order flow is changing. And what we can then anticipate is that price is likely going to retrace, utilize that sequence of imbalances as support and price, and reprice higher. If price displays through the next sequence of imbalances, and when I say sequence of imbalances, I say multiple imbalances, but it can also just be one. Depends on the environment and how quick the market has been moving. But if price displays through those imbalances on the left side of the curve, that's a sign to you that the underlying order flow is changing from sell to buy program. So what we can anticipate is that price is likely going to retrace and expand towards the upside. Now, the next step then is the creation of opposing imbalances, because as price is repricing higher, what we will be monitoring is new imbalances to form. The reason why is because these imbalances are showing to us that there's a certain urgency for the market to reprice higher. It's showing to us that there's urgency for the market to displace, to run. That's the function of an imbalance. An imbalance shows to you speed. Now it has to run. That's why there's no time for a retracement to take place to see immediate rebalance. Now instead the market just continues running, and at a later moment in time it will retrace to reprice back into that inefficiency. Now the third step which we can be paying attention to confirm CSD is a breaker or mitigation block formation. And the reason why a breaker or mitigation block formation is crucial is because a breaker or mitigation block formation is required in order for a swing high or swing low to form. Meaning every single swing formation either has a breaker or a mitigation block. There are no swings which form in any different shape or form. And that's something which I would like to investigate. I've already mentioned this prior throughout the series, but if you did not investigate this yet, do so. So do you understand why it is crucial that you focus on recognizing swing highs or swing lows formations through the lens of breaks and mitigation blocks? In my example, this is your bullish breaker, of course, right here. Now, what's important to note is that in front of you, I've drawn up the reversal sequence with an example. And do you see how every single step is leading to the next step? That right there is the most important takeaway which I want you to have from this schematic right here. Because this is literally the foundation of the protocol as I suggest you to begin working with. You can define and remove your own variables if you would like to, for example, only pay attention to PXH and PXL in combination with, for example, PD arrays, or you can be looking at purely break and mitigation block formations. You can be purely looking at the macros and you only want to trade those. Doesn't matter. This is the core. And around that core, you'll be able to define your own process, your own protocol. Now, this is purely the technicals, meaning this is the reversal sequence from a technical perspective. The next step is paying attention to risk management. For risk management, I highly suggest you to watch my risk management lecture in which I discuss this topic. And the reason being is because risk management is again something which is very personal. Meaning some of you might be very aggressive when it comes to risk management, whilst others might be very conservative, where you're trying to slowly grow the equity. And that is based around personality, based around overall equity, capital to your possession, etc. However, define risk management rules. Define for yourself how much you are going to be risking on any given idea, how much you are going to be aiming to make, how you're going to handle drawdown, how you're going to manage your capital, etc. Define these elements, write them down. Don't be lazy, don't be ignorant and think to yourself, you know what, I don't have to do this or whatever. Look, I'm literally showing to you how to create your own protocol. And the protocol isn't just a reversal sequence. It isn't just technical. No, it's more than that. It's about how you handle risk, but it's also about operator management. Now, operator management is a topic which I've been discussing more and more throughout the 2025 mentorship with sit-down lectures, with more psychological rants, etc. And this is something which I'm going to be releasing more and more on in the future. But the reason why operator management plays a crucial role when it comes to everything which I'm outlining to you now is because at the end of the day, this is purely the technicals, meaning this is the reversal sequence. This is icttrading. And if you don't believe me yet, it's because you haven't studied enough yet. However, I know that some of you have studied enough and I've been receiving great messages, absolutely phenomenal when I see those support messages or when I receive those DMs or those emails, etc. And it makes me smile to see you get those payouts, to see you get that profit on those live accounts, etc. And please keep in mind, I'm never going to be telling you to go out there and trade based on the information which I'm providing to you. Everything which I'm sharing right here for you is purely for educational purposes. I'm not a financial advisor and I'm not licensed to give you any financial advice. However, I'm simply sharing my own thoughts when it comes to price delivery. But when it comes to these technicals right here, look, this is a objective way of looking at the markets. Yes, it's based around time and price. Now, what's going to be the differentiating factor in terms of results which people will have if they decide on their own to utilize this information, first on a simulation account and later down the line, of course, in other accounts? What's going to be the differentiating factor are these two elements right here. Risk management, operator management. Meaning the more aggressive traders who will have higher risk tolerances, they will be able to make more returns than the conservative traders, of course, if they apply operator management correctly. Because that's the next step. Learning to manage yourself. Getting to know yourself. And this is where journaling plays a crucial role. Getting to know basically what makes you tick. What makes you do great things or what makes you go down the wrong path. And once you have experienced those different experiences and you're able to come to terms with, okay, this is who I am as a trader, this is what makes me tick, that's when you're able to eventually excel. So when you go into the charts and you begin thinking about, okay, I'm going to try and pursue a career of trading for maybe full-time, or maybe you're going to do it part-time besides your regular business or job. But if you decide on your own to make that decision, submit to time, because you need to learn operator management. And the only way to learn that is by paying attention to the lessons which I've already provided to you and by journaling, by submitting to time and going through the experiences. And that is crucial. But I hope that this video and this lecture has given you a good insight on how you can define your own protocol. Again, I highly suggest you to check out Myro. Again, I'm not affiliated with them. I don't have a code or anything like that. I don't get anything for mentioning them during this lecture. But I've been using them for years and I absolutely love the platform. It's super clean and it's a super easy way of defining flowcharts. And therefore, really suggest you to check it out. Because look, I know some of you are probably going to take screenshots from everything which I've shown during this lecture. And you're going to just copy paste it and you're going to think, okay, this is all that there is to it. You can do that, yes, but use it as a foundation. Meaning, use it as a foundation which you can build upon for yourself. This is your personal model, your personal protocol which we're developing. It's not simply, copy paste Zeussy, his foundational protocol, and that's it. No, remove things that you don't like, add things that you want to add, and move based upon that. And that is why I found it so important to create this lecture for you. I hope that you found it insightful. I hope that you have gotten a great insight on how to eventually begin with developing your own protocols. And during the next episodes, what I will be sharing with you is I'll be sharing with you application. And that means that we'll be in the uncensored style. I'm going to be discussing examples of the protocol being in play, etc. Good luck with your studies, and I look forward to speaking to you in the next one. Be safe. Hello there, I hope that you are doing well. Welcome to this new lecture of the 2025 model series. During this lecture, I'm going to be discussing the most frequently asked questions which came as a result of students having gone through the model series up until this point. These questions were asked either through the support page or they were asked in my DMs. Now, before we dive into this lecture, I would like to share with you that the majority of questions which were asked were either based around order flow or transitioning from higher time frame to lower time frame analysis and what to look for. So I'm going to be providing to you the answers to these questions. Now, what I've done is I've defined these questions as best as possible to make them as general as possible as well. The first question which we're going to be discussing is how do we determine the order flow when we open our charts? Meaning, how do we determine whether or not we're currently in bullish or bearish order flow? Secondly, we're going to be discussing how we can blend narrative with technicals, meaning how we can blend the overall understanding behind why something should happen with that what the chart is telling to us, whether the price is bullish or bearish. The third question which we're going to be discussing is how can we utilize lower time frame if we established higher time frame IOF. We're going to begin with the first question at first, and that is how do we determine the order flow when we open our charts? When it comes to this question, it's important to note that the order flow gets established by first of all paying attention to, okay, what is the market structure signaling to you from the highest possible time frames? Meaning, what are the highest possible time frames? Think daily, weekly, monthly charts telling to you. Is price right now in a buy program or is price right now in a sell program? Once you have defined what the highest possible time frames are signaling to you in terms of direction, you look into the lower time frames to see whether or not price is confirming that same direction. Meaning, if we are looking at the Nasdaq IO chart right now, and at the time of this recording, it's the beginning of June and we have been very bullish on the indices, on the American indices futures. If we have established that right there, we're going to be looking for the signs every single week that signal to us, okay, price is likely going to expand towards a specific level, a specific range. This is our draw liquidity. Once we have established this range, what we can be looking for is we can be looking for buying opportunities heading into that level. Once this draw liquidity gets met, however, that is when you need to be cautious. So when it comes to the week which you have in front of you right now, this was NFP week. And in this NFP week, what we saw taking place was the following. What we saw taking place was first of all that when we open up right here, we saw the market drop lower for the beginning of the week. This took place throughout the Sunday open and throughout Monday. Notice that we eventually form a low right here and we see the market expand towards the upside. Notice that this low formed at 3 AM, meaning throughout the London session on Monday. We saw the market expand towards the upside and we saw it reach this early CB right here on the left side of the curve. I'm going to be extending this CB to the right. Notice that the market rejected this CB at first and we saw the market retrace. Notice that the market repriced lower and notice that it repriced into what? It repriced into the yearly open right here. A new day opens up, the day of Tuesday. And what happens? Open low. Do you see what I'm paying attention to? I'm paying attention to how we're opening up for the week and for the days. And the reason being is because by paying attention to that open low right there, you're able to establish, hey, we're manipulating lower now for the beginning of the day, whilst we already know that on the higher time frames we're bullish. So what that means is that we're looking for the fact that the lower time frames are confirming to us intraday, yes, we are in fact forming lows of day during London. And because that occurs, you can anticipate what? The New York morning session should expand towards the upside. Why? Because you have a draw on liquidity of the previous week's high right here. The moment that the new week opens up, your eye is immediately drawn to, okay, where's the previous week's high? Where's the previous week's low? Once you have established that the higher time frame order flow is bullish and price shows you that it is in a rush to get somewhere, that is when you can confidently say previous week's high is going to be the level which price is going to be drawn towards. However, what's important to note is that in advance of this previous week's high, what you can see is that we have this RECB right here. This RECB could function as a big hinder on price. And when I say hinder on price, what I mean is that price could reach this range and reject it multiple times. Why? Because if we zoom into this range right here, what I would like to see is that we formed a low right here, we repriced higher, and then we displaced through this low with this CB. Therefore, what we can anticipate is that when price reprices into this range, it is being repriced into an imbalanced price range, and the moment that price leaves this imbalanced price range, this price range becomes balanced, and therefore price is going to try and fight against the balanced price range. And whenever price is trying to fight against the balanced price range, what that looks like is the following: a lot of back and forth going around that range right there. And when you pair this with the week, you can notice that we have NFP week. So throughout NFP week, this is the type of delivery which you anticipate. And when it comes to how we establish our higher time frame order flow the moment that we open our charts, it's important to note is that there's a framework to this, and that's the following. First of all, what you do is you define what is occurring on the highest possible time frames. And when I say highest possible time frames, I'm speaking in terms of, okay, what are the bigger time cycles suggesting? What's the quarterly cycle suggesting? What's the monthly cycle suggesting? What's the weekly cycle suggesting? Once these all tell you a specific story, the next step is then to look at the weekly cycle and begin paying attention to how each individual day is delivering. Because based upon how each individual day is delivering, you can anticipate what the next day is likely going to do. When you pay attention to Monday and Tuesday, what you can see is that Monday expands towards the upside right here. And when you pay attention to Tuesday, you can see that Tuesday also expands towards the upside right here. Notice that I'm anchoring the full day range from low to high. Notice that these ranges are rather large. So what should happen? Well, on Wednesday, we see price reach our point of interest or a draw liquidity. It's the same. Every single A to B turns into a new A to B, as I've been teaching you throughout this model series. So what you can anticipate for Wednesday is a small range day. So when you pay attention to the range which got established on Wednesday, what you can see is that price kept on coming back towards the range of that same CB. So do you see how we're blending, when we come to the charts, time cycles from the bigger time cycles to the smaller time cycles? And when we navigate each new week, we pay attention to, okay, what did the previous day do? Because based upon what the previous day did, we can logically anticipate what the current day is likely going to do. So what I would like you to start paying attention to is what's happening on any given day, and then see whether or not your weekly objective gets met. When your weekly objective gets met, that is when you should be cautious with holding on to that same idea which you had at the beginning of the week. So if we pay attention to the first question, how do we determine the order flow when we open our charts? What you pay attention to is a variety of things. First of all, you pay attention to whether or not discount arrays or premium arrays are functioning as either support or resistance price. That's a given. Next to that, you pay attention to the openings of each new day. If you pay attention to what happens from the midnight open, 12 p.m. New York time, and you pay attention to what the London session does, you can anticipate what the New York morning session is likely going to do. Based upon how the New York morning session delivers, you can anticipate what the afternoon session is likely going to do. So what you're doing is you're taking it one session at a time. And that is a major tip which I want to give to you, where I want you to become more fluid when it comes to finding opportunities. And the reason being is because the model, as I've taught it to you throughout this series, provides a lot of opportunities. And the way that you find your opportunity is by sticking on the ROI chart as long as possible. Now, when it comes to the following question then, how can we blend narrative with technicals? Well, in order to blend narrative with technicals, we must first be able to establish narrative. This is something which I discussed in great detail within the swing trading series, which I released at the beginning of 2025. I really suggest you to go over that even if you're not a swing trader. But in that series, I teach how the masses are getting tricked into false beliefs. And if they are getting tricked into a false belief, whilst the chart is telling you a completely different story, then you know that a high probability trade setup is being set up. And the way that you can internalize this is by looking at the following. What's the reason why everyone would be bearish now? And if you recognize the reason why everyone would be bearish now, but the chart is telling to you higher, then you have a very good setup. If you recognize that the masses are bullish, but the chart is bearish to you, then you again have a very good setup. So what you can see is that we're basically going against the masses when the chart tells us to do so. This also, however, means if the chart does not tell us to go against the masses, we simply just keep on looking for long. So let's say that the market is just skyrocketing. It's just running up higher vertically. And the masses are, of course, turning bullish. As long as price has yet to reach its strong liquidity, has yet to reach its point B, we keep on looking for one thing, and that is longs, 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 longs. If price is showing nothing but weakness and it's just dumping and it is yet to reach point B or drawing liquidity on the downside, we keep on looking for shorts. Why? Because the technicals are suggesting to us that we should do so. So what you can see is that narrative is this concept which is important when blended with the technicals. The majority of people, they simply look at what the newspapers are saying, they look at what goes around the social media, and they think to themselves that that's the reason why price goes up and down. That's nothing to do with what gets shared on the news. However, the news gets utilized to reprice in a specific way. So our job is anticipating whether or not that news is being utilized for manipulation purposes so that distribution can take place afterwards. A beautiful example of this is right in front of you. And at the time of this recording, there is a lot of chaos in the world. There's a lot of news which is being thrown around. There's a lot of manual intervention taking place. But what happened on Thursday right here was that President Trump and Elon Musk went head to head with each other. They used to be friends, so to say, to the public, but they now came out as enemies. They were going against each other. And it happened right here on Thursday. Do you see what happens? Price reprices lower towards the yearly open, towards an old area of inefficiency, which price was yet to trade into, right here, which got established on Tuesday. Forms low there, and boom, reprices higher right away. Why does that occur? Because technically speaking, icttrading had to reprice into this old inefficiency at one moment in time. If you pay attention to this high, you will see that formed inside of a CB as well. So you know that this is a very important high to monitor. But do you see how the news gets utilized to make sure that that repricing order takes place? Look, whenever you recognize that news is being thrown around the social media or you see it within the news headlines, etc., the moment that you recognize that and the news is telling you something which goes completely against what the chart is telling to you, then you know, man, oh man, this is sweet. Why? Because they're setting up a beautiful setup. Now, the third question is how can we utilize the lower time frames if we have established higher time frame IOF? When it comes to utilizing lower time frames, once we have established higher time frame IOF, the main takeaway which I want you to have is the following. When we have established that the higher time frame direction is, for example, bullish, we will continuously look for longs until our drawing liquidity on the higher time frame analysis has been met. Once this higher time frame analysis has been met, however, this drawing liquidity, that is when we can be looking for opposing scenarios. Why? Because who is making money all throughout that run higher? Buyers. So who is icttrading likely going to target when we see the signs present of a reversal taking place at point B, at our drawing liquidity? It's going to attack those buyers, their stops. That is engineered sell side liquidity. So a beautiful way that you can internalize this is that the moment that your higher time frame DOL gets met, go to neutral. Don't have any expectation. Price could continue, price could reject, price could consolidate. There are a lot of different scenarios which take place. However, you wait for icttrading to show its hand to you. And when it shows its hand to you and it shows to you, yes, I'm in fact going to reject that point B, which you had as your draw liquidity, and you see all the lower time frame signatures which are in play. So think of time cycle SMT, think of manipulation ahead of that time cycle SMT, think of CSD falling. When you see all these different signatures in play, that is when you can establish, okay, the moment that price indeed begins to roll over and it begins to create premium raise, those premium raises can get utilized to find a shorting opportunity. But here comes the thing. Your focus has to be on swing formations, recognizing whether or not a swing high or swing low is forming. And in the example which we're discussing now, where I'm discussing a hypothetical example with you, I hope that you're able to visualize what I'm outlining to you. If price reaches that draw liquidity which you had on the upside and you see the signs of a swing high formation taking place, the moment that price indeed confirms that swing high formation through SMT and you see CSD taking place, that is when you know price should roll over. And from that moment in time, you can literally use the entry pattern that you prefer to use. And there are a lot of different entry patterns which I've discussed throughout this model series, which you can decide to use. Pick that what suits you best. That's a major piece of advice which I want to give to you. Don't try to be the person that's using all different entry patterns whatsoever. In due time, some of you will be able to get to that level. However, for those of you that are just looking for that first stage of consistency, stick to one. Because if you're constantly changing your entries, it's very hard to find that first stage of consistency if you haven't yet experienced what it feels like to just repeat the same process all the time. Once you have experienced this for a short period of time, I'd say about 3 months, the moment that you have been consistent with purely trading, for example, based upon the market structure pattern or based upon the breaker or whatsoever, yes, from that moment in time, you can say, okay, you know what? What if I enter a bit earlier? What if I enter, for example, as that order block is being established? Or what if I enter if the rejection block is being established? And man, oh man, when you get those type of entries and you pyramid along the way, that's beautiful, right? However, you can only use the lower time frame if we have established what the higher time frame is signaling to you. So as long as price has yet to reach point B, has yet to reach your draw liquidity from the higher time frames, what you do is you look for opportunities in sync with that direction. However, the moment that the draw liquidity gets met, wait. Wait for icttrading to show its hand to you. And the moment it shows its hand to you, that is when you know, okay, even though on the higher time frames I'm bullish right now, I can still look for shorting opportunities because icttrading is signaling to me that throughout the current 90-minute cycle, price should expand towards sell side. Because price doesn't go up in a straight line. It doesn't go vertical. It might seem that way, however, there are always retracements. And it's in those retracements that new liquidity will be engineered, which can be made jacked at a later moment in time. So what I would like you to take away from these 3 questions, which I've outlined to you here, is the following. Your focus has to be on one thing, and that is recognizing what is the bigger picture right now. What's the bigger narrative in play? And in order to understand the bigger narrative, we apply exactly the same principles as we do on a smaller time frame, on a smaller time cycle, because that's the only difference. The size and the duration of the time cycle. If I'm paying attention to 30-minute cycles, I'm applying exactly the same logic as I'm discussing to you right now on the hourly chart for the weekly delivery, or when I pay attention to a daily chart for the monthly delivery, or when I pay attention to a weekly chart for the quarterly delivery and the yearly delivery, you name it. It's always the same principles. The only question that you should ask yourself is, okay, what are the arrays signaling to me now? What are the reactions to key previous XH and previous XL signaling to me? Is price finding support inside of previous XH when we displace through it? Alright, we're going to continue looking for longs. But if price rejects the previous XH, reaches our draw liquidity, reaches our POI, then we can say, hey, price is rejecting the previous XH, we see the signs of SMT taking place, we see CSD, then you know order flow is changing towards the downside. So do you see how it's all fractal? It's all forming in each other. And your job is to find alignment. And you find alignment by making sure that you're aligned with the biggest possible time cycles. And once you have aligned yourself with the biggest possible time cycles, which you will decide on what to use, if you are bullish for the quarter and month, some of you might implement the rule of, okay, I'm only going to be looking for longs. But others might say, hey, I don't really care about such a high direction. All I care about is what's the current session like going to do based on the previous session's delivery. All I care about is, okay, is price right now in the POI? Has it reached a level where I anticipate a reverse to take place from? Alright, I will take a short, even though the quarter is anticipated to be bullish. So what you see is that this has to do with your personality as well. What type of trader do you want to be? Do you want to be a trader that takes 1 or 2 setups a week simply in line with the higher time frame direction? Yes, that's possible. And there are plenty of opportunities like that each month. But some of you are wired a bit differently and you would like to just find opportunities as they're being presented and you don't care about the higher time frame direction as much, in the sense of you don't care about what the month or quarter is going to do. In my opinion, at first, it's best to simply stick to the higher time frame direction. Find yourself in alignment. And the way you recognize that is that if you're bullish, look for open low. Look for a new day, look for a new session to open low, wait for the signs of reverse taking place, voila. If you're bearish, you wait for open high, into a POI, wait for the signs of reverse taking place, voila, there you go. So what you can see is that it comes back to the same core principles. Higher time frame analysis, dropping into a lower time frame, not immediately 1 minute, but simply a time frame in between 1 minute and, for example, daily. So you pay attention to hourly, pay attention to what's the current day like you're going to do, and then you pay attention to what's happening from these key opening prices. Because based on what's happening from these key opening prices, what we're looking for is looking for manipulation. Because the moment that manipulation takes place, that is when we can anticipate the distribution. And once we see the manipulation ending through the lens of SMT and CSD, that is when we can utilize any specific entry pattern for our entries. And that right there is the main takeaway which I want you to have. Find yourself in alignment with all of the different time cycles. And when you start finding yourself in alignment and you start aligning yourself with that what is being told on the highest possible time frames, and you begin to look at how many opportunities there are every single week, your mouth is going to fall open. And once you have more experience doing that, you can also say, hey, maybe I can look for a counter trend setup simply because I see what the current session is likely going to do. So I'm going to run against everyone who is making money. It's going to set up a retracement, or what the current 90-minute or 30-minute cycle is going to do. But that right there requires a lot of experience, and you need to know exactly from what moment in time IPTA is going to spool towards engineered liquidity. And that will come as you start having more experience and you start practicing what I'm outlining to you here more. With that being said, this lecture comes to an end. I hope that you found it insightful. I'm going to be releasing uncensored lectures soon, and that is going to be where I will be applying the model as I'm outlining it to you during this model series. It's important to note is that I will not be giving you any financial advice. Simply because I'll be showing the real-time application of the model doesn't mean that I'm going to say you should trade this way. I will never tell you to go out there and trade. I will never tell you to go out here and use the information as I'm teaching it to you. All I'm telling you is to investigate that, what I'm outlining to you, because I promise you will never be looking at these markets through the same lens again. I want to wish you good luck in your studies and I look forward to speaking to you soon again. Be safe.